Accounting equation practice problem using Excel. Create accounting worksheet part number 1. Get ready and some coffee because we're about to learn the accounting foundation, the accounting equation in Excel. Here we are in Excel. If you don't have access to this workbook, that's okay because we'll basically build this from a blank worksheet. But if you do have access, there are 3 tabs down below. Example, practice, blank, example. In essence, the answer key, the practice tab having pre-formatted cells so you can practice the practice problem with less Excel formatting. The blank tab, the one that we will be working in, as you can see, is blank. Therefore, we'll be practicing our Excel tools as we build our practice problem in the blank tab. Let's go to the example tab to get an idea of what we will be building. We want to be doing data input, practicing our data input from the perspective of an accounting equation rather than from the perspective of debits and credits. Noting that there are pros and cons to the 2 different approaches, debits and credits being the optimal approach for general accounting system because it makes the data input a little bit easier. However, the downside is that you have more things that you need to know. There's another level of abstraction to get to the debits and credits. So we could start off, which is typically what accounting textbooks do, with the accounting equation, or basically just really get a good idea of what's happening from an accounting equation standpoint, which basically uses a normal algebraic equation, a basic algebraic equation that most of us are familiar with. So when viewing the financial statements from a standpoint of finance, for example, then obviously we usually think of it in terms of an accounting equation, breaking out the balance sheet into the accounting equation of assets equal liabilities plus equity. So that's what we'll focus in on here. If you have the whole concept down from an accounting equation standpoint, you'll probably be able to visualize it possibly a little bit easier in terms of which side of the equation is going up and down, what are the impacts of that. And then you would like to be able to switch in your mind to go from accounting equation to debits and credits. You'd like to be able to code switch if you're working in the accounting department back and forth, ideally, between viewing it in your mind from an accounting equation standpoint and viewing it in your mind from a debit and credit type of standpoint. So I just want to say, though, that the fact that we're building the practice problem using the accounting equation does not mean for accountants it's a good idea to just not learn the debits and credits because, again, they are very practical from a data input standpoint. However, again, we want to be able to code switch. Okay, that's the idea. Now, the basic accounting equation is simply going to be assets equal liabilities plus equity. Noting that we could algebraically rewrite that multiple different ways because we could subtract the liabilities from each side, for example, getting assets minus liabilities equal equity, or we could subtract equity from each side. However, that formula or format is possibly not as practical or useful or as often used as the first 2. So the accounting equation from an accountant perspective is formatted this way. I'm going to scroll in a bit. Assets equal liabilities plus equity, because that basically breaks down to the concept of debits and credits, or the idea that the asset from the perspective of the company being a separate legal entity, which is the way we typically think of the company as a bookkeeper as we do data input, even if it's not a separate legal entity, a corporation, but rather a sole proprietorship. Even in that case, we think of it as a separate entity for bookkeeping purposes. Whatever assets are in the company, therefore, we expect are for the use exclusively, in essence, of the company. That separation between the personal and the company is something that's difficult sometimes, especially for small businesses like a sole proprietorship. But the ideal is, of course, to have anything on the books as an asset for the company to be just the company's assets to be used in the future in order to achieve the company goal of revenue generation being a different goal than the personal goal. Personal goal, you want to live well, whatever that means. But that's why we separate for the company, because on the business side, we know what the objective is. It's to generate revenue. Now you might say, hey, we also want to make a product that everybody likes, and we want people to like what we do, and we're going to be fulfilled by it and all that. It's true, but from a bookkeeping standpoint, all of that is manifest itself in revenue. If you do good stuff in a good free market capitalistic economy that appreciates people doing good work, then the side effect of that is revenue. That's basically the idea. Now, the assets, of course, are the things that we have not yet consumed to generate revenue. We're going to consume them possibly in the future to generate revenue. And then the flip side is liabilities and equity. Now, why are these two things the same or on the same side of the coin? Well, liabilities represent a third party that we owe money to, typically the bank for a loan that we took out or credit card, for example. Also, accounts payable, which we'll talk about more later. So that means that there's claims to the assets of the company, like cash, for example, and other assets, equipment and whatnot, by third parties like the bank. So it's a flip side of the coin. The assets, what the company has. The liability is who has claim to those assets, not the owner in this case, but the third party. And then we have the equity. Why is the equity on the same side as the liabilities? Because I like equity. Equity is us. Equity is the owners. In a corporation, it would be the stockholders, sole proprietorships. It would be us, the person filling out the tax forms if you're in the United States, right? The owner. So the equity is good. Why is it on the same side as the liabilities? The bank, who have to pay, which we don't typically like having liabilities. We like having equity. So the equity, however, from the standpoint of the company, of the actual business, is basically the same as liabilities. It represents claims to the assets of the company. So it's two sides of the same coin. That's what the accounting equation is. This is what the company has, assets. The company has claims to those assets by either third-party liabilities or the equity, which is us, the owner. That's why this equation works great for data input and converts into, in essence, the basis of the debit and credit system. However, when you're analyzing the accounting system, you often want to get to the bottom line of the balance sheet, which is the equity, which means that the reformulation of this equation would be assets minus liabilities equals equity, just an algebraic adjustment. And that's what often we look at it from the perspective of a finance perspective, because equity becomes, in essence, the net assets, the value, in essence, of the company, at least from a bookkeeping standpoint. All right, so that's one thing that kind of confuses things a little bit when we think about the accounting equation, is that we have the assets on one side, liabilities and equity. People usually get hung up on equity because we like equity, and it's on the same side as the liabilities. And finance people would like to reformat the equation to assets minus liabilities, but that's not in the format that we want to do for data input, because it's not representing the two sides of the coin as this format of the equation basically does. All right, that's the layout. Now, the other problem we have is that we'd like to get more detail about the assets. So if I go over here to the assets, notice we have, at a minimum on the balance sheet, current assets and fixed assets. So now we have this situation of wanting to break out the assets into multiple categories. Now, if we had a debit and credit format, we usually make something called a trial balance, which is in a vertical system. And that's why we only have two columns, which would be basically, debits and then credits in essence, right? And then we have our columns of our trial balance. But when we have the accounting equation, I want to see the equation horizontally, which is another problem from a data input standpoint, because you have to come up with a worksheet that is this long, wide worksheet so we can see the accounting equation. So that's why logistically it's a little bit easier to convert to debits and credits. But here we want to focus in on the accounting equation to get it conceptually this way. All right, so we have current assets, which represent assets that are going to be consumed relatively recently, possibly in another year, cash, accounts receivable, possibly inventory, and then fixed assets, which could be called property, plant, and equipment, PP&E, For example, those are things like property, plant, and equipment that we're going to be using over a long period of time, furniture and equipment, and so on. And then on the liability side, we could have now we could also have other assets as well, but on the liability side, we also have current assets, those assets that are going to be due within a year's time frame. And then we could have long-term assets, such as long-term loans, that we're going to have to pay out past a year. So we want to break those two things out. And then on the equity side, it has its own problem. Now you might be asking, by the way, in this accounting equation, you might be asking like, where's the income statement, right? So the accounting equation is assets equal liabilities plus equity, but that's the balance sheet. That's defined as the balance sheet, one of our major two financial statements, not including the statement of cash flows because it's kind of a rework, in essence, kind of like of the income statement on a cash basis. So we're not going to get into that right now. If you look at the two major financial statements, balance sheet, income statement, the accounting equation is clearly represented by the balance sheet. Where's the income statement? Well, it's part of the equity. That's the other thing that gets a little confusing. This is what often messes people up from the accounting system, whether using debits and credits or the accounting equation. Because really the income statement is taking the equity and breaking it out. And remember, from a financial statement perspective, from a finance perspective, we can rewrite this accounting equation to assets minus liabilities equals equity. Therefore, equity is kind of like, to us, the owner, the book value of the business. That's what the value, the business, the equity in the business, like equity in your home, you might be familiar with that term, is the value of the home minus the amount that you owe the bank for the mortgage. That's what the net value is. Same thing here, assets, what you have minus liabilities is the equity. But that doesn't tell me anything about performance. How did I get to the equity? How did I get to this point in time? That's what the income statement is. So we have to break out the equity, and typically what we do is we say, I'm going to have the balance sheet side of equity, which you might call for a corporation retained earnings, or for a sole proprietorship, owner's equity, or a partnership account, multiple capital accounts, which is actually the most difficult one to kind of keep a handle on because you have to track multiple partners in a different way, even more complex oftentimes than a corporation in many ways. But then we also want to check performance, which is the income statement. So on the income statement, sales, revenue increases equity because that's going to increase the net value to us, and expenses are going to decrease equity because that's going to be a reduction in the net income. So in essence, the income statement is going to break out part of equity, looking at the activity of equity over a certain time frame that we arbitrarily pick, which usually is going to be a month, a quarter, or a year, right? Months, quarters, years. That's what we look at the income statement in. And the net income, the bottom line of the income statement, revenue minus expenses, is part of equity, rolls in or closes out from accounting terminology. It's the closing process. Net income rolling in to the equity is part of equity, rolls into retained earnings for a corporation, or owner's equity if it's a sole proprietorship, or the multiple capital accounts for a partnership. That's often one of the most confusing components, which we'll try to clarify as we go through our practice problem in terms of how that rollover works and how you might see it working in accounting software like a QuickBooks or something like that. All right, so that's going to be the idea. Now over here, we're going to enter our transactions, and then I'm going to enter the transactions into our accounting equation here, and then I'm going to summarize it, and we'll have a summary of it on this side. So within each of these categories, then we have the actual accounts, right? So within current assets, we have cash, undeposited funds, which we'll talk about later, accounts receivable, inventory, fixed assets. We've got furniture and equipment. If there were buildings, it would be buildings and land and whatnot. And then current liabilities, accounts payable, payroll liabilities, payroll taxes. The equity, we have draws, owner's equity, because it's a sole proprietorship. If it was a corporation, they would be called capital accounts, and draws would be dividends. We've got then the income statement, sales, and then all the expenses, cost of goods sold, insurance expense, and so on, expense. All right, so first we're going to practice just starting to make this worksheet, which is just really an exercise in Excel, and we'll try to make it pretty like this, and we'll color code it and all that kind of stuff. If you're into Excel and want to do that, then we'll do the formatting kind of thing. If you're not, you can follow along just with the accounting equation on the second tab, where you're just going to enter the names and you can fast forward through all the formatting stuff. But we're going to practice the formatting on the blank tab. So let's start this thing out. This is just a blank worksheet. If you want to just open a blank worksheet, you can do that. And so what I'm going to do, what I normally do within Excel, is first lay down the foundation formatting, because currently we're on like the general formatting. And so what I'm going to do is select the whole sheet with a triangle. I go to the triangle up top, select the whole sheet, right click on the selected sheet. We want to format the cells. Then I'm going to go to currency, is what I usually like for the baseline formatting that we will be using. I'm going to go to negative numbers being actually not red this time, because we're going to have red color. I'm going to just make it bracketed. I'm going to get rid of the dollar signs, because we don't need dollar signs to clutter up our worksheet. I'm going to remove the decimals, because the decimals are looking a little bit more cluttered. If I want them, I will add them later. And then I'm going to say OK. And then I bold the whole thing, home tab, font group. I'm going to make the whole thing bold. You might not need to do that, because I think it is better to have it bolded when I'm doing a screencast. So you can decide whether or not you want to have it bold, because if you bold everything, then you can't bold any individual thing, right? So I'm just going to bold everything personally. All right, and then I'm going to start with the accounting equation up top, and we'll start with that piece of the worksheet, and then we'll add to that. So the accounting equation is going to be assets, and then I'm going to put an equal here. Now, when I put an equal, I don't want it to, like if I hit the arrow key, it's going to try to do a formula. So right after I hit the equal, I'm going to hit enter so that it doesn't do a formula. Then I'm going to put liabilities. Now, if I misspell anything, I apologize. I'll hopefully go back and spell check it later. And then I'm going to put a plus here. And then again, if I hit the arrows, it's going to try to do a formula. So I just want to hit the plus and then enter so it doesn't do a formula. And then I'm going to put equity. So that's my standard baseline accounting equation. Let's take that whole bit right there. I'm going to center it by going to the home tab alignment. We'll center it. And then I'm going to go into the assets and do my color coding on it. So I want to make the assets green. I think that's an appropriate color. So I'm going to go up top, home tab, font group, color, and then let's just make that, I think this is just like the default green. So I'll make it, yeah, this is the default green. And then liabilities, I'm going to make it the default red. So default red. And then equity, I'm going to make it like the default blue. Equity, default blue, dark blue. Now that's dark. I'm going to make the text white so that I see the contrast. So then I'm going to say, let's pick up this and this. Let's make that black and white. So I'm going to hit this and say, let's make that black and white. And then let's make all of the text white. Go here, font group, make it all white. All right. And then I'll make the B and D. I'm holding down control to select the B, holding down control to select the D, because I want these two to be thinner and have the same width. So I can do that by selecting them at the same time and then make them thinner. And so something like that. Now, if I double click, it gives me just enough room, so I might be able to do it that way. If I want to do it one at a time, like if this one was wider and I want to make it the same width, I can select this one, home tab, and then format paint it, and then format paint it down here. But that, of course, will format paint everything below as well. All right, so that's going to be that. I might make I could double click on this one to make it as small as I can, because this is going to be a really wide worksheet. So that's my baseline form worksheet. Now I want to summarize everything here from the accounting equation, but now I also want to make an extended accounting equation, which is going to have the subcategories, for example, under assets of current assets, fixed assets, and so on under the equity having balance sheet equity versus income statement equity, and have the added accounts so that we can do the data input. So I'm going to make a skinny F over here to do that. I'm going to make a skinny F. And then let's say I'm going to do the assets again, assets. And then under the assets, I'm going to say we have the current assets. And then under the current assets, I'm going to list out the asset accounts that I know we're going to need. Now, I might need to add to these later, but these are the baseline asset accounts that we're going to need. Now, cash is obviously in every kind of business. I'm going to put undeposited funds. Now, this account is there when you're using some software like a QuickBooks software, and sometimes they call it a different name too, so they might change the name, but it's a clearing account. We'll talk about when that might be useful. We'll also hopefully touch in on the idea of when, like, we do work from a textbook standpoint. You often don't see clearing accounts like undeposited funds. You just say, I'm just going to put it into cash. But when you get into practice, due to the fact of having to do bank reconciliations and working with bank feeds, you have to add the added complexity of undeposited funds oftentimes to make sure that the grouping that you put in the bank account matches what's going to be on the bank statement to make it easy to reconcile. So that becomes an issue that we have to deal with. Now, notice that there's an overlap between this one and this one. I'm not going to worry about it right now. I'm just going to type over it, typing accounts receivable. And so I should probably just call it AR so it doesn't take up so much space, but I'll keep it there. And then I'm going to hit tab. So accounts receivable is only an account that we will have if it is a accrual-based system, which we'll talk about more when we get into that transaction. Inventory. Notice that not all companies are going to have inventory. Some are going to be service companies, but we're going to play with inventory in our practice problem to touch in on that issue, remembering that if you're working for somebody, whether or not they have accounts receivable that needs to be tracked and inventory that needs to be tracked are crucial components that you might be able to specialize in or not specialize in. Say, I'm not going to do that because I only want to work with companies that have somewhat of a more basic accounting system. It just depends on your business model. Don't let people distract you from your business model. They're going to say, oh, can't you do this? Can't you take this client on or do that or whatever? Or what you're doing is stupid or whatever. No, you have to restrict people down to your business model, or you're going to get work creep, and you're not going to be able to structure your model because you're listening to people trying to tell you what you should do when they don't know what the heck they're talking about. Okay, stop with the rant. Stop with the rant. I'm just saying. Okay, so then we have fixed assets, which you could call property, plant, and equipment. I added furniture and equipment to that one. And then I call it ACC depre, accumulated depreciation, which is a long word. Therefore, I'm going to abbreviate that one. Okay, so then I'm going to select this whole top bit from here to here. Let's make that green, the same format as this one. I'm going to go Home tab, Font Group, and make it green, and then the text white. And then here, I'm going to make this these ones. I'm also going to make green and white. So I'm going to make this one green and white. But this one is a different category. So I'm going to try to make it a different green, but still make it green. And the default is this green, which is hopefully dark enough that we can still see by I'll make the text white. It's still seeable. Maybe I should keep the text black on that one. That's going to make it more complex, but it's easier to see that way. And let's put some borders around it now. So maybe I'll make this one a little larger, like I'll increase the font size, like maybe there. And then maybe I increase the font size here to like boom, boom. This is at 16. Let's make this like 18. And then 6, and then this is, well, no, let's make this 16, 14, and then 11. All right, that's cool. All right, and then let's put a bracket around this whole thing. So I'm going to go to the Home tab, Font Group, and I want to bracket, not all brackets, but I want to make a thick bracket around the whole thing. So I'll go boom. So it kind of looks like it's all one. And then I'll make a thick bracket around these. So I'll make a thick bracket around that one. And then maybe a thick bracket around this one. And then on these, I want to put thin brackets around them. Let's put thin brackets around those. And then let's center it. And let's also wrap the text. Alignment, wrap the text. So notice what that does is it makes it a lot wider, right? So now what I'd like to do, it makes it a little bit harder for us to know how wide I should make the cell. So I'm going to make the cell as wide enough that one word shows. So that's as wide as I can go without it cutting off a word. Same here. So I'm going to go, that looks right. And then here, I'm going to try to make this, I want to make it 2 lines. And so there it is. Now I can double click here and hopefully it'll close up that space. Didn't close it up all the way, which is kind of annoying. So I could close it up a little bit more manually and say that's about where I want it. Now, if you didn't want to do it, notice it makes this wide cell. You could, if you didn't want to do it that way, you could like put it on 2 different lines so you know where the text is. And I'm actually going to make this bottom bit, let's make this black and white. Let's make this black and white to make it different from the top bit, black and white. So now this is going to be my data input component. And then I'm going to input underneath it here, which I'll also make green. So I'm going to, let's just put some space under here to like, I don't know, 25. And I'm going to make this green and bordered. So it's going to be green, it's going to be white and bordered. So when I start entering text, it's going to be looking like that. All right. And then on this side, I'm going to make this light green. So let's bring this down to 25 so that I can kind of color code this and imagine what's happening in my mind. This is still an asset, but it's light green for the fixed assets, bordered, and then I want to keep it black. So now I have black zeros in there, so it's because they'll stand out a little bit better. Okay, so then let's go, then we're going to say this is going to be equal to the liabilities. So liabilities. Okay, and then I'll make this one, I want to make this maybe the same thinness as this one. So I'm going to select this, Home tab, Format Paint, and Format Paint that right there. Boom. So now I have like the same thinness and it's got that black, which is good. I'll keep that. So now we have liabilities. And then under the liabilities, I'm going to put current liabilities. Liabilities. And then I will have eventually long-term liabilities, but I'm going to get to that later. First of all, we're only going to have current liabilities to start our practice problem with. And then under that, the current liabilities include accounts payable, which will only be there, again, if we're on an accrual system, which is something that you might want to kind of think about. Do you want to deal with clients that have accounts payable or only clients that are on a cash-based system, which you might be able, if using accounting software, used just like a bank feeds system to do. Accounts payable will add complexity. Payroll liability, let's just call it payroll payable. So that's going to be, again, only there if you have payroll, remembering that payroll adds a lot of complexity due to laws and regulations around it, including tax law, which is the thing that will be different from place to place. So the accounting equation, what we're learning here, is universal. It's just kind of like math. But when we get into laws, that'll add complexity because those are going to be different from location to location. Payroll taxes will be different in the United States to other countries. Payroll taxes in the United States will be different from state to state. However, if you use accounting software, most of the software, or good software, hopefully is able to kind of work with the needs of a particular state and so on and so forth. But from a bookkeeping standpoint, same question. Do you want to be taking on clients that have payroll, or don't have payroll? And if you deal with payroll, do you want to handle it, or do you want to try to be on a cash-based system, which payroll will kick you off of in the United States at least, and then work with a CPA firm to kind of shore up the cash flow? So those are questions just to keep in mind. Sales tax payable, which is a usage type of tax. So if you're in the United States, this is a state tax. If you're in other countries, this is a use tax, which is a tax system often used in many parts of the world use a tax system that's going to be basically a sales tax, a usage tax, rather than in the United States, which has the primary federal tax being the income tax. So again, that tax thing will differ depending on location, and your job as a bookkeeper is to say, what location do I want to kind of specialize in, and how do I deal with the complications of the tax code? All right, in that location. So let's go ahead and I'm going to try to copy the formatting on this one, Home tab, font group, and I'll make these the same formatting as that. Boom. So that looks pretty good. And then on the liabilities, I'm going to make that red and white. So I'll go Home tab, font group. Let's make this red and white. And then let's make this one also red and white. And then let's see, maybe I should make it a darker red. That red is quite bright, isn't it? Do I have a darker red in here on the defaults? Let's make it this darker red. That's a little easier on the eyes, maybe. Make it a dark red. Okay, and then what was the size? I made this one 16 and then 14. So let's make this 16 and then this one 14. And then these are what they are, so that looks good. All right, and equity. So I'm going to say plus here, and then enter. So if I hit an arrow, it's going to start doing that. So I'm just going to say plus and then enter. I'm going to format paint that the same format as this one to get the same width, as well as make it black and white. So I'm going to say Home tab, font group, format paint, and then I'm going to say equity. Now I'm going to get back into equity in next time, so we'll continue on, but let's color code it now. So we see it's going to be the dark blue. I'll make it white, and then it's going to be increased to 16. All right, so we'll continue on equity because equity is going to have the accounting equation under it. So we'll continue with that next time. So this is what we have thus far. Next time, what we're going to add is we're going to add the transaction field in front of it, which is usually like, from a trial balance perspective, that would be like where you enter the journal entry. The journal entry will be in form of accounting equation here. And then we'll finish off this bit on this side, and that'll give us our starting off. And then we'll also add maybe accounts receivable and payable subledgers to get an idea of what those will look like, although we might have to adjust them as we do our data input. So we'll continue on with that next time, and then we'll start using this worksheet to practice data input from the perspective of an accounting equation. Accounting equation and Excel. Creating the accounting equation worksheet, part number 2. Get ready and some coffee because we're about to learn the accounting foundation, the accounting equation using Excel. Here we are in Excel. If you don't have access to this workbook, that's okay because we basically built this from a blank worksheet but started in a prior presentation. So if you want to build this entire sheet from a blank sheet, you may want to begin back there. If you do have access to this workbook, there's 3 tabs down below: example, practice, and blank tabs. Example, in essence, the answer key. The practice tab having pre-formatted cells so you can practice the practice problem with less Excel formatting. The blank tab is where we started with a blank sheet and we'll be continuing with the blank part of the sheet this time, practicing our Excel skills and formatting as we move forward. Let's go to the example tab to get an idea of what we will be building. We're going to be constructing a worksheet to construct our accounting practice problem within, building it rather than with the debits and credits with an accounting equation format, remembering there's pros and cons to thinking about accounting from an accounting equation standpoint and from a debit and credit standpoint that we touched on a bit last time. But we have the recap. What I'd like to be able to see is, with every transaction, a recap of the summary of the accounting equation, assets equal liabilities plus equity. And then with every transaction, I want to be able to list out not only assets, liabilities, and equities, but the actual accounts, which will be subcomponents of the assets, which can be further broken into current assets versus fixed assets and possibly even other assets. But we're just going to use these two categories for now. And then the accounts within those categories: cash, undeposited funds, accounts receivable, inventory, furniture and equipment, depreciation. And then with the liabilities, we have the current liabilities and long-term liabilities. We're going to start off with only current liabilities: accounts payable, payroll, sales tax, and then the equity, which can be broken out into the balance sheet equity, which can further be broken out into the entire income statement, which we can think of as, in essence, the timing behind part of the equity statement, which we'll talk more about as we build it. So we have the balance sheet component: owner draws, owner's equity, income statement, which is income and expenses. And then we have our subledgers supporting the accounts receivable and accounts payable accounts, tracking information by who owes us or who we owe the money to, depending on if it's accounts receivable or accounts payable, which will only be there for on an accrual basis, which we'll talk about more as we construct that component. All right, and then we're going to have to go back to the beginning part here and add the bit where we're going to have the actual transactions. All right, the practice tab has some pre-formatted cells, so you can kind of fill in the information as we go if you want to do it that way, just to have a less proactive component. But we're going to be practicing Excel as we are in the blank tab. So we've done the accounting equation kind of overview, and then we did the assets section, and now we're on the liabilities. And I started the liabilities last time with the full liability section here, and then the current liabilities, and then the three accounts within the liabilities. Let's end this off. I'm going to put some brackets around this bit. So I'm going to go to the Home tab and then Font Group drop down, and I'm going to put a thick brackets around those, so it gives that line up. I'll do the same thing here. Let's put some thick brackets around these, and then I'm going to select just our cells for our data input, and I'm going to make those red and white. So I'm going to go to the Home tab, Font Group. Let's make it drop down, and I'll make it a little bit darker red on the default. And then with the drop down on the brackets, we'll make brackets around those. All right. So now we're going to be going to the equity. So within the equity, this is often the most confusing component within equity. And let me just recap this idea. Equity represents the owner's claim to the assets in the business. So remember, if I rewrite this accounting equation as assets minus liabilities, it equals equity, which on a book basis is the value of the company, which doesn't always tie into a market basis because the assets might not be valued at complete market value and the liabilities, right? So, but that's going to be our baseline if I was to sell the company, for example, of what we might start thinking about what the value of it may be, would be the equity side of things. Equity gets confusing for multiple reasons. One is the type of entity that we have. So if you think about equity in general, it doesn't matter what type of entity if you think about it as all one number, meaning I don't care if it's a partnership, a corporation, a sole proprietorship, the equity represents ownership interest. However, if it's a sole proprietorship, it's easy because you only got one person that owns it. Whereas if it's a partnership, you have a situation where who owns what. So assets minus liabilities equals equities. But if you have 5 partners, which partner has which claim, how much claim to the net assets of the company? So to track that, it's actually the most complex, oftentimes, format for tracking equity, even more complex than a corporation oftentimes, because like with the accounts receivable, you've got to track, in essence, an equity account, a capital account per partnership. But you can still think of total equity as you would for sole proprietorship. It's just that you have to further break it down into who owns them. You would think that corporations would be more difficult than a partnership, because corporations are typically what we think of as the big ones, what you would think have the most complexity, but they're actually less complex in many ways. That's what allows them to get bigger, because of less complexity. In other words, instead of breaking out the equity to every owner of the corporation, in this case shareholders, we say, hey, look, we're going to have equal chunks of ownership, kind of like currency, kind of like dollars. They have a fixed unit price already. And then we're going to define who owns what by how many of those fixed amounts they have. How many, in essence, dollars do they have would be the equivalent in this analogy. That means I can just break out the equity into basically a retained earnings account and a capital account, which represents initial owner investment versus the accumulated earnings of the company. So that's one thing that's confusing. But the bottom line is you can think of equity as, no matter what type of entity, the ownership's claim to the entity that we further then need to break out based on partnership, corporation, sole proprietorship. The other thing that's confusing is that the equity representing the book value of the company could be represented on the balance sheet and will be represented on the balance sheet as of a point in time, telling us where we stand as of that point. However, we also want to know how we got there, the story. And so that's kind of like breaking the equity out into the story, the activity, the time frame component, which is the income statement, and that's where the revenue and expenses come in. So when we report equity, we could report it shorthand or in a condensed format on the balance sheet, which has condensed all the time frame of income statement into one number, equity. Or we could say this is equity before that time frame. This is equity before last year, and the income statement is now breaking out in more detail the activity statement, income statement, which is also part of equity. That's what happens on like a trial balance. So we'll see more of that as we go through, but that means that we have basically a balance sheet component. So I'll say balance sheet, and I'm going to make this blue and the same color blue, home tab font group. Let's make this dark blue and then white. So we have that bit, and the two names accounts we're going to put under here is owner draws. Now the draws represent the owner draws for sole proprietorship, which we're thinking in terms of. If it was a corporation, you could basically think of draws as equivalent to dividends. The difference between draws and dividends, by the way, is that in a corporation, it's the management or the board of directors and management that are going to be determining how much money is going to be given out in terms of dividends. That becomes kind of an issue for the owners. They don't have control, in essence, over how much is going to come out unless they have ownership interest, 51% or whatever of the corporation. Whereas in a sole proprietorship or a partnership, the owners, partners, or sole proprietor have the ability to take out whatever they want because they're the owners of the company. So that's kind of like the difference there. And then we've got owner's equity. Now you might call this capital account as well, which would be called for a partnership. So this is going to be the equity interest in the business, which if it was a corporation would be called retained earnings. That's the account that the net income from the income statement closes out into. Now in a corporation, you have the owner's equity would be equivalent to retained earnings, and then you might have another account called the capital account, representing the investment from the owners into the company. Okay, so then so that's that. So let's go ahead and then keep on. Let's format like this. I'm going to go home tab, clipboard, paintbrush, and let's do the same formatting for the accounts. So there are those. All right, and so then we're going to have an income statement. You might also see it called a profit and loss statement in some software, such as QuickBooks. Defaults to profit and loss, basically the same thing. The timing statement, which in essence is part of equity, even though it's represented in a completely different statement, the income statement. It's breaking out part of the equity that would be on the balance sheet. And if we represent everything under one rubric of the accounting equation, the income statement is going to be part of, in essence, the equity account, meaning we're going to break out part of the equity. Okay, so we're going to go to the Home tab, font group. Let's make this one like lighter blue, maybe this blue and white. So there we have that. That looks good. Okay, and then I want the name. I want it to be how big? 11. Is that what we had over here? We want it 14. Let's bring it up to 14, and we'll bring this up to 14. And this one should be at 16. Let's bring that up to 16. And these are at 11. Okay. And then on the income statement, we have sales, which you might call revenue, or you might call income, noting that the difference in those names are usually dependent upon the type of industry that we are in. If we are a selling inventory, we typically will call it sales oftentimes. If we're selling services, we might call it revenue or income. Income's kind of a generic term that we might use instead of revenue. So cost of goods sold, which I'm going to abbreviate as COGS, cost of goods sold, which would only be an account, which is in essence an expense account, but the most important expense account if all we sell is inventory, because the largest expense that we will have if we sell inventory is the cost of the inventory. It also has an accrual component that we might have to deal with as well. So we'll talk about that. Remembering that if you're doing bookkeeping for someone, you want to keep in mind, do I want to deal with inventory? And if so, what kind of companies do I want to pick up in order to deal with inventory? And or do I not want to deal with some complex components of inventory and make sure that you weed out those kind of businesses? Remember, and I have to put this out because this is the problem I had a lot of times running a business, and that is trying to see which clients I want in my business model, and then going after those clients aggressively, while also not going after and being able to say no, which is was hard for me, to clients that don't fit your business model. Because even if you can do those, they're going to take more time because they don't fit the system that you've set up to do efficiently. So that's really important on the bookkeeping side. What exactly are you trying to do? Where are you trying to specialize? And then stick to that and don't let people, convince you otherwise. So then we have insurance expense. I'll just put EX for expense. So that's going to be typical for most businesses, which will have usually at least liability insurance and that will be involved. You have to be careful with other types of insurances, like life insurance, for example, or car insurance. Is that going to be included? Because you're going to have other car payments for the car. It might be personal and business for taxes and so on and so forth in the United States. So there's miscellaneous expense that we'll add. And so you got to be careful with miscellaneous. You don't want to dump it. That shouldn't be a dumping ground. We'll talk about that later. Office supplies. So we'll call it office supplies expense, which is also kind of a confusing one, because if you have office supplies, the question is, how valuable are those office supplies? Are they subject to shrinkage and whatnot? Should you be tracking office supplies like inventory or not? And so we'll talk more about that. Payroll expense, remembering that payroll is something that often has added problems along with it, because it's going to be subject to more laws and regulations. And therefore, although most accounting, double entry accounting system, in other words, is the same anywhere, it's like math, the regulations will make things different, usually the tax regulations that come along with things such as payroll. So we'll be looking at it from the standpoint of U.S. payroll taxes, but you're going to have different laws. That's another area you want to specialize in. Do I want to deal with payroll? Which payroll do I want to deal with? Do I want to specialize in payroll in a specific location? If I don't want to do payroll, do I get companies that don't have payroll and that's who I go after? Or do I try to come up with a networking system with other payroll companies so that I can do what I do and they do what they do and we work together? We have telephone expense. So that's pretty clearly on most businesses. And then utilities. Now, utilities is an interesting one because it used to be that like the telephone, the trash, the electric, the gas was all under utilities. But now the telephone is often broken out in and of itself, and you might break out other things like electricity if they were important in and of themselves. And so you always have this interplay between how specific do you want to get. So we'll talk more about that as we go. But this just gives us a quick list of income statement items where we'd have income minus expenses giving us the net income. The net income is what rolls in or is part of the equity that's typically reported on the balance sheet under one number, which is included in equity. Notice that if I look at this income statement and it comes out to net income, revenue minus expenses, then the equity over here, I'm going to have to start with equity before that, right? So if this was what happened in a year, the equity over here has got to be the equity from before that year, which I'm then adding the net income to get to current equity as of the current point in time, which would typically be reported on the income statement. That's the closing process that we'll get into as we work the practice problem. All right, let's select this one again. Format, paint that. We'll put that across here. And so then I can maybe do some formatting here. Maybe I select like, maybe I can make these like a little shorter. This one needs to be long enough to put the balance sheet in. So maybe right there. This one I can make a little bit smaller. This one I can make a little bit smaller. This one needs to be a little larger to get the insurance in. This one I can make smaller because it's miscellaneous. This one is about as wide as it can go. And this one needs to be a little bit larger to get the telephone in there, if I spelled it right at least. And then utilities maybe a little smaller. All right, let's do some formatting here. So I'm going to format this all the way across with the blue and white. Blue, or let's make dark blue and white. So that's all equity. And then this is going to be all the way across the light blue. Boom, light blue or lighter blue and white. Okay. And then let's put some boxes around it. So I'm going to select this whole thing. Home tab, font group. I'll put a bold border, thick border. I'll put a thick border around this. And then I'll put a thick border around this. Okay, that looks nice, doesn't it? Is it that nice? Let's then select all of this and go down. Oh no, que paso there. That's too far. You have gone too far this time. Well, that's okay. I'll stop. This time you have gone too far. We're going to go, oh, wait a sec. I need different colors. I'm going to make this dark blue over here. Go home tab, font group, make this one dark blue, and then borders around it. I'll make the text white. So when I go in here, it'll be a dark blue with white text. All right, and then down here, we'll make the lighter blue because this is the income statement accounts. So I'll make this light blue, or lighter blue at least, bordered and white. So this will look like that on there. Okay, that looks good. All right, all right. I think this looks excellent. Okay, so then let's copy this down. I'm going to copy this equal sign. Let's copy that all the way down. So I've got the equal sign all the way down. And then this has the plus. I'll copy that, Control C, and I'll paste that all the way down. Boom. And then let's do this. And then that's that. Okay. Okay. That's looking snazzy. All right, let's put our subledger. Now I might have to adjust the subledger on the end, but the point of the subledger is that accounts receivable over here, I'm gonna need to track not only who owes me that money, not only that we are owed that money, but who owes us the money, which I cannot track in just one account. So notice I would only have the subledger if we had an accrual account, because accounts receivable is an accrual account, which means we do work before we get paid and therefore have to collect on it and therefore need to track who owes us the money so we can make sure that we're going after that money and collecting it. So to do that, we typically need a sub-ledger over here. So I'm going to make a skinny AB. And so we might have to adjust this later, but I'm going to just start out and just to remind myself. So account, let's just call it account receivable, and I'll say subsidiary ledger. Now, subsidiary ledger is what you'll hear in accounting textbooks. Might not be exactly what they call it like in accounting software, because they'll just say this is the AR report or something like that. But it's a sub-ledger because it's going to add up to the same balance as the accounts receivable general ledger or account on the balance sheet or trial balance or accounting equation, but it'll break it out in a different format, giving us different detail, in this case, by who owes us the money. All right, let's select this. Let's make this centered alignment. Let's center it. Whoa, that's not cool. That's not right. Let's not center it. I could center it across there, but I'm not going to do that. Instead, let's go to the drop down and make this green. I think I made it dark green, right? And white. That's the same green, isn't it? And then I'm just going to put on this tab total. I'll put the total over here, and I'm going to put the list. I'm going to put vertically who owes us the money, the customers on this side. I'm going to make this our black band so it matches. So I'm trying to line it up so it matches nicely. And then let's put our border around here, font group, drop down. Let's put a border around this. That looks nice. And then I'll just make this green for now. So I'm going to make it green, white, all bordered. All right. And so then we'll do the same thing for the accounts payable. So I'll select this drop down to make another skinny on the AE, home tab, format paint, AE skinny. We'll call this accounts payable. And then I'll just say this equals the same name, subsidiary ledger. So the accounts payable, less common for small businesses to have an accounts payable because they might just be paying things as they become due with cash or possibly credit card. But as companies get larger, then it's likely that you're going to spend more time tracking your bills to pay them as late as possible because the time value of money becomes more important as the number of transactions come up. So if you can hold on to your money like a few days longer and pay it later over many transactions, that becomes a benefit, right? Not so much a benefit for if you don't have that many transactions. In other words, if you were to say your credit card bill or your utility bill came today, but it's not due to be paid until 15 days from now. Does it make a difference if I pay it today or 15 days from now? Not really, because it doesn't really matter. But if I had 1,000 transactions of the size of that utility bill, or transactions that were a lot larger in dollar amount because of inflation, it does start to make a difference, a big difference over time, to pay them 15 days later, if at all possible. Okay, so that's why small businesses are probably like, I'm not really worried about it. If I got the cash flow, I'm going to pay it because I'd rather, that's the easiest thing to do. I don't want to get any late fees or anything. Larger businesses are, okay, so that's why we have the same thing. We have to track who we owe the money to if we're going to be tracking the accounts payable and not simply paying the bills as we get the bills. So let's go to the Home tab, font group. Let's make this red and white, and then I'll put a border around this, and I'll do the same thing. This is going to be the total, and I'll make this, let's make this formatted black. Home tab, format paint, we'll make that black. And then we'll select all of this down to here. And we're going to go Home tab, font group. We'll make this red and bordered. Okay, let's go back to the left. All right, let's make this, I think these skinnies can be a little skinnier. I'm gonna hold down Control, and I'm gonna choose all of these skinnies. So see, I've got the 3 skinnies selected, and I'll make them the same width by just adjusting the width on this one a little bit. And now all the skinnies are the same. making it look a little bit more cohesive. All right, so that's nice. So now let's go back to the front, and I need to put where like my data input would typically go. So I need to put that in front here. So I have to shift this whole thing to the right. So the way to shift things to the right is to just select the entire column. And if I add something with the entire column selected, QuickBooks always enters it to the left, because that makes sense, because that allows us to enter something to the left. Whereas if it went the other way, I wouldn't be able to enter something to the left of it. So I'm going to say, I want to have like, how many? 1, 2, 3, like 4 columns. So I'm going to go 1, 2, 3, 4, selecting at the top all the way up here. So the whole column is selected, so that when I right click on it, I want to insert. It knows that I don't want to insert cells, because I can't insert cells because I have the entire column selected. The only option is to insert columns to the left. So it should insert 4 columns to the left. Boom. All right, and then I'm just going to put date. So that's going to be our date field, and then I'm going to put transaction. This will be like the description. Maybe say description. And then I'll make this a little bit larger. And then this is going to be the amount. So that'll be the amount. And then I'll make a skinny on the D. So I'm going to make this skinny J. Home tab, clipboard, take that. We'll put it on the D, making a skinny. And then I'm going to select this whole thing, make it black and white, maybe the same format as this one. So I'll go here and go format paint and make that the same format here. So that's at 11:11, so that looks good. But I'll make the date, I like to have it formatted on the left. And maybe this one also, I'll left align it. Okay. And then when we enter the date, I want to make it like a generic problem without the year, but I have to enter a date. So like if I just do this and I start entering a date, then it's not going to format as a date because it's in number formatting. So I'm going to select this entire column. Now there's a couple ways you could select the entire column and select here and say, I want to go to like a short date, but then like it gives you the year, and I don't want the year. So I could say, okay, if I don't want the year, select the whole thing because I want to make it generic. I'm going to right click and format. And then I want to say that it's going to be date field. So I'm in the number date. And then I have this one, which I think is there by default. If it's not there by default, you can customize it and then make one that's going to be what you want it to be is month and then year, right? That's what month and then year. So you can kind of create one if you need to, but I think they have one now. They didn't used to, or maybe I made it, but I have the one here that gives me the month the month slash day. I don't want the year, month slash day. So over here, it would be like M/Y, right? Something like that. I haven't made a new one for a long time, so I can't really remember. But in any case, or else you can just add the year and that's fine. But I'm going to pick that one. And so now if I entered 115, it just gives me the 115. It's still putting a year. You can see up top in the formula bar, 2024. But I'm only showing the 115 so I can make this kind of a generic worksheet that will hopefully last for all time into the future. And people won't be like, that's old, dude. That's like way old. And then they won't want to watch it because it's old. So I'm going to select all this. And then this time I like to make this my data input field just a standard blue. So I'm going to right click, and this is just my preference. So you can pick whatever color you want, but this is what I typically pick. And then I'm going to go into, actually, wait, let's do it over here. Home tab, font group, drop down. This is the blue. If you don't have that, go into more colors. And then I go to this side, standard color wheel, and I always pick, here's the middle. It's the one just off to the left above it. Why do I pick that one? That's what the Excel is Fun guy used to use before he switched to the green. I don't really like the green as much because it reminds me of the dark times before Excel. We had to write things down and stuff, and my handwriting's terrible. So I like the nice blue. It's nice, calm blue ocean. And then I like to add some borders. Home tab font group. We'll put some borders around it. So there we have it. All right, so that's going to be it. And then this side, didn't I change? I need to change this side. Control Shift down. Well, I'll select the whole thing. Let's just select the whole thing. Format, cells. I want to make it currency. Maybe negative numbers bracketed for this one. And no $sign. No decimals. I'll add decimals if needed. Okay. So when I put a number in here, boom, negative number, boom, turns it red. All right, lastly, let's also just copy the format down here because I'm going to have my information on this side, which I want to sum up on this side. So I'm going to put some borders around this. So I'll put a dark border around this, around this, around this, and then I'll add another green space. Let's just do this. I'll copy this whole thing, copy the formatting, and I'll paste it right there. And I'll just keep it the same because that lines up to this area. And then I'm going to format paint this to be right here. So, and then maybe I copy these, copy this to here, copy this to here, and then here, and copy this to here. And then below that, I'm going to put my green. So I'm going to make this the green. And so I'm going to go Home tab, drop down. We'll make that dark green and bordered. And then this one, I'm going to make that my red and border. So Home tab font group, dark red. Wait, that's not dark. Dark red and bordered. And then this one, I'm going to make that dark blue and bordered. And then I'll copy this, Control C. We'll put that here. We'll copy this, and we'll put that here. All right. So that's going to be our general formatting. I'm going to move this down, this description. I'm going to copy that and put it down here. Delete it from up top, and I'll make this whole thing black. So let's make this just black and white. So that because this is where the actual data input is happening down here. Maybe I should do the same thing here too. I'm gonna copy this and put it here, and then delete this up top. Because so then I'm putting it down here. So now what I'm trying to do is say this is where the description is going to be for what we do, the transaction description, and then we'll enter the description over here in accounting equation format on the same line, which will then be summarized back over here in the accounting equation. So everything will be on the same line, hopefully, is the idea as we go forward. So that's going to be the idea. All right, let's spell check it. Spell checky. Balance. That's not how you spell balance, idiot. Furniture. Furniture. That one, I'm going to ignore that one. Ignore all. Telephone. Telefine. Crying out loud. You're fired for spelling wrong. But no, I have spell check. So I could just fix it. All right, so I think that's our general setup. We might adjust this as we go going forward, but that'll be our general kind of setup, and then we'll enter our transactions and look at the impact of each of them from the accounting equation perspective. Accounting equation and Excel bill form transactions. In other words, purchases on account, purchases with no cash. Get ready and some coffee because we're going to learn the accounting foundations with the accounting equation in Excel. Here we are in Excel. If you don't have access to this workbook, that's okay because we basically built this from a blank worksheet but started in a prior presentation. So if you want to build this entire worksheet from a blank sheet, you might want to begin back there or you could just construct your own worksheet as we go from this point, or possibly just use good old paper and pencil following along as we work through the practice problem. If you do have access to this workbook though, 3 tabs down below. Example, practice, blank. Example, in essence, the answer key, the practice tab having pre-formatted cells so you can practice the practice problem with less Excel formatting. The blank tab is where we started with a blank worksheet, now basically having our template so that we could do data input into that template, possibly changing the worksheet as needed as we go. Let's go to the example tab to get an idea of what we will be doing, looking at transactions related to the entering of a bill. Remembering that when we think of a bill, there's a couple different ways we can visualize what a bill means. And it's very important for us to see the context of the words that we're going to be using so we can define them and then take action upon those definitions, which is a big problem, I think, in a lot of areas these days. The language is getting kind of confusing, so people don't know what each other are talking about. And that can happen in the accounting world, because whenever we think about a transaction, there are 2 sides of the transaction. And from a practice standpoint, it's useful sometimes for us to visualize both sides of the transaction. What would the transaction look, in other words, if I was on the other side of the table versus my side of the table? And that gives us a better insight of how the accounting system is working. So when I say bill form here, I'm going to say what might be said in an accounting textbook with text is that we make purchases on account. In other words, we make purchases where we're not paying cash for the purchases. The form related to a cash purchase being a check type of form. The form related to purchases on account being a bill type of form. However, in normal everyday language, you might use a bill if you receive a bill or when you bill the client. When we bill the client, we're saying, hey, we did work or we provided you with goods or services, and we're sending you the bill to pay us for the work that we did. So note, in that situation, oftentimes accounting software will distinguish by saying, when I send something out, I'm going to call that an invoice. And when I receive something that I need to pay, I'm going to enter a bill. But note that if I receive a bill, it might say invoice on it, because if I'm thinking of myself from the other side of the table, they sent out an invoice, right? They sent out an invoice and I'm seeing it as a bill. So the fact that the thing that I'm paying says invoice on it doesn't mean it's not a bill from the standpoint of us entering it into the system, because if I was to enter it into the system of like a QuickBooks software, for example, they often use the terminology of bill to be even more stringent than we might use in normal everyday accounting parlance, which is not stringent enough and can lead to confusing. So we're going to say the bill form represents the data input for work that was done for us, that we have to basically pay for, that we're not paying cash for. We're making the purchase of goods and services or services on account. So we're going to do our data input over here. This would be like kind of like the general journal, the journal entries that we would put in place if we were thinking about this in terms of debits and credits. But here we're thinking about it in terms of the accounting equation. So if you look at it from a practice problem standpoint, this would be like the data saying, we bought inventory on account. We bought, we paid the utility bill on account, and so on and so forth. And then when we enter that into our system over here, that will be like us entering the bill, which in accounting software might be in the format of a bill form, meaning it'll say bill on the top of it. But from our perspective, it's just a data input form. What we're going to do is enter the actual transaction, not in the form of journal entries, but in terms of the accounting equation, to see the actual accounts that are impacted when we enter a bill form. So we'll enter it here, and then we'll have to sum it up. Now, this is actually decent practice just for data input and basically using your 10 key. I highly recommend having a keyboard with a 10 key on it, meaning all the numbers like in a calculator format. Otherwise, it's quite painful to be an accountant unless you're really good at using the numbers up top. But most of us aren't, because we're used to the 10 key, or at least in my experience. So that's going to be the idea. Now, we have this tab, so it has some pre-formatted cells. So if you just want to do the data input and enter over here, you can. The blank tab is very similar because we already set up our Excel worksheet, but we're going to have a little bit of formatting that we'll do as we go. All right, so the first one, I'm just gonna put the date. I'm just gonna make up a date here because we're just really focusing in on general forms right now. In the future with this, we're gonna do a whole problem so that we can hopefully do like a month or two's worth of data input and see the impact of it. Right now, we just wanna drill down on individual forms and look at what they will do from an accounting equation standpoint. So let's first start with we invest cash because I don't have any money in the system. So I'm going to say that $50,000 is going in the business from the owner just to put some cash on the books. This would be a transaction that usually happens, right off the bat at the beginning because any new business usually needs some kind of cash to get off the ground. Some more than others. If you start a YouTube business or something like that, you want to make money making content or something, usually the cash investment is a lot less. You might need a camera or something, right? You might even do it with your phone or something. So there might not be a big cash investment. If you're going to invest in lawn care or something like landscaping, then you're going to need some equipment. You're going to need a truck. You're going to need tools and whatnot. So there's going to be a larger investment. Where does that money come from? Either the owner takes it out of personal money, puts it into the business, or it comes from a loan that you take out to get the initial investment. All right, so we're going to say it came from the owner. So what happens from the accounting equation standpoint? There's always going to be two sides of the accounting equation. So the accounting equation is assets, liabilities, and equity. So you could think about it in terms of the equation up top possibly, and then get into detail about the actual accounts within the equation. Let's think about it that way. We could say, okay, if this should be invest cash, not cast. Assets are going to go up because cash is going to go up. Now, the way I would think about this is I would systematically think about is cash affected? In this case, and then if cash is affected, which way is it going? So in this case, cash is affected because the owner is investing cash. So cash is an asset. So, and it's probably the first thing we think of when we think of assets is like cash, right? So cash is going to go up. So assets are going to go up. Now, you might think, well, cash is going down from the owner's account, right? From the owner. That's true, but we're looking at the business side of things. The owner is kind of like the other side of the table because we think of the business as being separate from the owner, at least from the perspective of bookkeeping, even if it's not a separate legal entity. So then the other side is going to be, what is the other side? Well, is it liability? No, because we don't owe a third party. We do owe somebody, though. We owe the owner, equity. So the other side is equity. So the balance sheet's going to be representing its own entity. It's separate from the owner, even though the owner might completely own it because we're talking about sole proprietorship. The business has $50,000. It must owe that entire $50,000 to someone because the business is not actually sentient. It's not a human being. It's just a holding account. So that asset has to be applied to somebody, either the bank, the third party, but we didn't get a loan. It didn't go to the bank. It's going into equity. It's owed to us, the owner. So now let's enter that into our larger equation. So under assets, we have cash, undeposited funds, accounts receivable. We're going to cash. I'm going to say this equals with an equal sign using the left arrows. I'm just going to go over there to the 50,000 instead of typing it in because this gives me a little bit more tying everything together, right? If I typed it in, I can't do something like this, go into like the formulas tab and like tracing it. So see, I want to be able to trace everything. If something's out of balance, I want to be able to find where it's out of balance. All right. So then the other side is going to go into equity. So equity, then the question is, well, what account in equity should it be? It's not going to be an income statement account because we didn't earn any income. It's got to go directly into an owner account. And if it's a sole proprietorship, we call that owner's equity. If it was a partnership, we'd have to put it into one of the individual partners, whoever invested the cash. And if it was a corporation, then the investment of cash is in the form of the purchase of the issuance of stock, right? Meaning the owner purchases stock from, in essence, the company, which is a little confusing because when we purchase stock, normally we don't purchase it from the company, we purchase it on a stock exchange from other people. But the initial offering is how the money gets into the business, the initial investment of the stock issuance. So we're going to say that's going to be 50,000. So notice two sides of the equation went up. So the assets equalize. So if I pull that over here, let's pull that into our accounting equation. So I'm going to do it like this, equals the sum of all of the assets. I'm holding down shift and I'm going to the right. So I'm having the sum of all of the assets comes out to 50,000, and then I'll do the same for the liabilities, equals the sum. This is the most used formula, the sum formula, equals the sum of all the liabilities. There's nothing there, but I'm going to use the formula because I want everything to be consistent so that if there was something there, it would pick it up. And so then I'm going to do the same thing for the equity, equals the sum of the equity. And this is going to include the entire income statement. So draws owner's equity and the entire income statement, income and expenses, and enter. Boom. Now I'm going to make these white, the text, because that'll stand out better. I didn't do that last time. Home tabs. I'm just going to touch up the worksheet as we go. Font group and put some, oh, not that. The text only, man. All right, so there we have it. So then what I like to do then is on all other accounts, I'm going to input a 0, which is tedious to do, but I think it's useful to do because it'll allow us to see the differentiation when we go from transaction to transaction. And it also is helpful just for data input. So I'm going to do it like this. I'm going to put a 0 tab, 0 tab, 0 tab, 0 tab, 0 tab, tab, 0 tab, 0 tab, 0 tab, tab, 0 tab, tab, 0 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 tab. Now you could copy and paste it, but I think just tabbing through it is actually fairly easy, and it's actually a good exercise to do because when you do data input in, say, a database, tabbing through the database is a common way to move through it more quickly. All right, so then let's go to the next one, and let's say that we have on 1/15. This is going to be the first actual transaction that will be a bill. Let's say we have utility bill, and let's say it was $500. Now, normally, it used to be we would get the bill in the mail, and the bill might say invoice on it because when the utility company sent it out, it was an invoice to them, or it might say bill, we don't, whatever. To us, from a data input standpoint, it's a bill because the bill form means to us that the accounts receivable is going to go up. We haven't yet paid it. Now, if we took that bill and we just paid it, then even though I still see it as a bill that I got from the utility company, even if the form actually says invoice on it, but I don't enter it into the system as a bill, I would enter it into the system from a form standpoint as a check, because I would just pay it with cash. I would just pay it off with a check. So even though it's a bill from a normal accounting, like a normal language standpoint, it's not a data input bill unless I'm entering it into the system because I'm not yet paying it and I want to increase accounts payable. So from a data input perspective only, bill input form means accounts payable is going up. All right, so I'm going to say, so let's go over here and say, okay, accounts payable is going up. So I should make all of these white too. I'm going to select all of these and make them white. So let's go to the accounts payable right here and say that equals, and I'm just going to say the 500. Boom. And by the way, accounts payable is a liability. So if I should go through this part first. So let me go through my routine. Is cash affected if we're going to enter a bill on account? No, it's not affected because it's going to be a bill. Then what are we getting? What are we purchasing? Well, we're purchasing utilities, or we're paying for the utilities that we already consumed. And the utilities, what kind of account is it? Well, it's not an asset because we already consumed it. Therefore, it's going to be an expense in the equity section. So that means that we're going to have the liability is going to go up with accounts payable, and the other side is going to be in equity, which is a expense account. The expense goes up, but the total equity goes down. So let me show you what that looks like. So we got the accounts payable goes up, and it's now we're on the same side of the equal sign. The other side is equity. So if I'm going to remain in balance, if this went up, the equity must go down in order to remain in balance. So this gets a little confusing because we're on the income statement. So remember, if I reported this on the balance sheet, it would simply go into balance sheet equity. But when I break out the income statement, I'm going to keep the equity at its prior point, or investments, and draws or dividends, and its prior point, and then I'm going to record the revenue and expenses in the income statement. Now, when I think about debits and credits, I'm going to say that sales goes up with a credit, and the expenses go up with a debit. In other words, we only think about these accounts really going up, right? Expense accounts go up in the debit direction, and then we take sales minus the expenses. But when we look at it from the standpoint of total equity, expenses are going to decrease total equity, right? Because they're going to decrease net income, which decreases total equity. So I'm going to go over here to utilities. I'm going to put negative of, I'm going to all the way to the left, that 500. So that should put us in balance because that's going to bring down the total equity. All right, so then if I go back on over here, I'm just going to copy this formula down, copy it down, put my cursor on the fill handle, copy it down, 0 cash impact, and then 500 increase to liabilities, that's the accounts payable, copy this down, a negative 500 to equity. Now what I'd also like to do is put a little check figure over here to say, how can I check to make sure this thing's in balance? I can see it's in balance, 50,000, these two add up to 50,000, and then this adds up to 0 on this side, but I'd like to do a little check figure. So what I'm going to do is I'm going to put my cursor on J, and I'm going to add another cell, right click or column, and insert another column. And then I'm going to format that over here to get rid of the formatting. And then I'll make it a little bit larger. And what I'd like to do is a little formula, which is going to be equals the 500 minus, I'm going to put brackets around it, this liabilities plus the 50,000. That should come out to 0 if this equation works, because it's the one side minus the other side should come out to 0. I need brackets around it because of order of operations. So 50,000 minus this plus this will be 0. Boom. So then I'd like it to be green. I'm going to do some conditional formatting. I want it to be green if I'm okay. I want it to be red if this is not 0. So let's do a conditional formatting. I'm going to go up to conditional formatting and say I want to say if it is between, let's go between, and I'm going to give it a little bit of clearance because I might remove the decimals. So if I remove the decimals, it might be off by rounding by like a couple dollars. So I'm going to say that's okay. I'm going to say, let's go from -2 to 2. So if it's in the range, not just of 0, but like -2 to 2, I'm going to say that's close enough for our practice problem purposes. And if that happens, I want it to be green. Okay, and then if it goes above that, I want it to turn red. So I'm going to do, or below that. So I'm going to do a conditional formatting. If it goes above, let's say 2, then I want it to turn red. Okay, and then conditional formatting. If it goes below -2, then I want it to turn red. Okay, let's test it out. Let's say it's -3, turns red. +3, turns red. Cool. So let's go back, undo, undo. So that looks good. Let's copy this down. I'm going to put my cursor on the fill handle, copy that all the way down, man. So there we have it. So now we've got that check figure. Let's go to the home tab, font group. Let's put some borders around it. Okay, so there we have that. All right, so then we're going to put the balance. So what I'm going to do now is I'm going to enter my zeros again. So with this last one, I'm just going to put there was nothing to cash, tab, 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 0 tab, 0 tab, 0 tab, 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 0 tab, 0 tab, tab, 0 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 tab, and there we have it. Now the reason that's useful is that I can then select all of these zeros, and I'm going to put an underline, home tab, font group, underline, and it wouldn't have anything to underline if there wasn't a zero. So I need the underline, I need the zeros. So I'm going to go here and put an underline, and then I'll go here and put an underline. So notice every transaction is going to be in balance, and then the total should remain in balance. So this is where we were last time with the first transaction, plus what we did this time is going to give us the new balance as of 115, right? So I'm going to do this. I'm going to say equals the sum of these two. So cash is at 50,000. I'm going to copy that, right click, copy. I'm going to paste it, but I can't paste it like just normal because it messes up the formatting. I want to paste it just the formulas so it doesn't turn all the cells green. So just the formulas, and then I can go here and say I want to paste just the formulas, and then I'm going to go here and say I want to paste just the formula. Oh no, undo, Control Z, paste just the formulas. You know what I was trying to do, Excel. So now we've got 50,000 cash. We've got accounts payable is still at 500. We've got the equity is at 50,000, and we have the 500, which means that total equity is actually our 50,000 minus 500, which is 49,500 down here in the sum area, right? 49,500. Okay, so that makes sense. Now, just remember that on the balance sheet, if I was to make a balance sheet report, it will group all of this together and report 49,500, and then it will have the income statement breaking out the fact that I have a 500, in this case, net loss so far in cash, and then the statement of equity or retained earnings will show the difference, meaning there was our starting point, we entered 50,000 of cash, and then we had net income showing us the difference from one period to the other. Okay, so then let's go back on over and say, all right, let me copy this down. I'll just copy this formula. So there's the 50,000 cash. There's the 500. We're out of balance, but if I copy this down, that should put us back in balance, man. Boom. All right, back in balance. All right, let's do the next one. Let's say that on that was the utility. I should have done investment utility. Let's do 120. Purchase furniture on account. Let's say I'll make this a little bit larger so that'll fit. Purchase furniture on account, and let's say it was $5,000. All right, so what's the impact on our accounting equation? Is cash affected? No, because we purchased it on account. Therefore, instead of the asset going down, the liability is going to go up. So we know that liabilities are going to go up. What about the other side? Wouldn't it be equity again as some kind of expense? That would seem reasonable, but this time we're purchasing a large item of furniture, and therefore we might have to put it on the books as an asset and depreciate it, because from an accrual standpoint, the theory is that we haven't yet consumed it in order to generate revenue. Now you might say, hey, look, I'm on a cash-based system. Note that even if you're on a cash-based system, a lot of times you'll be forced to do an accrual thing sometimes when it is so extreme of a difference in terms of when you consumed something versus when you purchased it that it doesn't make any sense to stay in a cash system. So in other words, from an extreme example standpoint of this, if you purchased a $100,000 building, even if you paid cash for it, you wouldn't just expense it, right? You'd put it on the books as an asset. Because the idea is, well, that would be ridiculous for me to have a $100,000 expense when the building is going to be used for like 30 years into the future. And therefore, from a matching standpoint, I should be matching up the asset. So the same thing will be true here. Now, you might say, well, the furniture is not that big of a purchase, so it shouldn't be big enough. Well, the other thing is if you do taxes in the United States, for example, income taxes, the tax code will force you to put it on the books as an asset sometimes. So you're going to have to follow at least those rules. Now, you still might get a write-off like a 179 or special depreciation, but it's still going to force you to kind of do that. So from a bookkeeping standpoint, we're going to have to keep that in mind. We're going to have to say, okay, these large purchases, I need to identify them. There shouldn't be as many of them, but I need to locate them and then therefore not put it on the books as an expense, but as an asset. And then we'll have to deal with depreciation, which we'll talk about in the adjusting entry process. So in this, we're going to say, once again, the liabilities are going to go up with the accounts payable. Accounts payable equals the 5,000. And then we're going to say the other side isn't going into equity, but it's going into a furniture and equipment, which is an asset, not a current asset though, a fixed asset, because it's possibly not going to be consumed within like a year. So I'm going to say this equals then the 5,000. Boom. Let's copy these down. So now the assets have gone up by 5,000. The liabilities are going up by 5,000 and no impact on equity. So also just realize the accounting equation, when I look at it, I could now think about the value of the company by taking the assets minus liabilities would equal the equity, right? So 50,000 minus 500 equals the 49,500, which in theory would be the value of the company if you liquidated it or closed up shop, right? Because you'd have to pay off the liability and then you'd have equity left of 49,500, which hopefully is cash that you could take out of the business. That's why equity is kind of like the book value of the business. All right, so we have the 5,000 here. Let's put in our zeros. I'm just going to say 0 tab 0 0 0 0 0 tab 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 0 tab 0 tab 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 0 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 tab and 0 tab. Let's put our underlines. I'm going to put my underlines here. Home tab, font group, underline, underlines here, underline, and then underlines here, underline. Okay. Then we're going to say, let's bring down our balance, which is going to be, let's sum this up. So this is where we were on the last balance right here. So now I'm just going to say this is where I was plus this is going to bring me to my new balance. So I'm going to say this equals the sum, not of the whole thing, but just of the last balance plus the current transaction. Keeps us at 50,000 here. I'm going to copy that, right click or Control C, pasting it, not normal, but formulas only. So it doesn't paste the formatting. So we'll paste that, right click, paste formulas, and then paste formulas, just the formulae. All right, and then let's copy it down to double check our Excel, our accounting equation. Copying this down, so now we're at 55,000 assets, and the liabilities are this plus this, right, 5,500, and the equity has not changed. It's this plus this, still at the 49,500. Book value, therefore, is the 5,500, or 55,000 minus the 5,500 gives me a book value of equity of the company, 49,500. So in theory, if I was to close up the company now, in theory, what would happen? Well, I could sell my fixed assets to get 5,000 in cash, which probably wouldn't be what I actually got for cash because I wouldn't be able to sell it for the purchase price. But that, in theory, that would be the idea. And then I can pay off the liabilities, which would leave me with cash of the 49,500. That would be the value of the business that I can liquidate, right? That would be the idea. So that's why that kind of makes sense, hopefully. All right. By the way, we could also, you might say this account right here, this liability account, is going to tell us the transactions and when they happened in what's kind of like the general ledger as we enter the data, but it doesn't tell us who we owe the money to. So this liability account, which is an accrual account, it would only be here if we were doing an accrual versus a cash-based system, because if we were paying things off by cash as they came due, we wouldn't have to track the accounts payable. If we have to track the accounts payable, we need a subsidiary ledger, which is going to track who we owe the money to so that we know who to pay. And accounting software will usually record this kind of for us at the same time. Some accounting software forcing us to be like in balance as we go, but some doesn't force us to be in balance. And this is often where software can get out of whack. People can get messed up. So let me show you, just give you a quick overview of that. Here's our subsidiary ledgers over here. So with this subsidiary ledger, I'm going to put the columns are going to be who we purchased from. So the first utility bill I'm going to say is Edison. Let's say we purchased it from Edison, right? And then I'm going to say this equals, go all the way to the left. I'm going to pick up that $500. So now that went up by 500. I'm going to select this whole thing. Let's select all of this and make the text white again, white text, so it stands out a bit. And then I'm going to add another column for the second purchase. So I'm going to put my cursor on column AL because I want to add a column to the left, right click and insert another column. The next thing we purchased was supplies, and I'm going to say that was from, let's say, Furniture Office Depot, let's say. So that happened on this line, I think. Is this the line? Yeah. So let me get that over here. So now I'm on this column, and I'm going to say this equals the 5,000. Okay? And then on the total, I'm going to say the total equals the sum of these two. And then this is going to equal the one above it, the total that we had prior to this transaction, plus the sum of these two. And then it'll close that up. And then I'm going to copy that down to here. So that means that, so notice what's happening. My accounts payable has a total in it of 5,500. That is the same that's in basically our general ledger account or in our liabilities account. And then I've broken out that we owe Edison. I can total up this column, 500. We owe Office Depot 5,000. Okay, that's the idea. So we need that subledger to help to track us. Again, accounting software will often help us to do that kind of automatically, although maintenance is needed to track that. Otherwise, things will get messy. All right, let's go to the 125. And the other thing we could purchase on account, we purchase inventory on account. So if we purchase inventory, this would only happen if we're in a business that buys inventory and then sells inventory. If you're in a service business, you don't have inventory, right? So what is cash affected? No, cash isn't affected because we're going to purchase it on account. Therefore, the liabilities account, accounts payable, is going to go up. Where does the other side go? Why am I buying inventory? Because I want to sell it to generate income. So you'd think maybe it's an expense of like cost of goods sold, but not yet, because normally we have to put inventory on the books as an asset. Now remember, there's a bunch of different things you have to consider with inventory in terms of what's your flow assumption, first in, first out, last in, first out, weighted average. Can I be on a cash-based system if I have a really like just-in-time kind of system where I sell the inventory right away or something like that? Because that would be easier. Am I in a manufacturing type of situation where I buy raw materials, have work in process? And so all of those things with inventory, you as a bookkeeper have to think, do I want to take on inventory? If I do, how am I going to approach that? What kind of inventory do I want to take on? And again, target those clients that you have a system set up for, and don't let the clients talk you into taking on tasks that are outside of the system that you're working on, right? You have to balance out your clients to what you've planned to do. So, which is again not always easy to do. Dang, clients are always trying to get you to do stuff that you don't. They're like, wait a second, that's not my business model. That's outside my business model. This is work job creep is happening here. Anyway, I'm starting to get a little bit of a flashback, a little bit of post-traumatic stress here. Let it go. Let it go. It's okay. It's over. It's over. All right. I'm back now. Okay. And so now we're going to go accounts payable. And then the other side's going to be in inventory. Inventory is going to be here. And so there we have it. So now let's copy that down. So if I copy that down, inventory has now going up 1,000, accounts payable 1,000, and then equity. All right. And then let's put our zeros in. 0 tab, 0 tab, 0 tab, tab, 0 tab, 0 tab, tab, 0 tab, 0 tab, 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 0 tab, 0 tab, 0 tab, 0 tab, 0 tab, 0, 0, 0, 0, 0. Let's put our underlines under this. Underline, and then underline, and then underline, and then let's total this thing up just with the last balance plus the current transaction. So it's going to be equals the sum of just the last balance current transaction. Copy that, right click copy, put our cursor on here, right click paste just the value, just the formulas. Pasting just the formulas. All right, and then I'll paste just the formulas. All right, now let's go back on over and let's copy these down. So this will be our balance as of 125. I'll just copy this down. So the 55 plus the 1,000 is 56,000. The 1,000 plus the 5,500 is 6,500, and no impact. This plus this is the 49. So our current value is at 56,000 minus 6,500. Now, one more thing with that inventory. How do we track the inventory? Well, let's just make a little subledger over here. This won't be perfect because, again, it will be dependent upon how you're going to be tracking inventory, remembering that accounting software often has the capacity to track, or many, like QuickBooks, many of the, like QuickBooks Pro or something, can track inventory, but you have to determine if the inventory tracking is suited to the needs of the business that you're in. And you might come to the conclusion that you'd rather track the inventory outside of your accounting software system in some cases, or you might think that it's not sufficient in some cases, even though it has accounting software to track. So let's just I'll do this quickly. We're running long on time. Inventory subsidiary ledger. So we're going to make a subsidiary ledger. I'm going to go down here and say this is going to be the amount. Let's going to make it a unit cost. I'm going to say this is going to be the unit change, and this is going to be the total units, and then I'll say this will be the total value in dollars. Now I might need to adjust this as we get into the inventory section of the course more, but this will just give us an idea. Let's make this green. I'm going to go Home tab, Font Group, making this the dark green and white. Let's make this black and white. We'll say this is going to be, let's make it black and white, and let's center it. And then up here, this needs to be, what did I say, 11? Okay, we'll keep it at 11. Everything's at 11. All right. And then down here, let's make this all green, and we'll make it green because it's part of inventory. It's an inventory subledger, bordered green. The text is white. Okay, so then what row was I on? Row 9. I'm going to go out to row 9, and I'm going to say this equals all the way to the left. We'll pick up that 1,000. Now I'm going to imagine the unit cost is $10. So that means that if I paid $1,000 cash, the unit cost is 1,000 divided by 10, or $100 per unit. And the total units, I'm going to say this is the first purchase we had, so it would be the prior units plus the current units, and the total dollar amount then is going to be the prior total dollar amount. Well, it would just be the total units. It would be equal to the total units times the total cost. So that means that we're just giving a subledger telling us the number of units we have. Now, why is this? Remember that if you're actually tracking inventory, the cost of the units might change over time. And if you have similar units, you're going to have to use a cost flow assumption, such as first in, first out, last in, first out, or weighted average, which is going to complicate this a bit. So you have to, keep that in mind. Also, of course, you might have different units of inventory that you're selling. So if you have one static unit of inventory, that's going to be easier than if you have all kinds of different units of inventory that you're going to be tracking. Are you selling stuff online with different products and so on and so forth? So again, there's going to be specialization based on those types of things that you're going to want to dive into more when you get into inventory. I'm just going to try to make this a little thinner and close this out since we're running long. Let's do a spell check on this bad doggy, and we're going to go okay. Ignore that. All right. So I think that's good. So that's the general idea with that one on the bills. Accounting equation and Excel. Pay bills form. Paying off, paying down, accounts receivable. Get ready and some coffee because we're learning the accounting foundations with the accounting equation and Excel. We are in Excel. If you don't have access to this workbook, that's okay because we basically built this from a blank worksheet but started in a prior presentation. So if you want to build this entire worksheet from a blank sheet, you may want to begin back there, or you can just build your own worksheet as we go, or possibly just use paper and pencil to follow along. If you do have access to this workbook though, there's 3 tabs down below. Example, practice blank, example, in essence, answer key. Practice tab having pre-formatted cells so you can practice the practice problem with less Excel formatting. The blank tab is where we started with a blank worksheet, basically working with a template as we do data input, now adjusting the worksheet as needed going forward. Let's go to the example tab to get an idea of what we will be doing. Looking at a transaction paying down the accounts payable. In a prior presentation, we looked at transactions that increase the accounts payable, those being bill type transactions, remembering that we want to be very specific with the terminology that we are using. And this will be important depending on what industry you're in, what accounting software you're in, and if you're in school, what textbook you will be using, because you can get things wrong by just misinterpreting what it is that's being said. And in different contexts, words can mean different things. So in the prior presentation, we talked about a bill form, remembering that if I do data input of a bill form in, say, a QuickBooks, then the bill form means that accounts payable is going up, meaning I made a purchase on account, didn't pay cash for it, therefore accounts payable is going to go up and I'm going to have to pay that off in the future. Remembering that even if I got a bill form from like the utility company, from Edison, let's say, and it said invoice on it, it would still be to me a bill, even though the accounting software that generated it from the perspective of Edison sees it as an invoice. And if I took that bill and simply paid it without entering it as a bill in the system, then I actually wouldn't use a data input form of a bill form because I just paid it off. Therefore, I would use a data input form of a check form, simply paying off the bill as I get it. More modern software using bank feeds to basically do that. That might be a wireless type of a wired up type of transaction that you do basically automatically. So that's the first thing. We enter the bill. The bill's going to be increasing the accounts payable. Once the accounts payable is up, we have to pay off that accounts payable. We don't get another form telling us to do that. It's not like we're going to get another form. We might get a reminder to pay the bill from like the utility company, but in general, we're going to have to say, when is it due, track it, and then pay it off. So we're not going to get an actual form, but we still think of it as a data input form in many accounting softwares, which might be called a pay bill type of form, which by definition means for that purpose that we're paying down the accounts payable. We're writing a check, but Oftentimes, many accounting software such as QuickBooks will not simply use a check form to indicate it, but rather a specific check form, a pay bill check form, which will indicate to us that not only is the checking account going down, but the other side is paying off the accounts payable rather than paying for something with cash off the bat. All right, so that's going to be our transaction. We'll enter a bill and then we'll pay off the bill just to see that full transaction. Remembering that the practice tab will have some pre-formatted cells. It'll look very similar to the blank tab as we have it now, though, because we're going to be working with our template. So we're going to start off with, we have our accounting equation up top. We're going to start off with that initial investment. I'm just going to leave that on the books at the $50,000, which I deleted. Let me put this back on the books here. Hold on a second. All right, so now we have $50,000 on the books. That's the initial investment from the owner, just so we have some cash in the business. And that means from an accounting equation standpoint, we have cash. If we liquidated the business, all that cash would go to equity, the owner, whether that be a sole proprietorship in our case, or if it was a partnership, we'd have to break it out between the partners, or if it was a corporation, we'd have to break it out based on the shares that are outstanding. All right, so now we're going to say on 1/15, we're going to enter another bill. So let's say we bought office supplies. Let's say supplies on account, meaning on account. Let's see if I could spell that right. So from an accounting equation standpoint, first question, is cash affected? We're going to say no, it's not affected because it says on account. Some textbooks use that as the language. Obviously, if you're in practice, you might get a bill for it, or you might be purchasing something that you're purchasing basically on account. So we know that cash wouldn't be affected. And then we're going to say, well, that means that liabilities are going to go up. That's going to be the accounts payable, which will also have to track in the subledger by who we bought it from. Let's imagine we bought it here from Office Depot, let's say. And then the other side, then we have the question of, should it be an expense or should it be an asset? And this is kind of an open question because if we're in a business where the supplies are a significant asset to us, we might want to track it in a similar way as inventory. So I just want to point this out as we go through this example, because we looked last time at the accounts payable going up if we purchased an expense like the utility bill, or if we purchased a asset like furniture and fixture, which means the asset would go up instead of an expense, or inventory, in which case usually the asset would go up instead of expense. What about supplies? Well, if it's like medical supplies and you have a lot of medical supplies and you need to track them and make sure those crazy drug fiends aren't breaking into your place and stealing the medical supplies because for whatever purposes, then you're probably going to have to track it as inventory, putting it on the books as an asset, and then tracking it possibly using a flow assumption, first in, first out, LIFO, weighted average, counting the supplies, making sure that you're taking care of them, and then writing them down in a similar way that we would with inventory. However, if they are small supplies, staples or something like that, then you might not be tracking them as closely, and you're just going to expense them because that would be the easy thing to do. So for us, we're just going to expense it here, imagining they are small supplies, and we're just going to expense them out. So I'm going to go and say, all right, let's say that the accounts payable, one side of the transaction, every transaction has two sides. Accounts payable is going to be equal to the AP. Where's the amount? There's no amount. Let's put the 750, let's say. 750 supplies. Okay. So now the accounts payable goes up 750. The other side, I'm just going to put as an expense. It's in equity. But in the expense side of things, the expense is actually going up, but revenue minus expenses resulting in net income on the income statement will be going down as expenses go up, which means equity will be going down. So I'm going to represent the expenses with a negative number, negative 750. Oh, wait, that's in the wrong line. Dude. All right, negative 750. So I just put negative and then scrolled over to the 750. All right, so that's going to be the idea. Let's copy this down. I'm going to copy this formula down, which will pull that transaction over. Nothing happened to assets. The accounts payable liability went up, and then equity went down. Notice that these this side of the transaction is similar in that it represents who has claim to the assets. So if accounts payable goes up and the other side of the transaction is in the equity has to go down, right? These two have to zero out. So we're going to say, all right, that's good. Let's put some zeros in here. 0, 0, 0, so I can put some underlines. Notice I kept the formatting of the underlines that was in there before. So it's already got the underline under the 0, tab, 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 0, tab. So let's just keep that. And then on the subledger, I'm going to say that it's not Edison this time. It's Office Depot. We purchased from Office Depot, let's say. So I'm going to say this equals on the subledger, tracking who we purchased from. That's the wrong line. Do that again here. Practiced who we purchased from, 750. So now I'm going to say the total is going to be equal to the one above it plus the sum of these two. Okay, so that means the subledger is now tracking who we owe the money to, but it's tracking who we owe it to. So it's breaking out by vendor so that we'll be able to pay off the bills later, which we will do shortly. All right, so then we have, let's put the balance down here. Balance. So we started off with 50,000 in cash, no transaction to cash. So I'm just going to do my sum. Wait, let's undo that. Okay, paso equals the sum of these two. I'm going to copy that. Right click and copy and then paste that across. Pasting it formulas only. Boom. And I'm going to do that over here. Right click and paste it formulas only. And do that over here. And then right click and paste it formulas only. All right. Let's go back on over and copy this down. So I'm going to drag this down. So now we have 50,000 here still. Dragging this down. We now have 0 plus 750 is 750. Dragging this down. We have 50,000 plus 750 is 49,250. Or in other words, we have assets of 50,000 cash and liabilities accounts payable of 750. 50,000 minus 750 gives me the 49,250 book value of the business. Why does that make sense? Well, what would happen if I liquidated the business? I'd have to pay off the 750 here, and then the idea would be I've consumed the supplies, so they're basically gone, right? And then I'd have the 50,000 minus the 750, the 49,250 that would be left over, which I can then put back into my bank account if I wanted to stop at this point in time, if I wanted to pull out here. All right, but we're not. We're going to keep going forward here, and we're going to stay on 120. Let's say that we now pay off Office Depot. So we've been tracking it for the supplies. We've been tracking the supplies in our accounts payable, and now we're saying they become due. Now, as I look at this accounts payable thing, just want to remind ourselves that small businesses, if you do bookkeeping for small businesses, you might not be tracking accounts payable as much because you might be paying everything as they become due, either with the checking account or possibly with a credit card. Be careful of the credit card. But that means you can do most of that work in accounting software, possibly with automatic bank feeds. The reason that's useful for small businesses is because it's not so important to wait until the last minute to be able to pay off bills, because the dollar amount of the bill is relatively small and because you don't have as many transactions. In other words, if the rent becomes due, even if it's $2,000, if I pay it today versus 15 days from now, it's not a big difference in terms of the time value of money. But if I had $2,000 transactions and I had thousands of them, paying all of them off 15 days early will start to add up to a time value of money issue and a cash flow issue that could be more optimally managed if I paid them off as late as possible. And if the dollar amount wasn't $2,000 but $20,000, that 15-day period becomes more significant. So just remember, if you're doing bookkeeping for a small business, then then accounts payable, you might try not to do accounts payable and say, hey, look, we're going to be on a cash basis. I'm going to do everything and automate everything with the use of bank feeds in something like a QuickBooks software or an equivalent of it, Xero or whatever you're using there. But if you work in a larger business, you might specialize in accounts payable and say, hey, look, you have a lot of transactions. Time value of money is important with the number of transactions you have and the dollar amount you have. Therefore, I want to help you manage your transactions to pay them as late as possible, optimizing your cash flow and the time value of money. All right. So in any case, if we then go over here and say cash is going to go down by the 750, and then on this side, the accounts payable is going to go down. Accounts payable is going to go back down by the 750, and then the subledger, way over here for the accounts payable, is also going to go down. So this is not like a third account that's being impacted. Remember that the accounts payable subledger is just more information, more detail about the general ledger account of accounts payable. So it's going to go back, it's going to go down. So negative 750, and that means that if I copy this formula down, it goes back down to 0. There's my running balance. So we paid off. If I look at this column, this minus this, Office Depot has been paid off. That customer's been paid by the column, and then this way I can see that my total accounts payable should be back down to 0. Remember that accounting software will often help us with this transaction as we enter the pay bill form, adjusting the accounts payable ledger for us. Accounting's like software like QuickBooks forcing us to do that, which is cool, but great, but also causes problems sometimes. Sometimes accounting software doesn't force us to keep these two the subledger in balance, and that becomes a problem. So if you one other area that you could be a specialist in bookkeeping in is that you clean things up, right? A lot of bookkeepers, they hire bookkeepers, they don't know what they're doing. The books become a mess. And one of the ways that things could be a mess is that the accounts payable doesn't match what is on the general ledger, or the accounts receivable doesn't match what's on the general ledger, or the inventory doesn't match what's on the general ledger. And you could be a cleanup artist trying to fix that common issue. In any case, let's go back on over here and say, let's copy this down. So there's the 750, and so there's that, and copy this down. So the transaction equals out. So assets now going down because I paid cash, and the other side, liabilities should be going down. I have it, see how this is out of balance? My check figure turned red. So I'm going to pretend that I did that on purpose so that would happen, even though I totally didn't, because you look over here and you're like, no, this should be a negative. It should be going down, negative that. Okay, see how I totally did that on purpose so that you could see the data input. So if you were looking at it before and you're like, hey, you messed up, then it's like, no, I didn't, because I was teaching, it was for lesson purposes. Home tab font, let's put an underline here. Let's put an underline under these. All right, and then let's put the balance back in place. Bring down the balance. So wait, let me put my zeros in place. 0 tab, 0 tab, 0 tab, 0, 0, 0 tab, 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 0 tab, 0 tab, tab, 0 tab, 0 tab, 0 tab, 0 tab, 0, 0, 0, 0, 0, 0. All right, now let's copy it down. Summing up just the last two, not all the way up to here, just these two. So 50,000 minus 750 equals the sum. A sum function because it's a negative number, so if I sum them, it will subtract them. 49,250, copying that, pasting it across, pasting it with the formulas so it doesn't mess up my beautiful color scheme. And then we'll take this one, paste it, and then take these and paste it formula only. All right, and then the subledger is good to go. And then let's copy this down. So now I'm going to copy it down. It's going to copy the underline. The underline's messed up, but I'll copy these down and then I'll get rid of the, oh no. Que paso? I messed it up. I'm going to copy these down, and then I'll select these. I'm holding down Control to select non-adjacent cells, the ones that are not next to each other, to get rid of the underline, because there's the balance. All right, so now the 50,000 minus the 750 means we have 49,250 of cash. The liability has now been paid off. Liability is now back down to zero, and all we have is really the cash of the 49,250. Why? Because the supplies that we purchased, we're assuming that we consumed them within the business, right? You might be saying, hey, I still have the supplies, but the idea is we didn't put them on the books as an asset. We expensed them, assuming that we're going to consume them either now or shortly to help us to generate revenue, right? And it would be like paying, which is similar to what we saw before with utilities expense. If I paid the electric bill, we already consumed the electric bill to help us to generate revenue. So it's not like I can really sell the supplies, so they've been consumed, right? So all we have at this point in time is going to be the 50,000 in cash. So if I liquidated the business, I currently have no liabilities to pay off. I've got the 49,250 in cash. I lost the 750. It's been consumed. If I stopped the business and liquidated at this time, I could take the money, 49,250, out and put it back in my account, which is why the equity is currently at the 49,250, representing in essence the value of the business, but on a book basis. Accounting equation and Excel. Check form, the form typically used to decrease cash. Get ready and some coffee, because we're learning the accounting foundation, the accounting equation with Excel. Here we are in Excel. If you don't have access to this workbook, that's okay, because we basically built this from a blank worksheet, but started in a prior presentation. So if you want to build this entire worksheet from a blank sheet, you may want to begin back there, or you could just build your own worksheet as you go, or possibly just follow along with good old paper and pencil. If you do have access to this workbook, though, there's 3 tabs down below. The example, practice, and blank tabs. Example, in essence, answer key. The practice tab having pre-formatted cells, so you can practice the practice problem with less Excel formatting. The blank tab, the one we will be working in, started with a blank worksheet, but now we're basically using a template to do the data input, adjusting the worksheet as needed as we go. Let's go to the example tab to get an idea of what we will be doing, looking at transactions that are going to be check form types of transactions. Remembering we need to be very careful about the terminology that we're going to be using, especially as accounting software comes into play with things like bank feeds, because many times people will say things like, well, we don't need check forms anymore. However, if you look at accounting software that uses things like bank feeds, they still are going to use check forms with the bank feeds as the data input form that is used when you do an electronic type of transaction or record something with the help and the use of the bank feeds. So when we think about a check, then we can obviously think about a handwritten check, a check that we actually write, and then when it is cashed, it's going to be decreasing our checking account. But we also want to think about the data input form into like a software that will be used to decrease the checking account in a similar way as we thought about the bill form as the data input form that is going to increase the accounts payable, and the pay bill form being a type of check form, but one that is specific, that decreases the checking account, but also decreases the accounts payable. So now we're going to think about those normal type of transactions, typically, some of which you can probably do with the bank feeds. And if you're working in a business that basically pays everything with cash, as many small businesses do as they become due, in other words, you're not tracking the accounts payable, then you might be able to set up the bank feeds, automating that system quite nicely using many accounting softwares. But remember that all the decreases to the checking accounts, even if done with bank feeds, are typically going to be assigned a check type form, because that's the form used by many accounting softwares to decrease the checking account. Even if they don't call it a check form, that's kind of like the traditional name, or some of the big softwares like Intuit, which is QuickBooks, will still call it that. So keeping that in mind, we're gonna enter some checks. pay electric bill. So we paid the electric bill before with a bill form. Increase in accounts payable. This time we'll use the good old check form. Buy furniture. So same thing we did with the bill form, but this time we're just going to pay it with the check, and then we're going to pay buy inventory. Similar types of transactions we did before with a bill form, but this time using a check form, paying for them as we go. The practice tab will have pre-formatted cells. It'll look much like, however, the blank tab, because we're basically just working in the template that we had set up before. All right, so we're going to start with the $50,000 just to have some cash on the books, imagining that the owner put in the $50,000, increasing the cash, meaning the assets, which is an asset of $50,000, and the other side being equity. So there's $50,000 in the business, nothing is owed to third-party liabilities. Therefore, if we were to liquidate the company, that $50,000 would be going to us, the owners. All right, then we're going to say that on 1/15, we're going to pay the electric bill with cash. So the questions that we ask typically when thinking about the transaction, is cash affected? In this case, it is. Which way is it going? It's going down. So the first thing I would note is that, okay, I can do that right off the bat. Let's put the 500. Let's say it's $500. So I'm going to put negative 500 in cash. Then the next question is, well, what's the other side that is impacted? It's not going to be a liability, because that would be like we owe someone money. It's going to be in the equity, in the income statement part of it, as an expense for the electric bill. Now, just a quick note on the timing of the electric bill, remembering that you might be, if you work with small businesses, they might be on a cash-based system or on an accrual-based system. Remembering that if you're working with small businesses, you might be trying to build a business around automating everything as much as possible, therefore wanting to be on a cash basis method as much as possible, therefore using the check form all the time, but in the process of bank feeds to automate the transaction. So that's one strategy that you might put into play. And you have to be careful of when an accrual component is going to come into play, because the accrual transactions will kind of mess things up, because if you have to put it on the books as an asset, or if you go through accounts payable, it's going to be more difficult to automate your bank feeds. Now, also just note, some types of things like the bill form makes sense when we pay them to expense them more easily than other types of things. Why? Because an electric bill is something that we consumed. We've already consumed the energy, and they're making us pay for it afterwards, after it has been consumed. Therefore, it would make sense for us to just write it off as an expense. Whereas if you pay for something like insurance, that becomes a little bit more problematic, because you pay for the insurance before the coverage happens. So that's what we have to be careful of with this accrual type of thing. All right, so we're going to go to the expense side on the equity over here. So we're in the equity, we're in the income statement, and then it's just a matter of what category we're going to put this thing in. I'm going to put it into the utilities, remembering also that with the expenses, we have the biggest leeway in terms of categories that we want to be putting into play. If you're in the United States, you might be trying to use some categories that line up possibly to taxes, to make sure that your tax income tax will be as easy to do as possible. But even then, there's going to be a leeway. In other words, utilities is the classic example, because utilities used to include things like the telephone, electric bill, gas, water, sewage, trash, so on and so forth. Usually fairly small items, therefore it making sense to group them all together instead of having all these different line items broken out with small, possibly insignificant for decision-making purposes, dollar amounts within them. But if any of these become large, such as the telephone for most companies, it's going to be broken out of utilities and reported in its own expense account. It will have the same bottom line for total equity, but might be a significant line item for decision-making purposes. So for our case, if the electric bill then was quite large, if I used the electric bill to grow plants or something like that with lighting, then I might want to break out the electric bill on itself, because it's very important expense. But if it's relatively small, I might group it together with the trash and the gas and so on. So I'm going to put it into utilities. Also, I'm going to make it a negative. It's going to be a negative because it's going to be decreasing total equity, decreasing net income. So we're going to say that's going to be 500. Boom. So that's going to be decreasing net income, which is revenue or sales minus the expenses. We don't have any revenue, so we have a negative net income at this point. And that then would roll into the balance sheet, decreasing the total balance sheet equity account. All right, let's put in zeros across the boards. I'm going to put 0 tab, 0, 0, 0, 0. So I have that nice underline in play, 0, 0, 0. Maybe I should just already start with, oh no, I don't want to zero that, with zeros in there and then just change the one that we want. Maybe I should add zeros all the way in there so I don't have to do that every time. Maybe I'll do that. That's a good idea. That's a good idea, man. All right, let's copy this down and say, all right, now cash is the 500, negative 500, copy this down. Nothing happened to the accounts payable, copy this down. That puts us back in balance. That's good because assets went down 500, equity went down 500. Makes perfect sense. Let's put our balance over here. Balance. Now I'm going to sum these two up, which will subtract them out because the second one is a negative. Sum, the trusty sum function, our favorite function. It's the best, man, sum function. We're going to paste it, just the formulae. And then I'll paste the formula here, paste just the formula, and then paste it here. Boom. All right, so now on the equity, you can see we have a negative. If I sum these up, that comes out to negative 500. Total equity then on the balance sheet would be reported just as one number of 49,050. And then on the income statement, it would break out that period of activity, that month or year, which only includes a negative 500 at this point in time. So that's how the income statement and balance sheet kind of work together, remembering that the accounting equation represents the balance sheet as of a point in time, income statement giving us that timing, breaking out the equity component. Let's copy this down, copy down, 49,500. Copy down the liabilities, no change there, and then boom. So let's put some underlines on these underlines. There we have it. So now I would say we have cash of 49,500. If we liquidated the business, I'm not going to get back this 500. It's been consumed. We paid the utility company for expenses, and hoping it helps us to generate revenue. It hasn't generated revenue yet. But there it is. So therefore, if I liquidated now, the 49,000 is all we'd have that would come to us as the owner. All right, let's do another one and say now we're going to say on 120, let's say we buy furniture for cash. So this time, just like we did with the accounts payable, we're buying furniture, but we're paying for it at the point. Before I get into this, one more thing I just want to show here where it says pay electric bill with cash. You might have said, hey, look, if it's a bill form, then I should be paying a lot. It should be a liabilities going up. Remember, the terminology gets a little messy there. And if you're using a textbook, you have to be very careful on how the textbook is saying the terms, because in practice, it would be obvious that you're paying a bill. In a textbook, they have to be careful and say, what is happening here? Are you paying, is it a bill that you're paying for on account, meaning accounts payable, or did you pay for it with cash? Now, if I say that there's a bill that we're paying the electric bill with cash, what I'm trying to indicate here is that we've got the electric bill, and instead of entering it into the system as a bill, which that terminology means that we would increase the liability account, no, we're just paying it with cash. So now we have a difference between the terminology for a bill in normal language. We got billed, they invoiced us, they billed us, versus the data input language, which is I'm not going to enter a bill because I'm just paying it with cash. Therefore, I'm going to enter a check form. And that also becomes problematic terminology-wise because I'm not actually writing a check. I'm doing a check data input, which might be done simply with a bank fee transaction. So that's something just to, again, the terminology, accounting's getting easier, but the terminology is getting actually somewhat more complex to be able to communicate with people exactly what is happening and what you need to be doing and what the software is going to basically do for you. Everything is, the accounting system is basically the same, but how things are being entered could be automated or not, and you have these electronic transfers that kind of confuse things a little bit, but the data input form are still named similarly. Now, if I buy furniture for cash, so now we go to Office Depot, we buy furniture. Is cash affected? We're going to say, yes, cash is affected, and therefore we're going to decrease the cash. Now, again, we might have got, you can imagine going to Office Depot and actually paying for it, possibly not writing a check, possibly still doing some kind of electric transfer while you're in Office Depot, however you're paying for it, possibly. But you can imagine the receipt being kind of like a bill form. They billed you for it, and you paid for it at the store. But you paid for it with cash, so you're not going to enter a bill. You're not going to enter the receipt as a bill, of course. You're going to enter it as a check, which might be done with an electronic transfer, which might be done automatically as it clears the bank. But still, the system will record it as a check type of transaction because that's the transaction that decreases the checking account typically. So I'm going to say that how much did we buy this for? We'll say $1,000 this time, furniture. So cash is going to go down by $1,000. Now, where does the other side go? And you might say, well, it should do the same thing that we did up here, meaning it's going to be an expense, furniture expense. Makes sense, but furniture is typically something fairly large. So you might assign a dollar amount, although a dollar amount is not typically how we define these things, but in practice, you might have a dollar amount, right? Because if it goes over a certain dollar amount, it's likely that you would have to put it on the books as an asset, remembering the same kind of concept conceptually of buying like a $1,000 office building. If you bought a $1,000 office building, expensing it would look funny because you wouldn't be able to compare the income statement of this month or year to last month or last year because you've got this giant expense in the current year, which isn't going to happen in any other year because the expense wasn't actually consumed in that year, but was just paid for in that year. That's what the accrual system is trying to do. Therefore, even if you're on a cash-based system, you're going to have to do some accrual things when the difference of when you actually earned the money on the revenue side or when you consumed the goods or services on the expense side differs greatly from when you paid for it, such as when you bought a building, or in this case, when you buy furniture. And remember, in the United States, the tax code is also going to kind of force you to put things on the books as an asset, again, even if you're on a cash-based system. Remembering also that the furniture and equipment, other types of property, plants, and equipment are going to be less transactions. You don't do those every day. So it should be easier to manage those when they do come up. You want to track them, make sure you're recording them, get them to your tax professional in the proper detailed fashion so they can do what they need to do with it. All right, so it has to go on the books as an asset then. So the other side then is not going to be an expense. It's on the same side of the accounting equation. It's an asset, not a current asset, but a fixed asset. So it's going to be fixed asset, meaning we're not going to consume it within like a year. We're going to consume it over a longer period of time. And we'll have to deal with depreciation, which means we'll have to do adjusting entries, which we'll talk possibly about later. Let's put zeros across the board. 0, 0, 0, 0, 0, 0, 0, 0, 0, 0, 0, 0, 0, 0, 0. Okay, let's put our totals in. Summing up, not up to the top, just the last balance plus the current equals the sum of those two. Boom. Copy that. Copy that. Roger out. Roger out. Pasting it. Formulas only. Pasting it. Formulas only. Pasting it. Formulas only. Notice that we don't have to deal with any subledgers or anything over here. Why? Because we're on a cash-based system for the most part. Again, even though I had to put it on the books as an asset. And also remember that if you're on a cash-based system, you can't just choose sometimes to be in a cash-based system. It's like the industry that you're in. So if I'm in an industry where I have to track accounts payable more closely, then that's just what I have to do. If I'm in an industry where I have to invoice the client and then collect on it later, I'm going to be doing an accrual type of thing. But if you're in the type of business where you can just pay the expenses, which are many small businesses can, as they become due, you don't have to deal with accounts payable, subledger eliminated, bookkeeping process easier. That is something you want to think about when you're trying to pick up clients. What kind of clients are you looking to pick up? What kind of clients are you looking not to pick up because they're not in your wheelhouse? And then the balance, we're going to say, let's copy this down. I'll copy this down to here first. So nothing happened. How can that be? Now, this is what's a little bit confusing about the accounting equation, because notice these two sides were on the same side of the accounting equation. So that means there's no impact on the assets, although one asset went down and the other asset went up. So what happens if I liquidated the company? Let's copy this down again. Let's copy this down. My balances are back in balance. Let's put an underline here. So now what if I liquidated the company? Well, if I liquidated the company, now I've got this 1,000. See this amount has been consumed. It's gone to help generate revenue. So it's gone. And then the furniture, we still kind of have it because I got this nice furniture right now. I got a desk maybe and some chairs around it. Our conference desk, beautiful $1,000 conference desk or something. And I still have it. And if I liquidated the company, I would have to sell the desk in order to get the $1,000 back, which possibly will most likely not be worth $1,000, which means we're going to have to depreciate it soon to write it off as it's being consumed. But in theory, if I could get the $1,000 back by selling it, then I would have the cash that I could then give to myself. So I don't have $49,500 in cash, although that's the equity value of the business. We've got $49,500 of assets, but some of them are sunk in furniture and equipment. I want to point that out kind of as we go, because a lot of times when people look at the value of a business, they say, well, look at the net equity is this, but most of it's not going to be in cash for most businesses, because the business isn't there to hold on to cash. It's there to hold on the assets that are going to be used in order to generate revenue. And if they were holding on to cash and it wasn't going to be intended to use to generate revenue, why are they holding on to it? They should give it back to the owner, where the owner can then invest in something else, like stocks and bonds at the very least. All right, so let's go to the next one. We're going to say on 125, let's say we buy inventory for cash. Let's say, well, actually this furniture I had at 5,000. I'm going to change this to 5,000. Notice the beauty of this. Everything, I didn't hard code anything. So if I change that to 5,000, everything should update automatically. Boom, across the board. And so that makes sense. That's why I'm using formulas to do this. So if you've been hard coding and you tried to change that, it's going to mess you up and you're going to be like, why did you do that? Why did you do that to me? You should have fixed it and went back and edited the video. But no, because this is going to teach you a lesson. This is going to teach you a lesson. You have to connect everything and not do, you can't just, because then you could just change it. You want everything to be connected with formulas, not hard coding. Okay. Anyway, I didn't do that on purpose though. I'm sorry if that bothered people. Let's go to the next one. Buy inventory. So now we're going to buy inventory, remembering that inventory becomes kind of an issue in and of itself because we have to track inventory, but we bought it for cash this time instead of on account. That should make it a little bit easier because we're not going to track the accounts payable. Is cash affected? Yes, it is, because we bought it with cash. Therefore, we can still think about using it possibly with the bank fee transactions if you have inventory, but inventory is going to mess up your bank fee transactions because you might have to track the inventory. Meaning you're going to have to use some kind of flow assumption, and that means you're going to have to use a form that tracks inventory, and so you have to be careful of that. You might be able to still use bank feeds, but you got to be careful that the form that you're using is going to track the inventory in whatever method you're going to use. But in just general terms, we're going to say, well, we bought it for cash, so cash is going to go down by 1,000. The other side, where should the other side go? Well, you might think equity again, like with the utility bill, because why did we buy the inventory? In order to generate revenue. We're going to sell the inventory. So maybe we should expense it. What's the expense form related to inventory? Cost of goods sold. But normally I wouldn't put it into cost of goods sold yet because I didn't sell it, right? I'm holding on to the inventory. I'm going to sell it later. Now, in some cases, if you bought the inventory specifically to sell it, and it's like a custom situation, the easy thing to do, as always, would be on a cash-based system and just expense it as cost of goods sold. But normally you can't do that because you're holding on to the inventory and you want to track it as an asset. You want to track it on the books. You want to make sure that you're keeping an eye on your inventory so you don't have people stealing your inventory. Dang pirates, I'm telling you, stealing your inventory messes you all up, man. But anyways, so that means you have to put it on the books as an asset. So we're going to put it on the books as an asset. So inventory is going to be here, boom, and then, okay. So there we have it. So then if I copy my formulas down, we're going to say that the assets, no change once again, just like up above. Why? Because one asset went down, cash, and then another asset went up, inventory. Why did we do that? If it didn't have any change to assets, wouldn't I rather have the cash? Well, it's because I hope to sell the inventory for more than I paid for it. Right? And then our assets will go up, right? But that hasn't happened yet. So then let's go over here and then put 0, 0, tab, 0, zeros across the rest of them, and tab, 0, tab, 0, tab, 0, tab, 0, tab. Let's copy the balances down. So we're going to sum up just the last two equals the sum of just the last two. Boom. I'm going to copy that. Control C, paste it special, just the formulae so it doesn't mess up the beautiful color coding. And there we have it. All right. Pasting across this way. And then, okay. And so then if I go back to the start, we can say the balance is now, if I copy this down, we're now at still, these two are 49.5, no change here, no change to the liabilities. We're not dealing with liabilities, man. We're making it easy, paying things as they come due. Liabilities, no, not using them. Underline. All right. So now we've got 49,500 in assets and 49,500 in equity, meaning all of the assets belong to us. That's the net value of the business. But if I was to liquidate, remember that I can't just get 49,500 cash, because now $1,000 of it is in fixed assets. I'd have to sell the fixed assets, hopefully for $1,000, and I'd have to sell, the inventory for $1,000, and I'd have to sell the fixed assets for $5,000 to get the $6,000 into cash, so that hopefully then I can get, if I liquidated, the $49,500 in cash. Now, obviously the problem is, if there's a problem in the business, it's probably because I can't sell the inventory, which means it's going to be worth less than $1,000. And I can't possibly sell the equipment for the same value I purchased it for, although we will account for that to some degree when we do depreciation, lowering the value on the books for fixed assets as time passes. So we'll talk about that more later. But that's just an idea or a reason or some information about why the equity is only book equity. Doesn't necessarily mean that you can get that money in cash if you close the business. And so just to keep that in mind, because that's a common kind of misconception, especially if you had a large business. If you start selling off all the assets of the business, it's going to lower the value of the assets as you go, possibly. In any case, so then I also want to go into the inventory over here. And let's just imagine we had a subledger that we had to track for inventory, remembering that normally you'd have to put it on the books and use a flow assumption like first in, first out, last in, first out, weighted average. Different accounting software can help with those kind of tracking. but you have to be very careful in determining how exactly you want to deal with tracking inventory. You might have a very simple method that you track inventory outside of the accounting software, and then you use some other software or Excel to track your inventory. You might track it within the accounting software like a QuickBooks or something like that. Or you might have more complex tracking inventory needs where you need something more complex. That's one of the reasons you might have to level up from something like a QuickBooks. So again, inventory is an area where you can specialize. And when you specialize, you're usually going to do it kind of by industry, because then you're going to get good at a particular type of inventory need. All right, in any case, we'll just do a quick subledger here just to get an idea of it. So let's say we spent $1,000 for inventory. Let's imagine they cost $10 per unit. So that means that the unit cost is going to be 1,000 divided by 10. So $100, the change in the unit, $100. So the total units we're going to say is the prior amount, which is 0 right now, plus the 100. And that means the total dollar amount, if they all cost 10 units and we now have 100 of them, would be this amount. Now remember, this is a basic worksheet. We might have to adjust it later when we start to do the full practice problem in accordance with whatever flow assumption we use, first in, first out, last in, first out, or weighted average, because the cost of the units of inventory will possibly change over time. So when I sell the inventory, the question is, what's the cost that I should be applying to that inventory? Am I using specific identification? Do I know the inventory thing that I sold specifically and how much it cost? Like if I sold cars, or more, if it's other types of inventory, I won't. So I have to use a flow kind of assumption. And also just realize that if you only sell one thing, it's a little bit easier possibly to track the inventory. If you sell a whole bunch of different things, then tracking inventory in accounting software is going to be more of a complex task, because you have all these different kind of inventory items that you need to be tracking. So, and those are just things to be keeping in mind with inventory. But the general idea is that you should have some kind of subledger that should tie out to the value of inventory, which should then match the inventory in the general ledger in the account of inventory, which we might get into more when we get into our practice problem. Accounting equation and Excel. Void check, prior period adjustment. Get ready and some coffee, because we're going to learn the accounting foundation, the accounting equation in Excel. Here we are in Excel. If you don't have access to this workbook, that's okay, because we basically built this from a blank worksheet but started in a prior presentation. So if you want to build this entire worksheet from a blank sheet, you might want to begin back there, or you could just construct your own worksheet as we move forward, or possibly just follow along with good old paper and pencil. If you do have access to this workbook though, there's 3 tabs down below. Example, practice, blank. Example, in essence, the answer key. Practice tab having pre-formatted cells so you can practice the practice problem with less Excel formatting. The blank tab, the one we will be working on, started with a blank worksheet, but basically using a template going forward, adding to that template as we work through the practice problem. Let's go to the example tab to get an idea of what we will be doing, looking at the accounting equation rather than the debits and credits, recording transactions in accordance with the accounting equation, thinking about a situation where we have a voided check. And when we think about a voided check, we can have a similar scenario as any transaction where we're adjusting an error that was made in the past. That's basically what a voided check is. In other words, if we wrote a check and the check doesn't clear, then at some point in the future, we want to take the check off the books because it keeps showing up in our bank reconciliation, for example, and it shouldn't be there because it never cleared, because whoever received it possibly didn't cash it, or maybe we entered it 2 times or something like that. Now, if it's in the same period, the easy thing to do would be to void it, which would be similar to deleting it, except that voiding it gives us the paper trail, which we want. We want to have a paper trail, therefore we void it, adding another journal entry instead of deleting the journal entry. But there's another problem, and that is that the check could have had an impact on the timing statement, that being the income statement. And if that is the case, and we closed out the income statement in the prior period, typically month or year, then if we void it, it's going to mess up the retained earnings because we're going to make a prior period adjustment, which has already been closed out. So that's another thing that we'll kind of keep in mind. Now, also remember that a lot of software these days might be using bank feeds, so more than writing checks. So you might say, hey, look, this is obsolete now because I don't write checks anymore. What I do is I use the bank feeds, and if I'm on a cash-based system, then I'm not going to have a situation where I wrote a check and then I sent the check out and someone just didn't cash the check and therefore it never cleared and I have to void it. That might be the case, although there's still going to be transactions where you might record it first. If you're in a larger type of business, a larger company, you might be doing more electronic transfers, but you might still be entering the transaction as you make the transaction, which still leads to the possibility of a similar error. We recorded a transaction that had not yet cleared. But even if you're on a cash-based system and you don't write physical checks, the practice of the voided check is still applicable because it's the just default scenario of a situation where you have something on the books that you need to remove from the books, but it's a problem because the income statement has already been impacted in the prior period and it'll mess up your closing entry, which is why if you work in any accounting department or you deal with a tax preparer at the end of the year that's a good one, that if you mess up the prior period numbers, you're going to hear about it, right? They're going to say, what happened here because my numbers don't roll forward to the current period. So it might happen with a voided check. It might happen with entering two transactions. Sometimes happens in bank feeds. Sometimes there's an error where, they entered two transactions, got entered, and you have to remove them. Or you might have a situation where your accounts receivable has a subledger and you have things in the accounts receivable that you're not going to be collecting on, or so on and so forth. Same with the accounts payable type of subledger, and these are kind of adjustments that have a similar characteristic to them that you want to be careful removing them because they're in the prior period. Okay, so that said, we'll go to the blank tab and add our information. We're starting out with just that $50,000 in cash as the initial investment. The other side's in the equity. So let's start by just writing a check. So we're going to say 115. Oh, wait a sec. Wrong space. I'm going to say on 115, let's just say it's a miscellaneous expense paid with a check. So again, if you don't write checks, you can think of it as an electronic transfer. Even if you're using the bank feeds and you let the bank feed record the transaction, recall that the check form is still the form used as a data input tool, typically by software, when you do an electronic transfer recorded with the bank feeds. All right, let's say that's $1,000. Now, what's going to happen there? Well, cash is going to go down, as we saw in a prior presentation. I'm going to put negative to the cash, and the other side's going to go to the expense of, we just put it to miscellaneous, assuming that we consumed it, which is going to be a decrease to the equity. So there it is. Let's go and let's make this a little bit wider so we can see that. It's nice to be able to see stuff. And so let's go back on over and let's tab through some zeros. 0, 0, 0, 0, 0, tab, 0, 0, 0, 0, 0, 0, 0. And there we have it. Now this transaction impacted the equity, decreasing the equity, but it's broken out on the income statement part of the equity. So if you had a trial balance, it's the equity section, which would be equivalent to retained earnings, is only showing the amount from the prior period before the income statement, income and expenses, has rolled into it. But the total equity is the entire thing, which would be reported on the balance sheet. So this account right here, owner's equity, which is equivalent to retained earnings if it was basically a corporation, would be reported on the balance sheet, including both of this transaction at the 49,000, right? Because the income statement would close into it. The income statement then showing the activity that is happening. That closing process is what's going to cause us problems. All right, so let's put the balance over here, say balance, and let's copy down our formula this way. So now we've got 50,000 or the 1,000 decrease. And there it is. So now let's put the balance. So I'm going to put that over here and just sum this up equals the sum, which will subtract 50 minus 1,000. Copying that, pasting that across. So this is where we stand. I'm going to paste it just the formulas only so it doesn't overwrite my beautifully colored statement here. Not colored just to make it colorful, by the way, although it is very nice, but it has meaning. Tons of meaning involved there. All right, so now we could see that here in our balance, 50,000 minus the 1,000 is 49,000 in total equity when you look at it from an accounting equation standpoint. So if I copy this down, boom. Now, what does that mean? It's useful all the time I go back to the liquidation. If I liquidated the company, I only have $49,000 now that I can get back into my checking account because the miscellaneous expense, we're assuming we consumed it in order to help us generate revenue, of which we haven't been able to generate any as of this point in time. So that's why there's $49,000 in the bank and it's in the business checking. But if we liquidated, that's what we'd, basically the net worth of the company. All right, let's say now on 1/15, like the same day, we void the miscellaneous check. So we're going to void it now. Why? Because maybe we entered it 2 times. And this would happen even if it was electronic transfer, right? Or you might have pulled in from the bank feeds 2 transfers instead of 1. For some reason, the glitch happened. It got doubled up, which still requires you to do bank reconciliations to find those errors. So we're going to go, okay, so that means we have to reverse it. So all we're going to do is say, okay, we're going to void the $1,000 check. So I'm just going to say now cash is going to go back up because the check didn't clear. It's not going to clear, we have determined, and therefore we incorrectly decreased our checking account by 1,000. We have to put it back in there. And so now you might say, why would I do that? Why don't I just delete this one, right? You could do that, but the problem with that is that you lose the audit trail. Now, if you happen to see that you had bank feeds that put in multiple checks, like it was a duplicate, then maybe you would delete it in that case. That would be the easy thing to do. But normally in the accounting system, if we do a data input, what we want to do to fix it is reverse it with a journal entry so that we still have the audit trail in place. Now notice in this case, we're in the same period. It's the same day. So I want the audit trail, therefore I'm going to void it instead of deleting it. And I don't really have to worry about the prior period adjustment because it's not like this was a check or a transaction that was entered in the prior year. Therefore, I'm just going to say, okay, I'm cool to just reverse it in the current period. So I'm just going to say, let's reverse it here. Added it back into miscellaneous. I put it into miscellaneous, but I didn't really actually spend it. So I'm going to put it back in play in there, meaning let's put our zeros in here. 0, 0. Oh no. Oh, what happened? 0, 0, 0. I hit the wrong button. Okay. Oh no. Don't put a 0 there. Boom. 0, 0, 0, 0. Okay. So then I've got underlines in the wrong place. So I'm going to ununderline these ones, ununderline those, and put the proper underline here. Underline. Oh, wait a sec. No, that's not where that was where the underline should go. Dang it. Let's undo that. Okay. And now let's put the balance in here. So if I copy this down, I'm getting distracted by my explanations and I'm just losing it, man. I can chew gum and walk at the same time. Okay, so this one should be a positive. See how this is out of balance now? So what happened? I put a negative here. I should have put a positive here, adding it back in, and now I'm in balance. The green 0 turned red. So that was clearly done on purpose for demonstration purposes. Copying this out, 50,000 in cash for the balance. That's the new balance. I'm just going to paste that. Formulas only. Paste in here. Formulas only. Paste in here. Formulas only. Boom. So now, of course, look what happened to the income statement. We increased an expense. That doesn't normally happen because usually the income statement accounts only go in one direction. We only buy expenses, which increases the expenses, but that increase here is a decrease to equity. So expenses always go in one direction, and then revenue minus expenses decreases the total equity. So here we did the opposite though. We reversed the expense. It's going in the other direction. That doesn't normally happen unless something weird happened, such as in this case, where we wrote a check, but it didn't actually clear, and therefore we reversed it to the income statement account. Now that's not an issue so much right now because again, it was in the same period. So that's cool. Easy thing to do. We just kind of reverse that. Let's look at a situation where the check was written in the prior period, which causes us more of a problem. And if you just reverse it, your supervisor is going to be like, they probably won't even let you do it, right? They'll lock the system. But if you're doing your own bookkeeping, this is a common error because what happens is people try to like clean up the books because it gets messed up, right? Because there's outstanding checks and there's outstanding accounts receivable, and they try to clean it up. But by doing that, they totally mess up all these prior year transactions, which messes up the rollover of retained earnings, and that becomes a problem. So it's something to keep in mind. So buy office supplies for check in the prior year. That's what this prior year means. Let's say it was 2,000 this time. So we're just writing a check again. So once again, cash is going down, and then the other side is going to go to this time supplies. Once again, on the income statement, we're not tracking the supplies like inventory. We're just expensing them in this example, assuming that we consume them relatively soon after purchase. So now let's put our zeros in here. That's our normal check transaction. 0, 0, 0, 0, 0, 0, 0, 0, 0, 0, 0, 0. I should just put zeros in the whole thing again. I still think I should just start that way, but I'm still debating if I want to do that. So now let's put the balance. So balance. So now we're going to say balance. Something's wrong with the spelling. Let's just say equals that one. And then we'll sum this up, just the last two. So here's where we were before. 50,000 minus 2,000 brings us to 48,000. I'm going to right click and just Control C copy, pasting that across, pasting it formulas only because I don't want to mess up the color coding because the meaning will be lost. The colors are giving us meaning, man. It's not just arbitrary for no good reason. All right, let's copy this down. And then we'll copy this down. And then we'll copy this down. Boom, boom. Everything's back in balance. Let's put some underlines over here. Put some underlines under these. It didn't do it. Where's my underline? And then we'll put an underline under these. Is that right? To the 50. And then this is the balance. Hold on a second. Let me undo that. I'm a little out of it. So this is an underline. That makes sense. And then we have the total. And then we have an underline here. Right? That makes sense. And then I need to copy this one down again. Copy this down to the new total. That's why it wasn't doing it. And then we'll put an underline here. Okay. So now here's our new total. All right. So now we're going to void it, but the problem is we're imagining there was a closing entry right here. So let's do the as of 12/31 of the current year. Now this is kind of messing me up because I didn't put years now, so it gets a little ugly. But as of the end of the year, we're going to do a closing entry, right? So I'm going to say this is going to be the closing process. So what happens with the closing process? Basically, a lot of times software does this for us if you're using something like a QuickBooks, but if we don't understand it, then that leads to these prior period errors. So what's happening is this income statement is going to roll into equity. So all of the income statement accounts, of which we only have one right now, I'm going to close out to equity. I'm going to make it go to zero by saying this is just going to be 2,000, or I could just say it's going to be the opposite of this, right? And then this equity is going to be the negative sum. I'll say negative sum of the income statement, which is only that two, right? So there's my journal entry basically. And so if I put my zeros across this, 0 tab 0 0 0 0 0 0 0 0 0 0 0 0 0 0, and we do our totals. So we'll put our totals. Let's put an underline under here, underline, underline, and underline, and then we'll sum it up. Little darling, sum it up. So we'll sum that up and we'll copy that, paste it, formulas only, paste it, formulas only, and paste it, formulas only. So you can see what happens here. So now I still have the same. See, if I took the total equity, it's the 50,000 minus the 2,000. So as of 12/31, I would still be reporting on the balance sheet 48,000, but then the income statement would be reporting this 2,000, right? But then once I close this out in the next period, we close out the income statement because it's a timing statement to the balance sheet. So now we have in the next year, we just have in the equivalent of retained earnings, owner's equity, the full 48,000, which is retained earnings up to that point, income generated plus draws, plus investments or issuance of capital stock if it was a corporation, minus draws or dividends if it was a corporation. Nothing's in the income statement. So when I void this check now, if I void it and I say, okay, on 1/15, let's say we void the check in the current year. I'll just say CY, current year, and it was the $2,000 check. So we're going to need then a journal entry to not mess. Well, let's do it one thing at a time. What's going to happen if I void that check right now? Let's copy this down first. I need to copy this down. So this is boom, boom. And so that's where we stand now. And so I copy this down. And that was the closing process, which had no impact on the accounting equation because both sides happen within the equity section. And then I need to delete this right now and then do the balance. So this should be the balance again. So then I'll copy this down. So we're in the same situation here from an accounting equation standpoint, but the equity now has everything basically in the balance sheet, nothing in the income statement, so that we're ready for the next period, which is the timing statement to count up. So then we're going to say, so now let's say that we void that one. So it's going to happen on 1/15 that we're going to void it. But when I void it, it's going to void it as of the prior period. So I'm going to do the actual process of voiding on 1/15, but then it void check which impacts prior year. And this is the problem with most accounting software. Now, you have to determine, like, if you're working with accounting software, you have to see what is it going to do when you void the check. It makes a paper trail, but usually it voids the check basically in the date that you entered the check. So some software will kind of help you out and try to say, hey, look, do you want us to make a journal entry so that it doesn't mess up the retained earnings for the prior period? And it might try to do that for you, which means it'll do what we're showing here automatically, or it might not. So that's what you have to kind of determine, like, what software are you working with. So the problem is here, we're going to say, all right, if I void the check, what's going to happen? Then the cash is going to go back up because the check isn't going to clear. But the other side now is going to be going into the office supplies expense. But that's a problem because we already closed out the office supplies expense last year to the retained earnings. And if we're in an income tax system like in the United States, then we would have written off the 2000 as an expense last year, right? So we wrote off an expense. So you would think you'd have to kind of add it back like in the current year. So if I say plus, we're going to say 2000, there it is. So we're going to go, this is going to be 0. Let's actually represent it this way. You see it's right here, but really it's going into the income statement last year. So it's going to mess up basically the equity. So it's actually going into the equity. So I'll put it right here. I'm going to say it's going to be plus the 2000. So then if I put my zeros in, I'm going to say 0, 0, 0, 0, 0, doot, doot, doot. Okay, boom, boom. And then let's put our balance. So I'll put this equals the sum of these two. Copy that across. Control C, and then paste just the formulas. And then paste the formulas and paste the formulas. And then I'll put an underline under these. Underline, underline, and underline. Okay, so most software is going to reverse it to office supplies, but it would have reversed it to the office supplies in the prior period, prior year or month. Let's say it was in the prior year. Well, that means that in the current year, it's messed up the retained earnings. So that means that, like, if I was trying to do financial statements from year to year, my statement of retained earnings will not match out, which is a common problem when you do tax preparation, especially if you're forced to do a balance sheet. If you're not forced to do a balance sheet on the income on a taxes in the United States, it's gonna be a problem because you're gonna mess up the deduction, right? Because you might deduct it twice or not deduct it because your retained earnings is messed up, right? You're not properly flowing over the retained earnings from one period to the next, because as of the end of last period, the retained earnings should be 48,000, and now because I deleted the check, as of the beginning, at the end of last period or the beginning of this period, it's now at 50,000, and that, again, very common problem for tax preparation for small businesses in particular, as they try to clean up kind of prior year books and to have these prior period transactions. So how do we kind of fix that? So we could do a journal entry, so to not mess up prior year. So what we're going to do is I'm going to say, okay, I'm going to let the software just remove it like that. Let's just keep the same number. I'm going to let the software remove it, but then I'm going to put it back on the books. So I'm going to say, then I'll put it back on the books here and reverse that transaction. So I'll say 2000 is going to reverse it, and we'll put it back in the cash of the 2000. Okay. Let's copy this down before I go to any further. copying this down, copying this down, and then copying this down. Okay, there's that transaction. And then I should, before I do this, I should do a balance. So let's cut this and put that here. And then I'll format paint this up here and put the balance again, sum. Well, wait a sec. Let's not do that. Let's not do it that way. I'll just copy it down like this. Boom, boom, and boom. We'll put an underline here. Okay. So so now the journal entry not to mess up the prior period. So that's going to be here. So there's the 2000 and the 2000. Let's add our zeros across. Zeros. Okay. So now we've reversed it. Now again, you might say, well, why would I do it that way? Because now I voided it and I just reversed the exact transaction I did to void it because of the paper trail. We want to void it, and that takes it out as of the day it was written, which will put it into the income statement, but for the prior year, which was already closed. So in essence, we're going to reverse that as of that same date in the prior year. So our retained earnings is back to where it should be. So now I'm going to say, let's show that by doing a balance. Let's do this again. And then we'll do the balance here equals the sum of these two. Copy that, paste it across, paste it across, and then we'll paste it across this way, and then we'll put some underlines in here. Oh wait, not italics. Underline, and then underline, and then underline, and then let's copy this down, copy this down to doot, copy this down to doot, copy this down to doot, and then underlines here. All right, so that puts, and then we'll do a journal entry to record it in the current year. So journal entry to adjust income statement in current year. So then we'll record it again, which is going to add it back the 200 here, or 2000. But then when I go over here, it's not going to go to retained earnings. Retained earnings now is correct because it reflects what the retained earnings was last year. And I'm going to go to the income statement as of the current year, having sorry, I just sneezed there. A 2000 kind of going the wrong way on the income statement, because remember, the office supplies, usually all expenses only go in one direction, decreasing retained earnings, right? But in this case, it's going in the other direction. Why? Because it's basically kind of acting as income on the income statement, which makes sense if you think about it from an income tax perspective in the United States, because expenses are good for taxes. We got a deduction of expenses last year that wasn't legitimate because we didn't actually pay the 2000 because the check didn't clear. That means we, in essence, should be recording income this year in order to correct it. Otherwise, we'd have to go back to the prior year and adjust our taxes. And we don't want to go to the prior year and adjust it. What we want to do is say, hey, look, that was just an uncleared check. I'll fix it this year. And instead of adjusting the retained earnings, which would not hit the income statement at all, we have to have an increase or going the other way on the expense account so that it basically acts like income. So it's going to increase our income from a tax perspective. That would be kind of bad, right? So that's the idea. Now, again, if you do accounting from a bookkeeping textbook, sometimes it's harder to see these little wrinkles that come into play. But when you get into tax practice, this rollover of retained earnings issue and prior period adjustments will be important oftentimes. Let's put an underline here, and here, and then here, and then we'll put a balance again. So I'm going to say then the balance is going to be equals the sum. Oh no, que paso. We'll copy that and paste just the formulas, and formulas. Right, so now you've got the you've voided the check, and you've made the and you didn't mess up the retained earnings. Retained earnings is proper, and we've got the adjustment happening in the current year rather than messing up the last year. So again, some software will do that for you when you void a check, but the same principle happens for any prior period adjustment, which often comes up anytime you're looking at a subledger and trying to fix it to reconcile it to the general ledger or deal with the fact that it doesn't line up to reality, such as with accounts receivable, adjusting information by customer, accounts payable that has the who you owe money to, inventory subledgers. All of those have a similar kind of problem where if you just go in and start deleting stuff, you're going to mess up your retained earnings. And so that's where you want to, so you have the similar kind of issues going to come into play. You have to figure out, what did the transaction do? Did it impact the income statement last year? If it did, or whenever it was recorded, how can I make the adjustment so it doesn't mess up the retained earnings, which might involve voiding the transaction or reversing the transaction with a journal entry, possibly doing it to, doing 2 journal entries to reverse it and then record it basically in, the current period would be the general idea. All right, so that's going to be the idea. Now, if you didn't void the check, notice you could say, well, why would I do this 2-method transaction? I could simply do it in the current period where I increase. Why didn't I just do this transaction in the beginning as of the current period? I record it as an increase to the expense account in the current period rather than in the prior period, and then an adjustment to cash in the current period. And again, the reason for this particular transaction is because of the audit trail. If you did that, you're not going to see in the prior year that check was actually voided. What we want to be able to see is in the prior year, hey, look, this is the transaction. Here's the error right next to it because it wasn't legitimate, so I reversed it in the prior year, which is what the voiding of the check does. But the voiding of the check that means that we recorded it in the prior period. It'll record it so then we have to reverse it again to get the retained earnings correct, and then record it with a journal entry in the current period. Also note that when you do this transaction, it's going to result in 3 hits to the cash account, which will impact your bank reconciliation. So when I go to the bank reconciliation now, I'd like to get this thing off the book. So I had it on the bank rec. Now I want to get it off the bank rec. How do I do that? Well, when I voided it, then I would have the 2 items that I could match up against each other to void the check. So we had then this original check, and then we voided the check. So those 2 should cancel out, which the software will probably pick up automatically. And then you've got these other 2 that we entered with a journal entry, which will be easy to identify, and we can check both of them off because they were entered with a journal entry. Your other option possibly is to use like a clearing account to enter these 2 transactions so it doesn't hit the bank rec. But I think it's easiest just to recognize that you voided it, and then when you do the bank reconciliation, if you check both of those off, they will cancel each other off and you'll be able to clear them off of the bank reconciliation. All right, let's copy this down. And hopefully I've got everything settled up here. Copy down, settle it up. So now we're at 50,000 once again. And that's interesting. We're back to kind of, because we voided everything else. That makes sense. All right, let's say review. Do a quick spell checky. Depreciation, ignore all of those. Miscellaneous, I should put a period. Okay. Okay, I'm cool with that. All right, looks good. Accounting equation and Excel. Invoice form. Get ready and some coffee because we're getting down to the accounting foundation, the accounting equation with Excel. Here we are in Excel. If you don't have access to this workbook, that's okay because we basically built this from a blank worksheet but started in a prior presentation. So if you want to build this entire worksheet from a blank sheet, you may want to begin back there, or you could just construct your own worksheet as you go, or possibly just use paper and pencil. But if you do have access to this workbook though, there's currently 3 tabs down below. Example, practice blank. Example, in essence, the answer key. The practice tab having pre-formatted cells so you can practice the practice problem with less Excel formatting. The blank tab, the one we will be working on, is where we started with a blank worksheet, but basically working with a template at this time, adding to the template as needed. Let's go to the example tab to get an idea of what we will be doing, where we will be going. Once again, recording transactions with the accounting equation, this time focusing in on the invoice form. The invoice form being the typical form used when we make a sale on account. That's typically how you might hear it in a textbook, for example, remembering the difference between working within a textbook problem and working in a real life situation, and possibly with the use of accounting software. When you're using a textbook, we got to make sure that we understand the terminology that is used to indicate certain types of transactions, which is going to be a different indication tool than in actual practice, when we'll typically be driven by forms and data input types of fields. So from a textbook standpoint, if we say that we make a sale, the typical 2 formats of sales could be we made a sale and collected cash at the same point in time, or we made a sale on account, we did the work, for example, in a service type of industry, and they're going to pay us at some future point in time, which some books will say we made a sale on account. The form typically used to indicate a sale made on account is an invoice type form. Remembering though, the invoice, like a bill, can be used interchangeably and like normal talking, even in an accounting situation, but is more specific when we use those forms as a data input sheet. So in other words, when we say invoice, you got to think about what side of the transaction are we on? What side of the table are we on? Because there's going to be 2 different companies possibly that are recording transactions. The person that is making the sale, doing the work, for example, and the person that is paying for the goods or services. So when we use the term invoice, we're talking about the side of the table when we did the work, we did the goods or services for somebody else and are sending out the invoice, which could be interchangeably called sending out a bill in normal type of language. The recipient then is the one that would receive what we would call a bill, even though it might say invoice on it, because when we made it, it was an invoice to us. And so they're going to be the recipient would be calling it a bill. So from a data input standpoint, however, that's what's really important in terms of recording items within accounting software. So it's even more specific, the terminology. When I say invoice from an accounting software situation, I'm talking about the data input field, the form used for data input. Even if we don't give that form to anybody else, it's the form that's going to be used to record an increase in accounts receivable in essence. And accounts receivable is going to be a type of asset that's not cash. It's something that we want to collect in the future. It is by definition an accrual type of account. So remember that if you're in certain types of businesses, you might want to be on a cash-based system. That's great. But some types of businesses are going to force you to do accrual type of things. And if you have to do the work first and invoice the client, that's going to be driven just by the type of industry you're in, right? It is what it is. That means you're going to have to track the accounts receivable, and accounts receivable is an accrual type of component because that results in recording revenue when we do the work, not when we received the cash. So we'll see how that plays out, and then we'll add a little bit more complexity when we have to deal with inventory when we have an invoice. All right, let's go to the blank tab and let's enter a transaction. Now I'm going to start off with our base transaction here, but it looks a little bit different. The $50,000 of the original investment, I'm going to assume is broken out 40% cash and 60% for inventory. So instead of having the whole $50,000 in cash, we broke out $30,000, which is the beginning inventory that we'll start off with, which will be relevant when we make the sale of inventory, so we can have a decrease of inventory. Owner's equity is still the $50,000, and then we have our subledger over here tracking the units of the inventory, which is what we want to have on the books when we deal with an invoice with inventory. So we'll talk more about that later, but let's start off with a transaction that doesn't have inventory, and this will be the baseline basic transaction, possibly more common for businesses that do invoicing, because the typical industries you need to invoice for are those where you do the work first and then you have to bill the client for the work done. And that might be like almost like a job cost system for service businesses, landscaping, accounting, lawyer work, and that kind of thing. So let's have a service invoice. So we're going to send out an invoice, the bill to the client, but we're thinking of it on, and it makes sale on account. That would be the terminology you might see in a textbook, meaning we did work and now we're looking to get paid for the work done. So we're sending out the bill, which we're calling the invoice. Okay, so our typical questions would be, is cash affected? Because that's the easiest thing to first think about. And answer here, no, cash isn't affected. So what are we getting instead of cash? We're still getting an asset. We're getting an IOU. So we did work. We're getting an IOU that we're recording right now that still has value. So I'm going to say it's still going to be an increase to assets. Now you might say, why does it have value if I don't have cash yet? One reason would be, wait, we have a contract. We did work, even if it's just a verbal contract. And you would think that if they default on the contract, we have at least some recourse, possibly selling the accounts receivable to a collection agency or something like that. So it's not as good as having cash, but we already did the work and have a claim to that cash. Therefore, it's still basically an asset. The other side then is going to be on the revenue side over here. We're going to call it sales. That's what our revenue account's going to be. So I'm going to say equals the sales account is going to be going up. Notice that we're recording revenue not on a cash basis here because we haven't collected the cash, but on an accrual basis, which is actually kind of more accurate in the sense that we already did the work, meaning the cash basis can distort our bookkeeping by distorting the time difference between when we do the work and when we receive the cash. On the expense side, when we get the goods or services and when we pay the cash. Whereas if we're on this accrual basis, we did the work. That's really when we should have the earnings recorded because that's when it has been earned. So that's going to be the general idea. So cash-based system is easier typically, but the accrual system is usually thought of to be kind of more accurate in that timing sense. And if we have to track accounts receivable, we have to use an accrual component because we need this accounts receivable and the related subsidiary ledger, which will help us to track who owes us the money, allowing us to follow up to make sure that we get paid. So let's put some zeros across this thing. 0, 0, 0, 0, 0, 0, 0, 0, 0, 0, 0, 0, 0, 0, 0. Then I'm going to go to the subledger over here. And this is what the accounts receivable subledger. I'm just going to call this person A. So this is going to be customer A, right? I know it's very generic, but that's going to be customer A. So I need to track this information also by customer for the subledger. This will often be done automatically in accounting software. So the total is going to be this plus this. So we have a total matching what's in the GL, 1,600, and broken out by customer, of which we only have one right now that owes us the money of the full 1,600. All right, let's sum this thing up. I'm going to say this equals the sum of these two. So we don't have cash yet, so I'm going to say copy that. Let's copy this across. Accounts receivable now going up to 1,600. Our inventory is at the 30,000. Let's paste it here, formulas only. And then we'll paste it across here. The income statement affected, formulas only. Remembering the whole income statement is really part of equity. So what would be reported on the balance sheet under owner's equity would actually be the 51,600, right? Because revenue would increase it. Net income would increase, revenue then increase it. And on the income statement, we would just have the 1,600, no expenses currently recorded for that. Let's copy this down. Let's put this as the balance. And that's not right. Balance. You have to spell it right. And then I'll copy this down. And then we'll copy this down. And copy this down. So now we're back in balance here. If I was to liquidate the company, what would happen? Well, now we've got cash of the 20,000, we've got accounts receivable. Notice if I liquidated the company, I'd have to collect on the 1,600 still in order to get the cash to put it back in my bank account. We have inventory of 30,000. If I liquidated the company, I'd have to sell the inventory for at least the cost of 30,000 to get the money to then close up the company, right? And this 1,600 has already been earned, but not collected. It's sitting in accounts receivable. So note, this is a common scenario, and it's often useful to think about the liquidation process to get an idea of what the bookkeeping is doing. I have assets of 51,600, but I can't just liquidate and take that money because, of course, I'd still have to go through the process of collecting on the receivables, and maybe I did business with deadbeats that aren't going to pay me, in which case I'm going to eat the loss, right? And I'd still have to sell the inventory, in which case if I'm liquidating, I might not be able to do that, which is why I'm liquidating, right? So that's why we have to be careful on valuing the company. That's the equity now represents the book value of the company, but it's not all cash. You can't just easily take out the equity, which is something we have to keep in mind. All right, so then let's try another one on 415. Let's say we sold inventory. So invoice for the sale of inventory. So now we're going to say we're invoicing someone for inventory that we sold. Now, if we sold inventory, oftentimes, then you're going to get paid at the same point in time. Like if you're in a store, someone's going to give you some form of payment, check, credit card, debit card, cash for the payment, and you will not be invoicing, but have what you might call a sales receipt type of transaction. And if you're doing online sales, often it works the same way if you're selling to an end customer, meaning they pay you on your website, for example, and then you ship them the goods. But it could work the other way around, meaning if the purchaser has more leverage, then it might be the case that they request the inventory and then you ship them the inventory with basically the invoice in the box, right? They check it, see that everything is lined up, and then pay it, right? So you still could have that situation. And we want to practice with inventory because inventory makes the data input process more complex. So let's say we had a sales price of whatever we're selling, inventory items, that is, of 2,500. So then what we need to record this is still going to be the cost of the inventory, and then we could have sales tax that's going to be an issue. Let's say the sales tax is 0.05. Let's percentify that 5%. So if we have sales tax, the way the sales tax works is that, and this would be a usage tax, which might be a primary tax if you're outside of the United States. For many federal taxes in the United States, we have an income tax as the federal tax, and the state taxes could use a form of sales tax, which would be a form of usage tax. The idea being we're going to increase the price of the goods that we're selling, but the money isn't going to us in theory. It's going to the government. We're being made into the government's little collection person, right? So so we have to collect on their behalf. So the theory is the tax is actually on the customer, not on the business. In economic terms, you might question that and say, who's really paying for the tax? It's kind of hard to tell, but that's the idea. So that means that when I collect on the accounts receivable, we're not only collecting the 2,500, we're collecting the 2,500 plus the 5% tax. So how would we calculate that? It would be something like 2,500 plus 2,500 times the 5% sales tax. So we're going to have to collect, the receivable is going to be for $2,625. So then on the other side of things, we've got then the sales side. The sales side is going to record the other side, but it's only going to record the amount that we have claim to, the 2,500. You could say, why don't I record the entire amount and then record sales tax expense? The reason, it's not supposed to be an expense of the company. We're just the collection person. Therefore, that other amount is off income statement. It never hits the income statement. Instead, if we do it properly, and software will help us to do the sales tax and usage tax, it should increase the payable account, never hitting the income statement. So I'm going to say that the difference here is going to be on the sales tax payable, which will be 2,500 times 5%. So I can imagine that as like 1/2 of the transaction, right? So now I've got 2,625, and then these two add up to, on the liability and equity side, 2,625. So we're in balance now, but we're not done, because we also have the cost that we need to deal with. So that's in our subledger, comes into play over here. Now, remember, if we have inventory, you have a bunch of questions with software that you need to really keep in mind, because these are areas as a bookkeeper that you can specialize in or stay away from, because they're not what you're specializing in. So in other words, if you sell inventory, are you tracking the inventory inside accounting software? Does the software do the calculations for you and help calculate the sales tax and all that kind of stuff? Or maybe you calculate the inventory outside the software for your accounting, and on like your website software, like your Shopify store or something like that, or possibly in an Excel worksheet, adjusting your software on a periodic basis type of system. Also, you have to think about, are you buying inventory specifically for custom jobs, in which case you're applying exactly the inventory that you purchased to the sales? Or do you have a bunch of inventory that you're buying, like a Shopify store or something, and then you're selling them as people buy them? You don't know, you're not identifying each specific piece of inventory that you're selling. You're using a flow assumption, like first in, first out, last in, first out, weighted average. We're not going to get into that in detail here, but just keep those in mind. We're going to say here we have inventory of $30,000 on the books. We need a subledger tracking that in some way, shape, or form by units, not by dollar amount. So we got divided by $10 a unit. That's going to give us the unit of 30,000 units. So now I'm going to imagine that we sold, what did we sell here? We sold over here the dollar amount. I'll say the dollar amount that we sold was inventory sales price. Wait a sec. I'm going to say that we sold, hold on. Let me put it over here. I'm kind of doing it backwards, but let's say we sold $2,000 worth. And I'm going to put that over here. This equals the 2,000. So how many units would that be? If I say they all cost $10, which I'm assuming all units cost $10, and that, again, would be more complex with a flow assumption. 2,000 over 10, so we sold 200. Usually that would be the other way around, right? We would say we sold 200 items. The cost was $10, which would not be on the invoice. Only the sales price would be on the invoice. But if we're doing a perpetual inventory system, this would be recorded at the same time. And then the total units then are going to be, let's actually make this a negative. We'll do it this way. Let's make this a negative. And then now we have the units, which are going to be this plus this. So we had 3,000 units. We sold 200, 2,800. So if all of those still cost $10, we're currently at $28,000 amount of inventory, which should match what's on our books over here, which it doesn't yet until we record the second part of the transaction. So now I'm going to say the inventory, let's record this in the same area, is going to go down by that 2,000. You can think of this as another transaction, like entirely, but it's all part of the same thing if you're doing a perpetual inventory system, meaning when you enter the invoice, all of this will be recorded at the same time. However, this 2,000 cost component will not be on the invoice and possibly not part of the data input because you will have already done that information like kind of behind the scenes. So it's similar to when you check something out at a grocery store, you see the sales price and the units, but you don't see the cost of goods sold. However, the system knows the cost and is recording that automatically, applying the proper cost flow assumption to do this side of the transaction. So this whole back end of the transaction, again, is something you got to think about. Do you want to deal with setting that up within a software system, or do you want to do that in some other format using a periodic inventory system, making adjustments to inventory on a periodic basis? Okay, so we're going to say that the inventory is going to go down by the 2,000, and then the other side is going to be cost of goods sold, which is going to be an expense of the 2,000. So note, now the cost of goods sold is representing an expense, but it's not being recorded at the point in time that we purchased something for cash, because when we purchased the inventory for cash, we typically put it on the books as an asset. We're recording the expense when we consumed an asset, that asset being inventory. We sold the inventory, we consumed the inventory, we gave away the inventory in the process of generating revenue, and that's why it's going to be an expense at that point in time, which again is an accrual component because we're recording the expense at the point in time we consumed it to generate revenue, not the point in time that we paid for that expense. And we're recording the sale on the point in time that we invoiced or shipped the goods, not the point in time that we actually got paid on that side. All right, so let's put our zeros across this thing. 0, 0, 0, 0. Oh, not there. That scared me. It's okay. You have an undo button. You don't need to. You don't need to have a heart attack. I ruined it. No. Okay, let's add a subledger. I also need to add a subledger because now we have an invoice out for B as well. So I'm going to put another column here, selecting this column, right click and insert. And I'm just going to call this B customer. And I'm going to say B customer now owes us 2,500. Let's just say they owe us this amount plus the sales tax. So there's B customer. So our total subledger, breaking out what people owe us by customer, is now the 1,600 plus the sum of these two. I'll just copy those two. This is my running balance. So now we have a total of 4,225 that should tie out to our subledger once I copy that down, which is representing two customers in our subledger that owe us 1,600 and 2,625 respectively, which we'd have to follow up on and make sure that they pay us. Okay. Let's go back on over here and let's put some underlines under this. Underline, underline, and then underline. And let's copy that down over here to see that. Let's just copy this down to this, make sure we're in balance. So now we're, this transaction is in balance. Okay, now let's sum this thing up. This is our last balance, and this is going to be our next balance. So I'll say this is going to be our balance now, which is going to be, let's do it down here, equals the sum of the last balance and then that row that we were on, which I know is a little spacey and kind of weird, but I think it makes sense. Let's paste formulas, and let's paste formulas, and let's paste formulas. Okay. And then I'll get rid of the underlines here because that's not where the underlines should be. Removing the underlines. Okay. So let's copy this down over here as well. I'll just copy this all the way down to here. All right. Copy this down to here. Copy this down to here. Does that put us back in balance? Yes. So 52,225 liabilities of the sales tax payable and the equity. So where do we stand now? We've got cash of 20,000. There's our accounts receivable, 4,225. It's an asset, but we're hoping to collect to convert it to cash later. How do we collect? We go to the customers that we sent invoices to. That would be given by our subledger over here. There's the 4,225, but who do we collect on? Customer A, customer B. This subledger will typically be tracked within software like a QuickBooks, often forcing you to make the subledger by every time you record something to accounts receivable, requiring a customer name so it can generate the subledger. However, if there's a problem with the subledger, then that becomes an issue, right? That could be messy. And then, so that's that. And so we have that. And then we've got the inventory, which also will have a subledger, sometimes tracked within the software, sometimes tracked outside the software, sometimes being done on a perpetual inventory system, being adjusted every time you make a sale with either an invoice or a sales receipt types form, or sometimes being on a periodic system where it's not being adjusted every time you record a sale, but rather you do a physical count. You make the adjustment periodically based on your external worksheet, which you might do in Excel, or possibly using accounting software or whatever other thing you're using, like a Shopify or whatever you're doing. So that then, here's our subledger here, showing us the units that we have and the dollar. So here's the units we have, representing a dollar value of 28,000. Remembering that this becomes much more complex when you have multiple different units of inventory that you're tracking, right? Because then you're gonna have to track all of the different types of inventory that you have, and so on and so forth, which again becomes complex, and you have to think about how you're going to deal with the inventory. But basic bottom line, subledger in some way, shape, or form should be tracking not only the unit, not only the dollar amount, but the units, so that we can tie out to what should be physically present in some warehouse or something, right? And so that ties out here. That makes sense. We've got the sales tax payable. This is money that we have not yet collected, but will collect when we collect on the invoice. This is money that isn't ours, therefore wasn't recorded into revenue, but is off income statement because we're just being made into the government's little collection person, right? So we have to put it here on the balance sheet, and then when we pay it to the government on behalf of the person who in theory paid the tax, the customer, this will go down and will decrease the cash. So then we have the equity. So the equity has not been impacted yet when you look at a trial balance, but total equity on the balance sheet would include all of this, which adds up to 52,100. And on the income statement, we would be breaking out one period, month or year typically, of activity, which in this case represents sales, revenue, invoices sent, even though cash has not yet been collected, of 4,100, cost of goods sold, 2,000, bringing it down, net income therefore at 2,100, which would roll into the balance sheet being part of equity in the closing process, which is often done by software automatically, showing on the balance sheet 52,100, or possibly in some software like a QuickBooks or a Xero, showing the line item on the balance sheet of net income of this 2,100. which is done on a yearly basis. So those softwares typically do things on a yearly basis. They don't kind of roll over on a monthly basis. All right, so there's that one. Okay. Accounting equation and Excel. Receive payment form. Get ready and some coffee because we're learning the accounting foundation, the accounting equation in Excel. Here we are in Excel. If you don't have access to this workbook, that's okay because we basically built this from a blank worksheet but started in a prior presentation. So if you want to build this entire worksheet from a blank sheet, you might want to begin back there or just create your own worksheet as we move forward from here, or possibly just follow along with good old paper and pencil. If you do have access to this workbook though, there's currently 3 tabs down below. Example, practice blank, example, in essence, the answer key. The practice tab having pre-formatted cells so you could practice the practice problem with less Excel formatting. The blank tab is where we started with a blank sheet, but now working in essence with our template, adding to the template as needed as we go. Let's go to the example tab to get an idea of what we will be doing this time. We're looking at a receive payment form. Now that's the terminology often used in accounting software such as QuickBooks to record a transaction for a receipt of a payment from a customer on account. In other words, it's a transaction where we did work or services, goods or services in the past, invoiced the client, increase in the IOU account, accounts receivable, and now are receiving payment on that. Remembering one of the major components and difficulties today is the terminology. So if you're working in a textbook, they have to somehow tell you without basically the data input form what the transaction will be. And it might be a term such as you're receiving payment on account, meaning you're getting cash for work that you're not doing today, for inventory that you didn't provide today, but rather you did that before and now you're receiving the payment for the work that you had done in the past. If we're talking about software situation, then we typically have data input forms that drive a particular transaction. Remembering that the invoice form is the form that we typically label when doing data input as the form used when we do good work, goods or services provided, but have not received cash at the same point in time. We didn't do the work at the cash register, but rather we did services, for example, like accounting, billed the client, which is termed as an invoice with our data input form, sending out the invoice or bill to the client. That increases the accounts receivable. Then we have to record the receipt of the payment, which is typically called a receive payment form. Noting that doesn't tie into anything that we actually see that we send out to the customer. We might give them like a receipt or something like that, but really the form is the name of the data input field, which means that we're receiving some form of payment, cash, credit card, electronic transfer, whatever, for goods and services that were provided in the past, and we need to show the link between the invoice and the receive payment form, which is often something that software does above and beyond even the double entry accounting system. So that's what we're touching in on here. Let's go to the blank tab, and we're starting off with that same 20,000 of cash, inventory of 30,000, and owner's equity of 50,000 with inventory on the books then of 30,000 in our subledger. We're going to say it was 10 units for the account for that 30,000. Okay. All right, let's get back on over here. Let's say this is happening on, let's say 3/15. We'll just pick a random date and let's enter an invoice. So invoice for service done. So this is where did work like a bookkeeper or like a law firm, like a landscaper, and we invoice the client, which you could call a bill, but for accounting software, we typically call that data input form an invoice. So 1,600 invoice. We didn't get cash. What's the transaction? We got something, we got an IOU that we should have some legal recourse to collect on, therefore justifying that we put it on the books as an asset, even though it's just an IOU. The other side recording the revenue at the point in time we did the work under an accrual basis, noting that we have to deviate from a cash-based system because we are needing to track the accounts receivable. So we're going to say, okay, there's our revenue goes up. We saw this in a prior presentation, so I'm doing it more quickly here. Let's put zeros across the board to the rest of these items. And so 0, 0, 0. Okay, let's also add it to our accounts receivable, tracking who owes us the money by customer. Subledger that we need here because of this accrual account of accounts receivable. This is, I'm going to say this is customer A, which is going up by the 1,600 as well. So our total now is the prior total, which was 0, plus the sum of all of our customers. It comes out to 1,600. The subledger should match what is on the general ledger over here. That subledger transaction typically done by software automatically if we have properly set up the data input field to create an invoice. So let's sum this up, equals the sum of these two transactions, boom, or the two items. Let's copy that across. So here's our total, pasting formulas only. So here's our new balance that we would build our financial statements from at this point in time. So there we have it. So now we have the income statement has revenue in it, and that would close into the equity account. Equity would be at the 51,600, but it's not all cash because now we have accounts receivable and the inventory. Let's copy down in our formula to the transactions. So we're going to copy this down. So this is the transaction. Assets went up, equity went up, and then the total is here. Let's put an underline under these, underline, and we'll put this as the balance. Balance. All right. And so now let's say time passed, 325, we received payment. Now, when we receive payment, it used to be that you would expect to receive a check in the mail, possibly, and then you would record that, finding the subledger that paid you the check and mark it off. Some of this might be done electronically now. It depends how sophisticated your accounting system is. If it's done electronically, then the system might be able to record the transaction basically automatically, although oftentimes you'll still have to kind of track it. Either way, however, we want to know what the transaction will be, so if there's a problem, we can drill down on it. So we still need to have an understanding of what is happening to deal with problems in the process. So we're going to say that we receive payment on account. Note when I say receive payment on account, that's what a textbook might say, because when you might say I received a check for work done in the past, right? I received money, some type of payment, not for goods or services provided today, but for goods and services provided in the past. When we think about this in terms of a data input, typical terminology for software such as QuickBooks is a data input form. When you think of forms normally, you think of something that you're going to give to a client or a customer or a vendor oftentimes. But we're talking about a data input form here, meaning this is the field that you use to do the data input. That's why we call it a data input form. And if it's a receive payment data input form, that means that your some kind of cash or some payment is going up, and the other side is going to decrease the accounts receivable. So this is going to be for the 1,600. So did we receive cash? We're going to say yes, we got cash here. Now, note that if you're thinking about a QuickBooks type of system, accounting software, we still have to account for the idea that we might not have put it into the checking account yet, because we might have a grouping situation where we got multiple payments that are going to go into the checking account as one lump sum, such as could happen with credit card payments and so on. So that's why we have this undeposited funds account. But we got some form of payment. I'm going to just put it into cash with our transaction right now. So we're going to say it's going to increase the checking account 1,600, and then the other side is going to be going in to accounts receivable negative 1,600. So we're on the same side of the accounting equation. It went up and then went back down. Let's put zeros across the board for the rest of it. Nothing's happening here. Nothing's happening to the income statement, even though we got cash, because we already recorded the revenue when we did the work. What about the subledger? The subledger needs to go back down because they have now paid us. So I'm going to say this is going to be negative of the 1,600. And so now our total in the subledger is going to be equal to the prior balance plus the current activity, sum of these two items, and close that up, and boom, it's back down to zero. So now our subledger is reflected that this A has now paid us. We billed and now it's been paid. So the subledger now matches what should be on our ledger. Let's then put the balance here. So the balance is going to be the sum of these two. Checking account goes up. So now we finally got the money. That's good. Accounts receivable goes down. No impact on total assets, but we got like a better asset, right? Let's get rid of the underlines. So we lost the receivable, but now we have a better asset. We have cash. Let's put a format paint here and put the underline, and then I'm going to format paint here and get rid of the underline. Not put the underline, get rid of the underline because it shouldn't be there. All right, so there we have it. And so now if I copy this down, copy these down to there, copy this down to there, copy this down to here. We put an underline here, home tab, font group, underline. Notice zeros across the board because both the transactions, both of the accounts impacted were in the assets, but we received kind of like a better asset. We got the cash, which we would rather have than an IOU for someone that owes us the money. All right, let's do another one. Let's say on, let's make this one on 410. Now on this one, I'm going to add the added complexity of this undeposited funds, which is often in the works when you have to deal with the real world, because you have to be able to reconcile the bank accounts, which also takes into consideration bank feeds. If you're dealing with that in an accounting scenario situation, bank feeds are useful, great, can simplify the process, but also they don't make everything seamless. You have to figure out how it's going to work. So let's say now we invoice for service, invoice B. Let's say we're going to invoice B client for service done. So we're sending out another invoice. We did services, we did our bookkeeping, our law firm services, or whatever it is. We enter the invoice to bill the client. So is cash affected? No. Instead, accounts receivable is going up. What's the other side? It's going to be revenue because we did the work and we earned it. Therefore, income is going to be the other side. On the equity side of things, on the income statement, sales or revenue. Let's put some zeros across the board. So 0, 0, tab, 0, 0, 0, 0, 0, 0, 0, 0, 0, 0, 0, 0, 0, 0, 0. Subledger is going up. Now we're going to say tracking B customer owes us money. So I'm going to track this in the subledger for B, 1,400. Therefore, our total in the subledger should match what's on the general ledger, our main account. That's going to be the prior amount, which is now 0, plus the sum of the current activity. So that should tie out to 1,400 once we add the balances. Let's do the balances, which is just going to be equal to the sum of the prior balance plus the current activity. Is that? I'm going to copy that and paste it across. Paste it 1, 2, 3. Paste it, not 1, 2, 3. Dang it. Undo. Paste the formulas. Formulas only. Paste the formulas. And then paste the formulas. Okay, so there is that. So let's copy this down. This is going to be the balance equals the balance. Copy this down, boom. Copy this down, boom. Copy this down, boom. Underline it, holding down Control to select the non-adjacent cells. Home tab, font group, underline. All right, so the transaction was an increase to assets, increase to equity, new balance, 53,000 assets, 53,000 in equity. So now let's say that we receive the payment on something like 415. So we receive the payment. However that happens, electronic transfer would be most likely how it might be happening these days, but we still have to receive that payment and record it against the receivable. You can see why that adds another issue even if you're doing electronic transfers, because I just can't record it to sales, which would be the easy thing to do. I have to make sure that it maps out and ties to the invoice, because I need to make sure that I'm tracking my subledger. And beyond that, it would be nice if the payment can be tied to a specific invoice, which is a step beyond what we can do in this kind of accounting system, double entry accounting system, that software is great at being able to do. We can track the payment to a particular invoice, tying that out. So we're going to say we receive payment on account, all right, of the 1,400. So same amount, we'll say it's the 1,400. So cash now is being received, but I'm not going to put it into the checking account. I'm going to put it into undeposited funds, which is often the workflow that you'll see in accounting systems. Now, if you invoice a client and you have an accounting system where they're going to pay you that exact amount in the future, possibly with an electronic transfer or something like that, then you can most likely just put it directly into the checking account, because that's the amount that will also match the bank statement, so that you can do bank reconciliations tying our books to the bank books. But if they're going to pay you with a credit card, then it becomes more of an issue. Or if they're paying you cash, it becomes more of an issue, because if they pay you with like a credit card, for example, the credit card company is not going to take that money and then deposit it into your checking account in the same dollar amount as each transaction that they received. They're going to process a bunch of transactions and deposit it into your account periodically, nightly, weekly, bi-weekly, monthly. So you're going to have to figure out that difference. One way to do that is to see if I record it into the checking account, but then the credit card company combines transactions together and records it, then it's going to be a problem, because I won't be able to tie out my books to the bank reconciliation and it will be a mess. How do we deal with that in practice? We take those accounts into a clearing account called undeposited funds, or deposits, amounts to be deposited, something that's basically an asset cash account, but not yet in our checking account, so that we can then group multiple transactions together, making sure that we put them in our checking account in the same dollar amount that will be on the bank statement, allowing us to do a bank reconciliation. All right, so we're going to say it's going to go into undeposited funds then, and then the other side is going to go into accounts receivable. So same type of transaction, except it doesn't yet go into the checking. Let's put zeros across the board. Zeros across the board. And then the subledger goes down just like it did before, because they have now paid us. B has paid us. So a negative of the 1,400. Our balance in the subledger is the prior balance plus the sum of the current activity. That's our running balance calculation. It's back down to 0. That makes sense. So now we're going to put our balance. Our balance is now the sum of the last balance plus the current activity. We will copy that, paste it across here, paste it formulas only, paste it formulas only, paste it formulas only. And let's put an underline under these ones. Underline, underline, and then underline, making it look fancy, pantsy. Put some pleats on those pants, making it fancy, pantsy. And then we'll copy this down. Copy this down. copy this down, and then holding down Control to select non-adjacent cells, putting an underline there. Okay, so now we have this money in undeposited funds. We're going to need one more transaction, taking it out of undeposited funds, putting it in the checking account. Now, in this case, we're not combining it with any other transaction. Therefore, even in software, we could have put it directly into the checking account because it would have matched. But if it was a credit card or cash that we were receiving or something that's going to be grouped together before going into the checking account, that's when we would need this undeposited funds, and you'd need to work it into your accounting system. So we want to highlight that here. So let's say on 4/15 at the end of the night, then we put this into the checking account. So we're going to say deposit to checking account. Okay, so now notice that when I use a deposit form, that's going to be the form typically used to make a deposit. Now, again, that sounds obvious because when you hear deposit, that usually triggers in our mind that we're going to the bank physically or something and putting money into the bank account, or that we're transferring money directly into, or something like that. It's a deposit into the account. But remember, from a software standpoint, deposit is the form used to increase the checking account. So it's the data input field used to increase the checking account. Also realize that in this last transaction, we didn't use, in essence, a deposit form to increase the checking account. We instead reused the receive payment form, which is a more specific form. You can think of it like a deposit form, but the receive payment form was a form that always is going to decrease the accounts receivable because it's a form that is tied to receiving payment on account from an invoice that was made in the past, designed to match the invoice so that we can link them together. Whereas a deposit form is a more universal form that is going to be used for any kind of deposit. Maybe when it came from the customer, which is going to be hopefully the largest number of deposits, but also if we put money into the account or if we took a loan out, those are all types of increases to the checking account that we might use a deposit form for. So note that sometimes in accounting software, it's useful to have this intermediary step in order to have all of our increases into the checking account be using the same form, the deposit form, which is another reason that you might use that intermediary just kind of like as a default all the time, even though it's kind of an added step. So in any case, let's do the deposit form. We're going to say this is going to be for the 1,400. So 1,400 deposit form is going to be increased to the checking account and just decrease the undeposited funds. So once again, just on the income statement, no impact on the accounting equation because basically it's just a transfer between two checking accounts. Let's put the zeros across the board. The board has zeros across it. And so here's our board and there are the zeros across it. And then we'll put a balance here, summing it up. Little darling, sum it up. Little darling. And so we'll paste the formulas. Paste the formulas. Paste the formulas. And then let's copy down these. Copy that. Or copy that down. Copy that down. Holding down Control for non-adjacent cells, so I can select them at the same time to underline at one time. So now we have the 53,000 in assets, which represents 23,000 cash, 30,000 of inventory, and we then have on the equity we've earned. We're saying the sales of the 3,000. So on the balance sheet, we would have equity of 53,000 in owner's equity, which would be equivalent to like retained earnings. And on the income statement, we just have the sales of the 3,000 for the time period being the month or year that we're currently in. Let's do a form, a spell check. Check the spelling. Ignore that. Perfecto, just like Mundo would do it. My friend Mundo, the perfectionist. Perfecto, just like Mundo would do it. Accounting equation using Excel. Deposit form. Get ready and some coffee because we're going to learn the accounting foundation, the accounting equation with Excel. Here we are in Excel. If you don't have access to this workbook, that's okay because we basically built this from a blank worksheet but started in a prior presentation. So if you want to build this entire worksheet from a blank sheet, you may want to begin back there, or you could just build your own sheet as we go from here, or possibly just follow along with good old paper and pencil. If you do have access to this workbook, though, there's 3 tabs down below. Example, practice, blank, example, in essence, answer key. The practice tab having pre-formatted cells so you can practice the practice problem with less Excel formatting. The blank tab is where we started with a blank worksheet, but basically are using a template at this point in time, adding to the template as needed as we go through the practice problems. Let's go to the example tab to get an idea of what we will be doing this time, looking at transactions related to a deposit form. A deposit form being the form that is used to increase the checking account typically. So again, we got to differentiate ourselves from transactional ideas that you might see, say, in a textbook to tell you what is happening in as few words as possible versus what might be done in accounting software versus normal day-to-day type of language. So if you're talking about a textbook, remember that you're usually going to be dealing with just cash as the account that's going to be going up, as opposed to a checking account and thinking deeply about the issue of bank reconciliations as we deposit something into cash, something that we want to keep in mind because it's a practical problem in real life. As we hit the checking account, we want to be able to do that in the same format as is done when the bank hits our checking account so that we can reconcile or possibly use our bank feeds more efficiently. Now, the other thing that's going to be an issue is that when we enter information into accounting software, we're going to use what we call the forms, the deposit form being the form used to increase a checking account or cash type of accounts. Typically, however, when we use deposit form in normal parlance and normal language, we kind of imagine that we're going to the bank, filling out a deposit form, and then making a physical deposit, which many people might say, I don't do that because I'm online now. I don't make physical deposits. Deposits forms are old news. I don't deal with that stuff anymore. But in the accounting software, the deposit form means the data input form that we record in order to increase a checking account. And you might say even that is outdated because I use electronic transfers to make the deposits. But still, even if you do it electronically, automating the system will typically name the form that's going to be generated automatically a deposit form. So we want to basically keep that in mind. So we're talking here about multiple levels in terms of the language of deposit form. What does it mean like when I actually make a deposit to the bank versus what does it mean in terms of a data input form when I put it into a software such as a QuickBooks? And from a textbook standpoint, what does it mean when they're trying to tell me that I need to increase the checking account? What is the book's language for telling me that, which is going to be different, of course, than kind of the real life situation. It's trying to approximate that. All right, so we're going to keep those in mind, remembering that increases to the checking account, when does that happen? Hopefully, in some process in our revenue cycle is going to be the normal deposits that are going to be going into our checking account, because increases in cash hopefully are coming from some types of sales that have happened. However, we could also have deposits from other sources such as the owners, us. Say the owner puts money in a sole proprietor, or if it was a corporation, the issuance of stocks from the corporation would be the similar way of getting money from the owners. Or you might take out a loan from the bank, for example, getting money into the checking account, not from customers, but from a loan. So that means that the deposit form is a form that we can't really automate as easily possibly as decreases to the checking account when you think about things like bank feeds, for example, because we have the issue of possible use of a deposit form for multiple things, and we often have this accrual issue that comes into play because if my accounting system deals with me having to invoice clients and then receive payment, I need to tie the deposit form to the invoices. That becomes an issue, as does inventory, because when I record some transactions, I might be dealing with inventory. All right, keeping those things in mind, let's go to the blank tab. We're starting out with just our normal 50,000 in the books, cash at 20,000, inventory at the 30,000 on the assets for the 50,000, the other side in equity for the initial investment. So now we're going to go say it's going to be 315, and we're going to say that we're making a sale on account, Now, so that's going to be my starting point. Now, remember, from a book standpoint, when I make a sale on account, then that's what a book might mean to say I sold something, but I didn't get cash at the time. Instead, I got an IOU, accounts receivable going up. In terms of forms, the form, as we saw earlier, would be an invoice type of form typically. Remember, in the invoice form from a data input standpoint being different than like an invoice paper form, right? The language of data input being more specific than even normal accounting language, like in an accounting office, where you might call it billing the client, for example. All right, so we're going to say accounts receivable is going to go up. I'm going to do this fairly fast because we've done it before. We've seen this. We've been there. We've done that. And then we're going to go back on over to the sales. Revenue is going to be going up. So I'm going to say equals and say there that is. I'm going to enter my zeros across the board. 0 tab, 0 tab, tab, 0 tab. Zeros across the board. The board has zeros across it as of now. I'm going to go into my AR subledger. Here's my AR subledger. I'm going to imagine this was customer A, just generic customer A, breaking out the receivable in the subledger by who owes us the money, 1,600 again. Running balance is going to equal what we had before plus the sum of the current activity between only two customers, A and B. Therefore, our subledger here tying into the general ledger of accounts receivable, breaking out who owes us the money, in this case, customer A. All right, let's go back on over and let's put the balance here. I'm going to do the balance, summing it up equals the SUM and sum it up, little darling. Sum it up. All right, we're going to right click, paste it, formulas only, so we don't mess up the beautiful color scheme that is helping us to understand the whole system in a way that is just amazingly efficient. And so we'll just paste it, formulas here. Okay. So then we'll copy this down. I'm going to copy this down. So our accounting equation assets went up by 1,600 to 51,600 total assets because the receivable went up. Nothing happened to the liabilities. Copying this down on the equity side, we had an increase of 1,600 to equity, even though we didn't get cash because we're on an accrual basis driven by the fact that we had to do the work first. I'm going to underline here. And then get the money later. That's the industry that we happen to be in. That's just the way it is, man. That's just the way it is. You know what I mean? All right. So now we're going to go to receive payment. Now, this is when the deposit form happens, when we have the receive payment. So now we're going to say that on 3/20, we receive payment. Receive payment on account. So when I say receive payment on account, that's what a textbook might say, to say I got money, not for work we did at the same time we got the money, but we did the work before. Therefore, instead of recording revenue at the point in time we got the money, right now we're going to be decreasing the accounts receivable instead. From a data input form perspective in accounting software, you might have a receive payment form, but that receipt, this is where it gets a little messy in the accounting software, right? Because if you're saying a deposit is usually the form that we think of using in a data input form to increase the checking account. And here we might have another form for many accounting softwares that use a receive payment form because they want to use a form that is going to be tied specifically to the accounts receivable. That's typically a receive payment form. Now you can use that form in accounting software in a similar way as a deposit and get that money, depositing it directly into the checking account. But sometimes you can't really do that because you might be receiving payments that are going to be grouped together, such as if you're receiving payments from like a credit card or something. You're not going to get it going directly into your checking account at, in this case, $1,600, but rather grouped with other received payments through the credit card by the credit card company. Then it's going to hit your bank account in some kind of lump sum. Therefore, you might put it into undeposited funds or some type of clearing account so that you can then move it from there into the checking account using a deposit form in that case, in the same grouping that will be found on the bank statements, allowing you to do a bank reconciliation more easily. So first, let's this time put it directly into the checking account. This would be something you can do in practice if, for example, you're getting electronic transfers, for example, and they just wire the money directly to you using, like, I don't know, a PayPal or some kind of electronic transfer that you might have set up through the accounting software. Given the fact that I'm not grouping it such as I would have to do in a credit card, I might just deposit it directly into the checking account using the receive payment form, which in this case is kind of equivalent to a deposit form, except that it has the special characteristic that it's always going to be decreasing the accounts receivable. So we're going to say the other side is going to be a decrease to the AR. Let's put our zeros across the board. 0, 0, 0, 0, 0, 0, 0, 0, 0, 0, 0. Okay, that's tedious, I know. And then in our subledger, we got paid now. So in column A for customer A, I'm now going to put negative of this 1,600. Remembering that we're doing this manually here in Excel. In accounting software, the subledger will typically be done for you if you set up the software properly and enter the proper form of a received payment, which can then be matched to the invoice, automatically creating the decrease to the subledger, applying that decrease to the proper customer. All right, so I'm going to say this is going to be this one minus the sum of this running balance back down to, oh, wait a second, equals this one plus the sum, because this is a negative number. All right, there we go. Back down to 0. All right, let's put the balance down here. Balance, summing it up. Here we go. Summing up the last two transactions from the last balance to the current activity and enter. We will copy that and paste it on down, formulas only. Paste it on down, formulas only. Paste it on down, formulas only. And then we'll copy it down to make sure that we are still in balance. Copying this down to give me the transaction, and so nothing happened here. Why? What do you mean nothing happened? I got cash. Yeah, but the other side was accounts receivable, which is already an asset. We didn't hit the equity because we hit the equity before when we actually did the work. So let's copy this down. Boom, boom. Copy this down. Boom, boom. No impact across the board, even though there was a transaction, because both sides were in the asset side of things. All right. Let's do another one, similar process, but this time we're going to take it through undeposited funds here first. So let's say this happened on 4/15, let's say 4/15, and I'm just going to say, once again, we had a sale on account. In other words, we issued an invoice for work that we did that we're not going to get paid for yet, but we're going to collect in the future. Let's call that 1,400. The invoice form being the form that will record the transaction that increased the asset of the IOU, accounts receivable, and then it's not really an IOU, it's a they owe us. They owe us because we're the ones that they owe the money to. Anyway, sales is going to go up then over here. So we're going to say the sales is going to be equal to the 1,400, and then we'll put that once again into our subledger. Let's say it was customer B this time, just to see how the subledger works. We have a separate customer breaking out who owes us the money, not by date when the transaction happened, but by customer. So the running balance, it was at 0 plus the sum of these two, close it up, back to, now it's at 1,400. That 1,400, of course, matches what's in our GL account or our accounts receivable. Let's put the zeros across the board to fill this thing out so we don't get confused with blank spaces across our worksheet. That gets confusing, and I don't like being confused. I try to I diligently work not to be confused. So I don't want those stupid blank spaces. Let's sum it up again. This is going to be equal to the sum of the prior balance and the current activity. Copying this, paste it across the board. Pasting it with the formulas only. Pasting it with the formulas only. Pasting it with the formulas only. And boom. All right, let's go back on over. That's what we have now. All right, so now we're going to say that we receive the payment, which is once again kind of where we use that receive payment form as like a deposit form, but this time we're not going to put it into the checking account directly, but rather into a clearing account like undeposited funds, an activity you don't typically see in accounting software. In accounting textbooks, because they kind of make it generic and don't really deal with the issue of having to reconcile the bank account and needing to make sure that your deposits are properly formatted to make that as easy as possible. But when you get into practice, it's important. People run into problems all the time. So I'm going to say that this is going to be 1,400. Let's just say receive payment 1,400. So now we're going to say, instead of putting it into the checking account, cash is affected, I'm putting it into the clearing account, taking that one added step, which would be important if it was paid by like a credit card and I needed to match it with other payments before the credit card issued the money into my checking account. Similarly with cash, you have a similar type of issue, or you might use this method just because I want to make sure the receive payment form is used as a receive payment to lower the accounts receivable, and therefore the deposit form can then be used to increase the checking account, making it easier to sort transactions for increases to the checking account because there won't be multiple form types in there. You can sort the documentation in accounting software, for example, simply by form, deposit form, possibly including transfers too, but we'll talk about that later. So then the accounts receivable is going to be going down, and let's put some zeros across the board again. Zeros across the board. Only things happening in the asset side of things. Nothing's happening to the revenue, even though we got paid. Why? Because we're not on a cash basis here. We're on an accrual basis, and we already recorded the revenue. And so I'm going to say that the subledger is going down for customer B. B's paid us. Good old B. Our customers are good customers. We don't have those deadbeats. They keep not paying us, taking our stuff. They take our stuff and then don't give nothing back, man. Bunch of leeches. Anyway, I did my part of the bargain, and then they just, that's not who we do business with, man. Our customers actually pay us. We're appreciated over here. We're appreciated. Okay. I got a little upset there. I don't know what happened. I'm going to put some underlines over here. Let's copy this down to the prior balance to here, and then we'll copy this one down to here. So now the last time, and then we'll copy this one down. And so we had an increase. Let's put some underlines under here. I should have done that before. And now we're going to have the new balance. So new balance is going to go, isn't that a product of some kind? The new balance, like a shoe or something? I don't know. New balance. That's not what I mean here. We're going to sum it up again, little darling. Summing it up, okay, little darling? Is that okay with you, little darling? Sum it up, little darling. All right, we're pasting it with just the formulae only. Just the formulae. All right. Okay. So now we can use a deposit. So now on 415, we're going to use an actual deposit. And it might be, well, we'll just call it a deposit. So again, this is something you don't really see in a book problem, but in practice, we see it all the time because now we have to transfer out of the undeposited funds putting it now into the checking account. In this case, we only had one deposit. Therefore, it's not really like grouping anything together. Therefore, we could have put the deposit directly into the checking account, but still it might have a purpose to do it this way, because now again, I can use a deposit form to make the deposit into the checking account, having all increases in the checking account using the same form, making it easier to sort by transaction type. All right, so the deposit's gonna be the 1,004, and let me copy this down before I do this. You're getting ahead of yourself. Don't get ahead of yourself. That's what I always say. But I hate waiting for myself because I'm so slow. You're so lame. I have to wait for you. Yeah, you can't get ahead of yourself. Why can't myself go faster? Okay. Let's sum this up now. We're going to sum it up. Here we go. Equals the sum of these two. And then we're going to, no, wait a sec. No, that's not right. That's not where I'm at. Now I'm going to say the checking account's going up. Checking account goes up. And then undeposited funds goes down. That's where I'm at. That's the two sides of the transaction. So once again, only impacts on the asset side of things. Let's put zeros across the board again. Zeros across the board. It's like a soccer game. You've got zeros across the board. Except for those 2 points, up top. All right, let's go up top and let's put, now notice that you can also freeze the panes. So I'm going to do this now. I'm going to put my cursor right here. It has to be right here. I've scrolled all the way up. I'm going to put my cursor here so I can see these headers even as I scroll down. So, and so I'm going to do that by going to the View tab and then freeze the pane. Freeze the pane. That's what I do when I've got gout in my foot. I freeze the pane. Okay, that's not the same thing. What are you talking about? Okay, I'm just saying. I had a gout attack, okay? Notice the other way you can do it is you could go over here and you could split. Or, I mean, you could freeze the panes here. So now you've frozen it this way and this way. So that might actually be better because then you can see the transactions. But it also kind of messes things up. It confuses people a little bit. The other thing you could do is you could split the panes right here so that now I have a whole different like pane over here and I could scroll on this one separately. So that's useful too. But again, for a screencast, that confuses people. So that'll work for you when you figure it out. But for me, I'm going to do a simple, just freeze the top rows and freeze the panes. Freeze the pane because it hurts. It hurts. It needs to be frozen, man. Just freeze the foot right off if you could. That would be helpful. All right, let's sum this thing up now. Equals the sum of these two. There's stupid beeping in the background. I have to do it all over again. I can't, that's gonna mess up my whole recording. Let's paste this, just the formulas, pasting just the formulas. Okay, and then we'll copy it down to make sure that we are remaining in balance. So nothing happened because again, one asset went up, the other asset went down. So nothing happened from an accounting equation standpoint. Okay, so now let's do the other types of investments. So notice that when you're setting up your accounting system in, say, accounting software or something, you might say, hey, look, can't I automate the deposit somehow and make an automatic deposit, maybe figuring all deposits are from customers or something like that. You kind of can do that in some systems depending on the industry you're in, but need to be very careful that if you are doing that, if you get a deposit from something other than a customer, you do not want to record it as revenue. Otherwise, if you're in an income tax system like in the United States, you'll be paying taxes on it, and that's not what you want to do. So, for example, you might get money from the owner. So the owner investment in business. So the owner's putting money in, let's say $10,000 from the owner goes into the business. Now, in a sole proprietorship, it would just go directly from the owner. If it was a partnership, it would be whatever partner. You'd have to allocate it to the proper capital account. If it was a corporation, how does an owner invest in a corporation when the owners are the shareholders? That's the issuance of the shares directly from the corporation, not shares that you buy on the secondary market, but shares issued directly from the corporation is money going into the company from the owner, the shareholder, right? The initial offering, the issuance from the company. Okay, so that's going to be the idea. Now, if you see that, how can I differentiate that from money that's coming from a customer? Well, the money coming from a customer, you might have different dollar amounts. Usually when you got the money coming from the owner, it's going to be something kind of even, like a $10,000, right? Versus if you're selling stuff, especially if there's sales tax, you're going to get some funny number. Oftentimes an owner investment might be larger than a normal singular sale, for example, or because you might be putting money in when you start the business or possibly when you're expanding the business. But whatever it is, you want to make sure that whatever system you have, you can separate the deposit from, say, an owner, which shouldn't happen all the time, more of a rare situation, than from the customers, which hopefully do happen all the time. The other side, where does the other side go? Cash goes up. The other side does not go in the income statement. We want to avoid recording it in here, in sales. It would still increase equity, but it shouldn't hit the income statement because it wasn't earnings. It should go directly into the owner's equity or issuance of capital if it was a corporation, so that we still see that it's money that is owed back to the owner, but it wasn't earned. It's not going to be part of retained earnings or owner's equity, the account that we roll over the income statement to. So there it is, 10,000 goes up on the equity side. Let's put our zeros across the board, boom. Now this is something that, again, we would possibly just use a deposit form from a data input standpoint to record, even though in practice it would most likely be an electronic transfer, possibly using bank feeds to record it, but the bank feeds will still use within the system a deposit type form as the data input if you were to drill down on the electronic bank feed typically. Or so that's going to be the idea. Let's sum it up. So there, we're going to copy this across. I'm kind of trying to go a little bit faster because we're running long on time, and I don't want to run long because I get out of breath if I'm running too long, and then I pass out, and then a tiger eats me or something. So I have to go faster. So let's copy this down, and then we'll copy this down, and then we'll copy this down. So now assets went up, equity went up, but it wasn't the income statement directly to equity went up. All right, let's do one more that we might get on, let's say 620. Maybe like when I'm investing in the company, the investment could come from money that we got out of retained earnings if there was money in the company that had accumulated from the sales that have happened in the past. But if it's a new company or you're trying to expand a lot, then you're going to need other resources of money. Where's it going to come from? Well, the owner, shareholders or owners or partners, or a loan. That's the other way you might get the money to expand, buying, new space to put space in. Now that the economy seems a little bit more on track these days, they might get some regulatory stability where we at here in America. So maybe people are going to be feeling a little safer to take out a loan and not have the regulatory burden shooting their legs out from under them. And so we could take out a loan and say, I'm feeling like this might be the time, man. This might be the time to expand. So we're going to say this is going to be 10, let's say the cash is going up again, but once again, we want to make sure that it's not the other side is not going to income. It needs to be going to a loan. Now, when we record a loan, it's going to be a liability because we owe it back to the bank. When we record a liability, there's going to be issues with payments of the liability because I'm probably going to be paying it back in installments. Those installments having both a cash, a principal and interest component to them. So the question becomes with a loan, should I record it as a short-term or long-term loan? And And so that becomes an issue that we might dive into a little bit more in future presentations, because it also becomes a reporting issue because the loans could have a short-term and long-term component to it, which you want to be aware of for reporting purposes, but you don't really want to have two accounts that you're always dealing with every time you make a loan payment. It also causes problems with the bank feeds. So, and there's multiple ways that we can think about dealing with it. But for right now, the main point is you want to make sure that you record it as a loan and not as revenue. It shouldn't be on the income statement. So this is going to be an increase to the loan. Boom. Shakalaka. Let's put the zeros across the board and wrap this thing up like a present that you're putting under the tree. So let's go like this. Don't wrap it up like I would wrap it. It would be ugly then. But like if someone knew, we're gonna wrap it up nicely. Like if someone knew, like someone would do that knew how to wrap it up here. Let's wrap this thing. Let's sum it up. So we'll sum this side up. Copy this across. Copy it across. Paste it. Formulas only. Paste it. Formulas only. Paste it. Formulas only. And then we'll copy down the last bit here. Copy down. Copy that. 10-4. 10-4. Roger out. Liabilities impacted this time. What? Que paso? My liabilities are missing. I added a new account over here and it's not. So I'm going to have to fix this. See what's happening? It didn't pick that one up. So I'm going to drag this over here. You need to pick that one up, dude. Dude. What are you doing? That's okay. I fixed it. All right. Your worksheet is broken, man. I can fix it. So now we have an increase. You're broken. So now we have an increase in assets and an increase in liabilities. And here's our ending balance as of this point in time. Hopefully that makes sense. So there's that one. Accounting equation and Excel. Sales receipt form for sales at a cash register or for when we receive payment at the same point in time goods or services are provided. Get ready and some coffee because we're about to learn the accounting foundation, the accounting equation with Excel. Here we are in Excel. If you don't have access to this workbook, that's okay because we basically built this from a blank worksheet but started in a prior presentation. So if you want to build this entire worksheet from a blank sheet, you may want to begin back there, or you could just build your own worksheet as we go, or possibly just use good old paper and pencil. If you do have access to this workbook though, there's currently 3 tabs down below. Example, practice blank. Example, in essence, the answer key. The practice tab having pre-formatted cells so you can practice the practice problem with less Excel formatting. The blank tab, the one we will be working on, it's where we started with a blank worksheet, but basically are using a template now. However, adding to that template as needed as we go through the practice problems. Let's go to the example tab to get an idea of what we will be doing, looking at a sales receipt type of situation where once again we want to be careful about the terminology that is going to be used in normal day-to-day language and a textbook and when we do data input into a software, for example. So if you're in a textbook and you hear the language of a sale was made for cash instead of on account, that might be the abbreviated way that the textbook is going to be telling you that basically a sale happened maybe at a cash register. That's what you might want to be envisioning in your mind, so that the payment is happening in some way, shape, or form. Cash, credit card, electronic transfer, whatever that form may be. At the same time, the goods or services are provided either at a cash register, usually the goods provided there, but possibly services at that point in time as well. When you think about accounting software, then you might be entering the data and not be at a cash register, but you still are receiving payment at the same point in time. Say the work is done, you could possibly think about setting that up with an automated system, such as using the bank feeds, where the deposits that you are receiving, you basically are assuming are coming from a customer, and therefore you're going to record them kind of as income. But whatever the system might be, if you do that system, by the way, you might be using like a deposit form, which is a little bit kind of unnatural for some accounting systems, because the deposit form usually is not the form that we use to record revenue, because the revenue forms, at least in like a QuickBooks and many other accounting softwares, is either an invoice when you make sales on account or a sales receipt form. So the form that we're typically going to be thinking of if accounts receivable is not going up and a sale is made is a sales receipt form. Noting that when you hear the term form, you might be thinking that I'm going to provide that form to a client. However, when you're doing data input in a software, you might provide the sales receipt as kind of like a receipt from the check register, a similar process there, emailing it out possibly in an accounting system. But the form is used internally as a data input form. That's the form that you data input in order to record the transaction, the form that will be drilled down on if you do an audit system, drilling down on the end product, the financial statements, down to the data input form. All right, that being the idea, let's go on over to the blank tab and do some data input. So we'll start off with one that doesn't have inventory, and then we'll add the added complexity of dealing with inventory in the process. So let's say 115, we have a sale at, let's say, a cash register, and so I would call that a sales receipt. Sales receipt. And you can imagine that terminology being similar to, of course, if you were to give someone a receipt for the payment that was made at a particular point in time. That's the form paper-wise that you can think of. But again, sales receipt to me means the form that we would drill down on in an audit system to see the data input form of a sales receipt. All right, so 12,000. So the question would be, is cash affected? By the way, I just added in this first line that we should have in there where we're saying that there was a $50,000 investment by the owner, 20,000 cash, 30,000 inventory, and the other side is in equity. Okay, so is cash affected? Well, we're going to say that cash is affected because we're receiving some form of payment at the same point in time. Again, it's useful to imagine like a cash register situation. So I'm going to say that cash is going up. Now, note that with a sales receipt form, you have a similar situation that in practice, as opposed to in a book situation, you might have this issue of grouping the payments together so that when they hit the bank statement, they will be in the same format as when you make a deposit into the bank, so that you can do a bank reconciliation. Now, if you're at a cash register and you're receiving cash payments, that is almost certainly going to be an issue that you'll have to deal with, because what's going to happen is you're going to collect the cash at the cash register, and then you're going to have to go to the bank and deposit it, not depositing it as each individual cash payment that you received. Therefore, the bank statement not showing every sale that was made, but rather depositing in one lump sum. Therefore, you would want to put it into a clearing account, which we'll talk about in another example shortly. You'd put it into the clearing account here and then deposit it into the cash account in the same format as the actual deposit form, making it easier to do a bank reconciliation. However, if you are making payments and you're getting like an electronic transfer or something like that, possibly with the use of a bank transfer or something, then you might be able to put it directly into the checking account using a sales receipt form, or possibly, given some accounting software, you might be using like a deposit form, which would be recording a similar type of transaction for the data input form. All right, so the other side is going to be over here in sales. Let's go on the sales. It's on the income statement. Equity, income statement, revenue, or sales is going to be the other side. Equity going up. Let's put some zeros across the board. We've got no subledger we need to deal with because this is just a cash-based system. Noting it's a cash-based system not because we just chose that we want to use a cash-based versus an accrual-based, but because we're in the type of industry, like a cash register, where naturally we get paid when we do the work. If you have a restaurant, you're not going to be invoicing the person that you just gave a meal to. You're going to be saying, "Pay me now, please," right? But if you're a bookkeeper, you're going to have to invoice generally because that's the custom of that type of industry. Let's do a sum of these two. Let's sum these up and copy that and then we'll copy this across. So we'll say paste it, formulas only, pasting it, formulas only. I'm doing this more quickly because we have seen these in the past. And so if you're new here, I did it a little bit more slowly in prior presentations, but now the people that have been following along are like, you need to speed it up, man. You need to speed it up because you're lagging. I know how to do this. All right, so then we're going to copy this down. We're going to copy this down. And so assets went up by 1,200. Nothing happened to the liabilities. The equity is going up by the 1,200, which is in the income statement, which is part of equity. And so that's going to be that. All right. So then we're going to say that's the whole transaction, right? If we had just the one sale. Let's do another one this time. I'll do it again. I'm going to say 921. But when we receive the payment this time, I'm going to put it into undeposited funds. So it's the same thing. We're going to have a sale that happened. Imagining it goes into a cash register for like 900. Let's imagine that we got cash this time, or similarly like a credit card payment, either of which will not go directly into the checking account, but will either be in the cash register or be accumulated and accounted for by the credit card company before it hits our checking account. So therefore, I'm going to put it into the intermediary account of undeposited funds. The other side is still going to be increasing the sales. So the other side is the same, but we put it into a clearing account, which is basically like a cash account, but it's a holding account so that we can transfer it from there into the checking account, possibly then using a deposit form, which is nice because then the deposit form will be the only form that shows basically increases to the checking account, allowing us to filter by deposit forms if we're using accounting software rather than having to filter by deposit forms and sales receipts when we're trying to look at increases to the checking account. All right, let's put zeros across the board. Zeros across the board. Zeros. Oh, not there. Control Z. No need to panic. I almost panicked again. But it's like, that's okay. I have a undo button. You should know by now. It's only been like 40 years of Excel work. You should realize you don't have to panic every time because there's an undo button. That's why they put it there. Let's sum up the last two here. Summing this up. If I just stayed calm, I probably would have saved put 10 more years on my life instead of panicking every time I deleted something and then I'm like, oh wait, I got the undo button. Maybe I shouldn't freak out. Even if I didn't have the undo button, what's the point of freaking out, you know? That's what I'm saying. I don't even know why I would freak out anyways. But that's just what I do, I guess. I don't know. Anyway, let's do another one. Before we deposit that, we're going to say on the same day, 9/21, let's say we made another sale, but this time we're dealing with inventory. So let's say we sale of inventory item at like a cash register. So let's say the units that we sold of the inventory are 200. So we just have one type of inventory we're going to imagine right now just to make it simple. Obviously, again, anytime you deal with inventory, you got to think about how you're going to set up your accounting system. Do you want to track inventory within the system or using a periodic system outside the system, and so on and so forth. But we're going to have to track the inventory in some way, shape, or form. If we are in a store, then clearly they're going to bring up the inventory to the cash register, and we're going to be able to count the units of inventory in a similar way as you might be useful checking out your own stuff at a grocery store, which oftentimes has an automatic checkout here in where I'm at least. So when you do the automatic checkout, notice it will tell you the sales price. We're going to say 2,500. It's currently in a percent format. I'm going to adjust that by going to the cell above it, Home tab, Format Painter, and paintbrush it down, then put the 2,500. So I'm going to put the sales price is 2,500. And then I'm going to put the sales tax rate, Now, this would be a usage tax in the United States. That's going to be a state tax versus a federal tax, which in the United States is a federal income tax. In other countries, you might have a similar usage tax depending on where you are at. Remembering accounting is universal, the double entry accounting system that is. Taxes are not. They're specific to location. Therefore, taxes are always the issue, the bureaucratic stick in the spokes that you're going to have to work out and figure out how you're going to deal with that. So let's put 5%, 0.05. I'm going to percentify it. And then we've got let's say the cost per unit is 10. So remember, if you check something out at a store, like with the self-checkout, you know the sales price. You know the sales price, the cost to you per unit. You don't know the cost to them per unit, right? That's unknown. It's not going to be on the sales receipt that you receive but it will be recorded if the system that you are using is using a perpetual inventory system like in a grocery store or something like that. So let's record this out. What's this going to look like then? Well, I'm going to say that the cash is going to go up, but I'm going to put it into undeposited funds again instead of directly into the checking account. How much are we going to get? We're going to get $2,500. We're imagining, I know that's a large dollar amount but for the United States, but we're going to get that. And then we're going to add to that the sales tax, which is $2,500 again times the 5%. So that's what we're going to get. We're going to get $2,625. The sales is the other side. That's on the revenue side. Our revenue is going to go up equals, but it's only going to go up by the $2,500, not the sales tax part, because in theory, that's not our earnings. The government just made us their little collection person on it. So we don't record it as income. It's off income statement, but rather we put it into the liability because we're just collecting on their behalf. It's going to go up on the liability and then back down. So the sales tax payable is going to be equal to the $2,500 times the 5%. Boom. Okay, so there it is. So that's going to be in balance. So we're going to have to still deal with the inventory, but I can basically think of the inventory as a separate transaction, even though it happens at the same time when doing a perpetual inventory system, as would be the case in like a grocery store or a cash register typically. Let's copy this down, which I haven't been doing. So if I copy this down over here, let's hope we were in balance before. Copy this down on the last one. So 900, 900, here's our current balance. Okay, let's copy it down thus far to here. So there we are thus far. There we are thus far. And so see, we're still in balance. See, we're still in balance. These two add up to that. Okay, but now I'm going to record the other part of it, which is the inventory situation. Now, to think about the inventory, we have a subledger that might be doing this automatically if you set it up in like your accounting software properly, right? So we might already have on the books, we're saying 10 units at like $10 a unit, 3,000 units, 30,000 units. We would need a flow assumption typically for most types of inventory, unless you're using specific identification, which would be the case if you have large types of inventory that are unique, such as a car or something. But otherwise, you're going to have to use FIFO, LIFO, or something like that, which I'm not going to get into in detail right now. But the general idea is they cost $10 a unit, and we sold, how many units did we sell? 200. I'm going to put a negative of the 200. So I'll put that in first. The cost, I'm going to say, is $10. We only have one layer of cost right now if you're using FIFO or whatever. And then that means the amount is going to be this times this. So there's the 2,000 that we paid in dollars. So the total units then is going to be 3,000 is what we had before in units, plus the negative 200 that we decreased it by. Therefore, the units we have on hand now, we're going to imagine 2,800. That gives us the dollar amount of 2,800 units times $10 per unit. So this is the issue that we have with the subledger for inventory, that being we can't just track inventory by dollar amount. We need the subledger breaking it out by unit as well, which becomes more of an issue when the dollar amount of the cost of the units change over time, forcing us to use a flow assumption like first in, first out, last in, first out, weighted average, and of course becomes more complex if I don't have just one type of inventory, but multiple types of inventories that I have to use a flow assumption on each one, and so on and so forth. But that's the idea. This 28,000 should match what's on the general ledger or in our account over here after we make the adjustment. So inventory, this is the accrual component that we would have to do for inventory. Inventory, once again, forcing us to abandon a cash-based system most of the time because we have to do the accrual thing of putting the inventory on the books as an asset when we buy it instead of just expensing it as we would do if it was a cash-based system. So inventory is going to go down by, once again, I'm going to say 200 times 10, 2,000. So the net impact on assets is the cash we got, the payment, minus the inventory, 625 net increase. The other side is on the income statement. Income went up by 2,500, but we had to consume something in order to generate that, not in cash at the moment, because we already paid cash for it in the past, but with the consumption of the inventory asset, which is, of course, the biggest expense, typically, if you sell inventory, that being the cost of the inventory, which we call COGS, or cost of goods sold. So it's going to be negative decrease over here for the, in essence, expense account of 200 times 10 again. So the impact on net income for this sale of the inventory, once again, is 2,500 minus, well, this time 2,500, the sales price, not including the sales tax, minus the 2,000. Okay, and that should put us back in balance over here. So that puts us back in balance. So we're still in balance, still got the green 0. So we're good to go, yo. All right, I'm going to stop saying yo. You can't say yo is like, that's like what people said like 100 years ago, dude. Like, what are you doing, man? Let's put a zeros across the board. Does anyone even say yo anymore? I'm finally into it now. But now no one does it anymore. I'm gonna say, let's put some underlines. I'm a little behind the times, I think. But I'm ahead of times. I'm ahead of the time because it's gonna roll, because it's cyclical. So it just depends how you look at it. I'm behind the times by like 40 years, but then because it's gonna come back around at some point, I'm ahead of the time by whatever, like until it comes back around. I'm gonna then sum this up equals the sum of these up to there. Let's copy that. Oh, it's got an underline. I'm gonna have to delete the underline. That's okay. I'll paste it, formulas only. Paste it, formulas only. Paste it, formulas only. Let's get rid of the underline. I'm gonna select this whole thing and make it look nice. Make it look fancy, like pleats on the pantsies. Let's get rid of the underline. Okay. All right, and so then we're gonna say, now let's make the deposit. So now we have 3,525 in our undeposited funds. Let's do I'm gonna do a freeze pane, so I'm all the way up. I'm on cell A4, then I'm gonna go to the View tab and freeze panes. So now I can scroll down so the headers are still there. So now we've got the 3,525, which is 2 transactions that were in here. That's why we didn't put it directly in the checking account, because now I'm gonna imagine that was received in cash or possibly with a credit card, either of which case means it wouldn't hit the checking account with 900 and 2,625, but rather is going to hit the checking account at the end of the night when I make the deposit at 3,525. Therefore, I want to make hit the checking account with 3,525, not 2 transactions of 900 and 2,625, Otherwise, it's going to mess up my bank reconciliation because the bank is going to see it as one number, not two numbers. And that's the idea. This is also could be useful because the sales receipt form, if you make them go directly into the checking account, again, means that a lot of software will use a different data input form for increases to the checking account. Therefore, when you want to sort the data, looking for increases by the checking account, sorting by deposit by form, then you'll have two forms, a sales receipt and deposit form. Whereas if you use the clearing account, then we can always use a deposit form to increase the checking account, which could make it a little bit easier to sort information in the checking account, which is the most common place to be sorting information and the most complex because it has more types of transactions in it than any other. So sometimes it's easier to simplify the number of forms that are going to be hitting the checking account for increases to the checking account to simply deposits and then possibly transfer forms. All right, let's say that this is going to be on 9/21. At the end of the night, we're going to deposit. We're going to walk to the bank and cash that check. Got to be careful because there's crazy people on the streets these days, you know, so we have to make sure we're locked and loaded over here to make the deposit. And so we're going to say, and how much are we going to put in there? I'm going to say it's going to be equal to the amount in the undeposited funds. That's what's going into the bank. And then we're going to take it out of undeposited funds. So the other side is going to be a negative of that amount, right? So it's just going to, one asset account's going down, the other cash checking account's going back up. Okay, so then we're going to put zeros across the board. Zeros across the board. All right. And then let's put an underline under here to make it look suitable for presentation purposes. Got to make it look nice. Making it nice looking is half the battle. Presentation is half the battle. That's what G.I. Joe would say. And so we're going to say this is going to be, then the new balance is going to be the sum of that. Let's sum it up. Equals the SUM of these two. So now we've got 24,725 in cash, undeposited funds going back down to zero. So there we have that. Let's copy this and paste it across the board. And it should just bring down everything. Nothing new happening over here. Just the same old, same old, same old, same old, man. What's happening? Just the same old, same old. Over here, all the stuff's happening on the cash side. That's where the action is. We're just chilling over here on this side of the equation. So we're just going to put some underline on that one. And then let's copy down our formula. So here's what the balance was before. I should have done this last time. So it's copying down the balance there, which is this and this. And then we'll just copy it down to these two. So nothing's happening because it came out of one asset and into the other. So even though the cash or the assets were impacted on both sides of the equation, it balances out to zero. Okay, so that's the sales receipts. Accounting equation and Excel. Credit memo, refund form, and bad debt expense. Get ready and some coffee because we're learning the accounting foundation, the accounting equation in Excel. Here we are in Excel. If you don't have access to this workbook, that's okay because we basically built this from a blank worksheet but started in a prior presentation. So if you want to build this entire worksheet from a blank sheet, you may want to begin back there or just construct your own worksheet as we go, or possibly just use good old paper and pencil following along. If you do have access to this workbook though, there's currently 3 tabs down below. Example, practice blank. Example, in essence, the answer key. Practice tab having pre-formatted cells so you can practice the practice problem with less Excel formatting. The blank tab is where we started with a blank worksheet but are now basically continuing with a template, adding to that template, however, as needed as we work through the practice problem. Let's go to the example tab to get an idea of what we will be doing, looking at the dreaded credit memo type of situation. The credit memo is often a scary thing to be recording for multiple different reasons. One is that it's not, or hopefully is not, a normal type of transaction because it usually occurs when we need to reverse, in essence, a sale that has happened in the past. Instead of deleting the sale that has happened in the past, which would eliminate the audit trail, we're going to be adding a credit memo, which in essence reverses the transaction that has happened in the past. Because it doesn't happen that often, then we might not have as much experience entering the credit memo. It also often requires some kind of approval if you're in like a store situation in order for a credit memo to be entered, say, into the system, for example. And the transaction of the credit memo kind of goes against some of the general rules we have related to the income statement, which is that the income statement accounts, income and expenses, typically only go one way. The income goes up in the income direction and the expenses always go up typically, which brings down the equity. With the credit memo, we basically reverse those rules. Also, we have a problem with the accounts receivable. So we're dealing with accounts receivable, remembering that if we have accounts receivable, then we also have to track a subledger tracking who owes us the money. So if I have a reversal to an accounts receivable account, I also have to deal with that dang subledger, which is an issue. And I want to be able to tie out this credit memo in an accounting system to the invoice that is in essence reversing, giving us the audit trail accounting software, often being useful for that kind of situation. Now, if there was a return of inventory, we also have inventory that we have to deal with. And the question is that inventory still good? Do I need to put it back on the books as inventory, or is it basically written off and we're not going to get the inventory back, right? So we have that kind of situation. Then you have things that are similar to a credit memo. Let's say someone returned the inventory, for example, and they had already paid for it. They bought it at a cash register. Well, in that case, you're going to have to give them a payment back. So it might not be a credit memo. It would be a return payment of some kind of form, way, shape, or form, because you've already got the money. And if you want to return it, you're going to have to give them money back or give them something else in return, such as basically a credit to purchase something else in the store or something like that, which again gets a little bit more messy of a transaction. All right, so keeping those things in mind, we're going to go back to the blank tab here, and let's say that we start off with just a sale on account. So we're going to imagine that we make a sale and accounts receivable is going to go up. And then, of course, we're going to have to reverse that sale, remembering that in a book, you might call that sale on account. That's what an accounting textbook might say. In practice, we would be data inputting into a form. That's the form that we enter the data into within our accounting software, which is usually called an invoice. So we're going to say that's going to be 1,600. Accounts receivable is going to go up. I'm going to do this fairly quickly because we've seen it before. Accounts receivable goes up. The other side's going to revenue. I'm not going to deal with inventory this time. We'll take a look at inventory more closely later, adding that level of complexity after we do the baseline example. So we're going to be picking up the 1,600. Let's put over here in our subledger. I'm going to say this is customer A again, tracking who owes us the money, this time in the subledger by customer, which we need to do with the accrual account of accounts receivable because we're not on a cash basis if we have accounts receivable, plus the last balance plus the sum of these. So the subledger is at 1,600, which should tie out to what is in our general ledger or our main account, 1,600. I'm putting zeros across the board, as has been our custom. So we'll just put the zeros on across the board. And then let's put the balance. We're going to sum it up. Little darling equals the sum. Sum it up. And we will copy that. And I'm just going to paste that across. Formulas only so we don't mess up our beautiful worksheet. And so we'll just paste that across, just the formulae. Just the formulae. That's not how you say formula, but it sounds cool. The formulae. All right. So then let's copy this down. So on the accounting equation, we have an increase of accounts receivable, 1,600, which is an asset. Nothing happened to the liabilities. The equity went up by 1,600. Let's put an underline under these transactions so that we see the information nice and neat. All right, so then we're going to say on 320, credit memo happened. Credit memo. Now, if we didn't sell inventory, they didn't have to return the inventory or something. Possibly they said, hey, look, your service was bad or something. And we're like, whatever, dude, our service was good. What are you talking about? But then they're going to complain. They want to sue us or something. And we don't want to deal with the legal issue. We're just going to give them a credit memo. Now, because they haven't yet paid us, they owe us in the accounts receivable. So we're just going to say, well, the accounts receivable, I'm just going to take the accounts receivable down. And that's all we have to do. So the credit memo would be the data input form for us to remove the accounts receivable. By the way, it being called a credit memo because in debit and credit format, we would debit the asset account to increase it. And now we are crediting their account. That terminology gets all mixed up because people start to think of credits like differently than debits and credits. Like it has its own meaning when we say we're crediting the customer account. It's like good, you know, but it's really, we're to us, it's an asset. We're crediting their account, meaning we're decreasing the asset from a debit and credit standpoint. So I'm going to say that accounts receivable is going to go down. Now, the other side of the transaction is where it gets a little messy because now we're over here. What happened? The sales didn't really happen because we're not going to get paid. We're never going to get paid. Now, I'm going to record it this time to the sales, but that means that sales is going down. Normally, we don't like that, right? So if you just enter a credit memo normally, which just reverses the transaction, it does give a nice audit trail showing us the entry and then the reversal, as opposed to deleting the transaction, which is not what you want to do typically in accounting software because you won't have an audit trail, but it's decreasing a sales account, which normally we don't like. So I'll show you what that looks like. And then next time we'll enter one and put the other side to another account, like bad debt possibly, or sales returns and allowances. So what's going to happen, we could say sales goes down, negating the sale. And then the subledger is going to go down. So A no longer owes us the money, even though they didn't pay us because they threatened to sue us. And we're like, all right, just bugger off if you would. We don't want to do business with you anymore anyways, because you're just messing with us. This just a troll. We don't do plus the sum. So we'll just give them this money back and we'll go our separate way and move on. Get better clients, man. Get better clients. Let's put some zeros across the board. All right. Zeros across the board. Boom, boom, boom. And then we'll put a balance down here. The balance, dude, is that. Let's add this up. So we'll just sum it up. Equals the sum. Boom. And then I'm going to copy that and copy that across the board. Pasting it just the values only. Just the values only. I mean, sorry, the formulas only. Not the values. The formulae. Okay, so now sales went back down. So again, that's a little odd. We might want to put it to another account like bad debt expense or possibly sales returns and allowances. So that's where the little twist will happen. So let's put that twist in. Let's do another one, but then add a twist into our routine. So we'll start with another sale. Let's just say this happened on 4/25, let's say. Another sale on account, so another invoice. We're going to say, let's just make this one 2,000 for example purposes. But before I do that, I'm going to copy this down. Let's copy this down. It reverses this transaction. So we're back to basically where we started. So this went up, and then back down, and we're back to where we started. Boom and boom. Put some underlines here. All right. Okay. Because I was getting ahead of myself. I don't want to do that. I want to not get ahead of myself. All right. So now let's go. Now we're ready. So now we're going to go accounts receivables going up by 2,000 again. And over here, sales is going up again by the 2,000. Same-o, same-o. And this time, let's say it was customer B and the subledger that we have to track who owes us the money. Hopefully this guy's going to pay us. Hopefully we got better clients this time, but no, this guy's a deadbeat too. We'll see. Watch. He's not going to pay us. I know it. Man, we shouldn't be dealing with this dude, but whatever. Plus the sum of these two. So 2,000, that should match the ledger over here. Let's put zeros across the board. Zeros across the board. And boom, boom, boom. Okay. And then we'll put the sum balance. And then the sum equals the SUM of the 20 and the 0. We're going to copy that across the board. AR is going up. So there's the increase there. We're just pasting it across the board. Okay. And then we'll copy down our totals. So the 50,000 is going up on the assets by the 2,000 in accounts receivable. No impact on the liabilities. The equity is going up by the revenue for the invoice of the 2,000. And then we're like, that's good. Now we've got picked up a new client. But then they're not going to pay us. We hear they're not going to pay us. We're like, dude, not again. So we're going to have to write off AR. Man, what kind of people AR uncollectible. Like, why are we need to have a better like vetting process with these people, man. We got to do some credit checks or something. This is not sustainable. This is like the government doing business or something. It's ridiculous. All right, so then we're going to say, but whatever, we'll write it off. So now accounts receivable is going to go down again. But this time, I don't want to decrease the sales account. I want to make another account. Now, oftentimes what will happen if we're writing off like the bad debt, we might have determined that they're not going to pay us. Maybe they told us, we know that they moved out of the country or something, and like, okay, we're not going to get any payment, or it's just been a long period of time and we write it off. Now, when we write it off this way to bad debt expense, there's two methods that you might use. Larger companies will use the more proper method, or if you have a lot of accounts receivable, of an allowance method, which deals with an estimate of the receivables that are going to be uncollectible. Because I might have a business model where I collect a lot of receivables, and I know that there's going to be a certain amount of them that are uncollectible because there's just going to be some deadbeats. That's part of the model. And then I will account for that by basically valuing my AR, estimating the amount of the AR that's going to be uncollectible so as not to misrepresent my assets as being too high when I know I have a lot of accounts receivable that I predict will be uncollectible, even though I don't know who exactly I'm not going to be collecting from. Smaller companies, and the easier thing to do would be to use a direct write-off method, which would mean I'm not going to write off the accounts receivable until I determine that particular accounts receivable account per customer that's not going to pay me. So right now we're using like a direct write-off method, and I'm going to go over here and say, let's add bad debt. I'm going to put a column over here before the utilities by selecting AG, the entire column, so that when I right-click and insert, it will apply items to the left of it. So insert, there it is, boom, beautiful. So this is going to be bad debt expense. Let's just say expense. So that's going to be here. So bad debt expense is going to be negative 2,000. So now notice what happened. Same impact on net income as we did before. It's going to be reversing the amount that we put to the income, but like we did up here. But this time, it's not going to go to the income account. It's going to go to the expense account. So income is still going up, but now the expense is also going up in the expense direction, bringing net income down. So it'll end up canceling out just like we did before to net income, but gross income will still be there, and then the net income will go down. The other method we'll take a look at is sales returns here, which is which we'll talk about later. So let's do this first. Let's put the zeros across the board. Zeros across the board. Zeros. Zeros, zero, 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 zero. And this, well, we have to zero it out of the subledger. So B is also a deadbeat. So we're going to say, dude, this is ridiculous. So we have the 200 plus the sum of these two, and that brings it back down. And then we'll bring the balance. So it's going to be the balance is going to be the sum equals the sum of these two. Copying that across. Copy it across. Paste the formula. Paste the formula. Paste the formula. And then I'm going to get rid of the underline. And okay, so now let's copy this down. So now we see it reverses here, just like we saw before, and we'll copy this down. Nothing happened there, and it reverses over here. Same thing from the equity standpoint, but it's impacting the expense instead of the income. All right, let's put an underline under that one, and I'm going to freeze the panes up top. So I'm going to scroll all the way up. Put my cursor in A4, freeze the panes by going to the review or the view tab, Windows, and then freeze panes. Boom. So the header stays there as I scroll down. That's super cool. Not just cool, super cool. Although not cold, because I don't like being cold. Just cool. All right, let's go to the 5.5, and then now we're gonna let's do another one. This time we're sale of inventory on account. So now we're selling inventory. We have to deal with the inventory. Let's say we sold it for 2,500, and the units sold, let's say, are 200 units, and then the cost per unit is $10. We'll say cost per unit $10, and let's say we have to deal with sales tax, which is a usage tax, which again in the United States is a state tax as opposed to an income tax, which is the federal tax. But in other countries, the usage tax might be the normal tax of the location. Remembering that the double entry accounting system is universal. I'll make that 5%. But taxes are not. The taxes are the stick that are in the spokes of the accounting system that you have to deal with depending on the location. Okay, so we're gonna have to say then cash. Let's say cash or accounts receivable is going to go up, not just by the 2,500, that's what we charged, plus what we're going to have to collect for the sales or usage tax, plus 2,500 times the 5%. The other side is going to be going to revenue or sales once again, but the only part that's going to revenue is our part, not including the sales tax, because in theory, that is going to the government. So we're just being the collection person on their behalf, doing our duty. So we're going to say this is the sales tax. It's going to be equal to the 2,500 times the 5%. It'd be nice as I do my duty if they would do theirs and stop people from shoplifting, help people to pay their bill, for crying out loud. How am I supposed to stay in business this way? Anyway, let's copy this down. They're collecting protection money and then not protecting me. It's ridiculous. I'd be better off paying the mob, for crying out loud. Oh, anyway. So the assets equal the liabilities plus the equity. So we're good there, but we also have to deal with the inventory. So we're saying that the cost per unit was $10. So we have the accrual component of inventory we have to deal with. Let's add that. It's going to be, let's say, negative 200 times 10. Inventory is going down by 2,000. Therefore, the Net assets are the difference between these two, which is, of course, the 625. And then on the liabilities side, on the on the income statement, cost of goods sold is negative of the 200 times the 10. So that means our net income went up by the difference between these two, which is $500 after consuming the inventory as an expense of cost of goods sold in order to help generate the revenue. And then over here, we had on the inventory subledger, I'm going to imagine that we started with 20,000 in inventory. Let me put this back on the books, and the unit cost was 10. And then the total units was, let's say, total units was this over this, and then so the total value is this times this. So let's do that, and then we're gonna say that we're down here now. And where was I? Let's do this again. I was over here on this line, line 16. And so now we're going to say that the cost is 10 still, and we sold 200 units, negative 200. I'll do it this way, negative all the way over to this 200. And then so that means that the total units, now I'm sorry, my starting point should have been 30,000. There we go. So then we're going to say then our total units equals what we had before, 3,000 plus the negative 200. So now we're down to 2,800 units, and that gives us a cost or dollar amount in dollars of inventory, 2,800 units. We're going to assume they're all $10, $28,000 amount. So that's going to be what should be matching on our general ledger inventory account after we total this thing up. Let's put zeros across the board. 0, 0, 0, 0, 0, 0, 0 across the board. Okay. And so there we have that. And then we also have the subledger. And let's say this is client A again, or customer A. Instead of having another one for C, I could add another one for C. Let's say we were stupid enough to make another sale to A after they didn't pay us the first time. So it's going to be the 2,500 plus the 2,500 times the 5%, or in other words, it's going to equal that 2,625. So there's the 2,625. And so our total is this plus the sum of these two. All right, so there's our another sale. So this should match what's on the books after we sum this up. Let's sum this up, have the balance here, and then we will sum it up. So this equals the sum of this plus this, because this is the last transaction we had, last balance. And we'll copy that across the board. Copy it across the board. Paste the formulas. Paste the formulas. Paste the formulas. And then we'll put an underline under these. Underline, or undo these underlines. Get rid of those, put an underline under these ones. That's where the underline should go. Do it right. You need to do it right. You have the underline in the wrong spot. Okay. There we go. And then I can copy down the balance here. So then I'm going to say, all right, copy this down. And see if we're still in balance, which we should be. Okay, let's put some underlines under these. Green 0 means we're in balance. So that's good. I should have an underline there. So that's good. Okay, so there we have it. Now we'll do another credit memo. You mean A's not going to pay us? I told you not to make a sale to that guy again. He already didn't pay us last time, for crying out loud. What? Oh my goodness. Whoever sold inventory to a customer again, it's fired. You're fired. We can't do business like this. What do you think? We're the government? It's ridiculous. Okay. That's okay. Let's just deal with what we got here. We're going to say, now we could just reverse the entire thing, right? So if I'm going to reverse this, the easiest way to think about a credit memo with inventory is to first think about the sales transaction. So you want to think about the sales transaction and then reverse everything exactly, and then think about the twist that you would put in place. So in other words, I would just reverse it by saying accounts receivable is going down, right? So I'm going to reverse that. I'm going to reverse the inventory, again, assuming that I'm getting the inventory back and I'm going to have to add it into inventory again. However, if the inventory is damaged or something, then I wouldn't add the inventory back, right? It would just be a lost cause. It's already expensed in cost of goods sold. And then I'm going to go over to the sales tax. I need to reverse that because I don't owe the sales tax at this point in time because we didn't make the sale. They're not going to pay us. But then when we get to the sales item, I don't want to reverse the sales directly, but rather, instead of putting it into bad debt this time, I'm going to put it into what we often do, a contra sales account, when we have inventory that we sell called sales returns and allowances. Typically acts like an expense, goes in the same direction as expenses, but is usually grouped in the income side of things. Basically, it's going to be a net sales side or gross net sales. So I'll put my cursor on the double A here, right click and insert, and I'm just going to call it sales returns. Now you might call it sales returns and allowances, but that's going to be too long. I don't want to have another row, so I'm just going to call it sales returns up there. And so that's going to be that. And then we'll say this is where I'm going to put the negative 4,500, allowing sales to remain. I'm not going to have, because sales is only going to go one direction. Sales only goes up. And then when I have to reverse sales, I'm still going to leave sales alone, show it in another account, which is kind of like a contra account because it's a sales account that goes the opposite direction. Contra accounts being generated or come about because we want to show more detail, breaking out what would really be in this account into another account so that we can show the other half of, in essence, the T account, if it was debits and credits, in another account. All right. Let's put the zeros across the board. Zeros across the board. And so there we have it. And boom, boom. And then we have to take it out of the subledger. We have to take it out of the subledger. If anybody sells anything to A again, I swear, man, like, oh my goodness. This is going to be negative, or let's just say it equals that. Okay. And then this is going to be equal to the prior balance plus the sum of these two. So subledger back down to 0. And then the inventory subledger is going to also be impacted because now we got the units back on the books. So now we're going to say the units, the cost per unit is the same. And we basically, now we've increased by 200 units again. And so that's going to be equal to total units are at 2,800 plus 200. Again, assuming we can put those units back in inventory. And then we have this equals the 28 plus the 3,000, or I'm sorry, this equals the 3,000 units times $10 per unit, which brings us back up to where we started at the 30,000 units, right? Okay. Now hold on, I put the 30,000 on here 2 times. I shouldn't have. This should be, oh my goodness. Let me remove this one shouldn't be here because I had it up here already. And then this one should be the total is now going to be this times this. Total units should be not here, but up here. Sorry about that. And that should bring us back so everything else looks proper. So we're back up to 30,000. That's the bottom line. Okay. All right. Let's put some underlines across this. Underlines. If we could. I'm going to wrap this up. Running long. You're running too long, man. You're pulling too much time. You're breaking your own rules, man. Okay. We're almost done. I need to get to the vault. Not the vault. All right, I don't know. I have a movie in my mind. Copy these down. Am I in balance? It's not in balance. Que paso. So we have the receivables. What happened here? What in the world happened? It's because I picked up the wrong amount here. So this needs to be negative of this, not the balance. This needs to be the negative of the 2,000. There we go. And then the sales item here needs to be the negative of the 2,500, not the balance. So I was picking up the balance. Okay, so that makes sense. Does that put me in balance? It does not. So did I do the same thing for the sales tax? The sales tax should be negative of this. Okay. And then I'm missing the inventory, I think. So the inventory I did not put in place, which should be negative of this. All right, that should do it, man. Sorry about that. That was a mess, but that's what the double entry accounting system helps us do there. So now we're back in balance. All right, so then I'm going to put the balance down here, and we'll sum this. We'll sum this up now. Let's do this. The sum equals the sum of these two, and we'll copy that and paste it across the board. Formulas, pasting formulas, and then pasting formulas. Okay, I think we have it now. So the accounts receivables back down to 0. Subledger here's at 30,000. That subledger should match the 30,000 here. Accounts receivables down to 0, matching the subledger. Now let's see if we're in balance with the total. Copy this down. Copy this down. Copy this down. And underlines. And we're back to where we started. 50,000 and 50,000, because we made all these sales to deadbeats, one of them being the same deadbeat, and we had to then do credit memos to all of them. All right, any case, let's do one more thing here related to a credit memo, and this would be a sale. So let's say on 115, let's say we made a sale at cash register, and that's going to be a sales receipt. So this time, let's imagine we already got paid. So let's say we got $800 at a cash register. Going to record this quickly. $800 goes up. Sales is going to be the other side of it. So sales is the other side. Ba-boom. And let's put zeros across the board. Zeros across the board. And then we'll do the underlines. Underlines through here, underline, and underline, and underline. Okay, and then we'll copy this down, see if we're in balance on the transaction. We should be 800 change to assets, no liability change, equity, 800 change, balance. Then if I sum this up, equals the SUM of these two. Copy it, paste it across. Formulas only. Formulas only. Formulas only. Okay, no subledgers we have to deal with because there's no inventory or accounts receivable. Now let's say that something happened and they want their money back again. So here we go again. We can't make a sale. These customers. My goodness. Another one claims to sue us. This is not good. Maybe it's us. Maybe we're the problem. Maybe our stuff isn't good. I don't know. I'm starting to question the quality of our work at this point. Let's put some underlines under here and say, so now we're gonna have to refund it. So if we refund it, notice this is a little different because we're actually gonna have to give them a payment back, or possibly like a credit or something that could be applied to a future purchase or something like that. So that means that we're gonna actually have to decrease cash, right? So cash is gonna have to go down, and then the other side is gonna go to, it could go to sales. Let's just say it's gonna go to sales returns and allowances. We have the same issue on the other side, meaning should we reverse sales or go to sales returns and allowances? I just want to point this out because it's the same idea as a credit memo, but if there's no AR and you have to issue them a check, it's not really a credit memo. Most accounting software will use possibly another term because you're going to have to issue them a payment because you've already received the cash, right? And so, but the other side would be the same. If there's inventory, it would be the same. I'll just put it to sales returns and allowances instead of hitting the income account. And so there we have that. So there we have that. Okay, so let's put the zeros across the board. Zeros across the board. Almost there. This is a long one. I should have broken it out into 2 presentations. I had it broken out into 2, but then I was like, no, I can do it in 1. And I probably should not have put some underlines under that. But, you know, it is what it is. And it's long. That's what it is. That's okay. And so let's copy this down. So we should have 800 goes back down here. Nothing happened to those liabilities. At least we don't have any liabilities. Dang, clients don't pay us, but at least we don't have any liabilities yet. So that's good. Let's sum this up. Let's look at the bright side of things. If we could for a second, we'll copy that across. Copy this across, paste in the formulas. Paste in the formulas. Paste in the formulas. Okay. And then there we have it. Let's add a balance. Summing it up equal, well, wait, I'm just going to copy it down. Copy it down, should sum it up. And we're back in the balance. So once again, we're right where we started again. After all this time, I'm in business to make money, people. We need to get better clients, man. We need to find some customers that aren't deadbeats. Let's do better. We need to do better next time. So we'll be back. We'll try again later.